So at some point, you also have to start to wonder, when do lower yields and lower crude actually recatalyze some of the growth story? So there's that may be to come in the back half of the year here. Copper has certainly been weak to the extent that reflects China. But the commodity picture is very, very mixed here. I think the strongest trend, without question, remains gold.
Still, even with bonds, it's remarkable that they're still rallying this morning, because you could say we've moved from 4.7 in year 10 to under 4. We have something like 150 basis points of cuts priced in the next 12 months. We've completely obliterated that higher for longer narrative. Is this not an asymmetric risk going into this earnings report, that everyone is coalesced around this really bearish story?
Yeah, you know, I think what you've seen in the positioning is a massive shift over the last few weeks when people got caught off sides. And you can see that in the price action. You see it, I think, in the follow-through over the last several days. You know, John and I were saying off air, what happens if you get a soft number and you actually put your low in bond yields today for the next couple months? I don't think that's out of the question. Yields are very oversold here. 375 on 10s, I think, is probably a good interim low. I think under 375 that's when you begin to say, okay, what does the bond market really know about the economy that I haven't quite figured out yet? So that would kind of be my line in the sand. Particularly the 2-year yields, they are very, very oversold here. So I wouldn't be shocked, irrespective of what the payrolls is, if we actually got a bounce in yields over the next 4, 6, 8 weeks. I think that ultimately would fail at a lower high. I think you still want to be kind of secularly more bullish bonds here, but we'll see what the next couple weeks bring.
I'm just trying to understand what the reaction to equities would be to that, because we do seem, again, I know you say it's only a few days, but it does seem like a shift. That bad news is bad news, and we have a growth scare. Well, your yields go lower, and so does the price of equity markets. What tells you that holds or not?
I mean, we have 80% of stocks above the 200-day moving average. I wouldn't say this is a market that's been dying internally for the last 6, 8, 10, 12 weeks. If anything, it's actually been improving over the last 6, 8 weeks. That's not where your big problems generally come from. We're into a weaker seasonal. We're into an election season. Could you get consolidation, correction? Absolutely. History tells us those tend to be modest. History tells us those tend to be modest, particularly when you enter that period in a relatively strong trend. I think we're going to change the sentiment really fast here. Whatever kind of residual bullishness was out there, I think will decay pretty quickly. So I would be careful getting too worked up about this just yet.
Not just the weakening U.S. economy, but there's also been a flight to safety because of geopolitical concerns, also falling U.S. government bond issuance. How do you discern why the market is moving?
Yeah, something we've always said in our work is you have to kind of really differentiate between what you think should happen and what will happen. And I know all year there's been all this anxiety and angst about a couple bad auctions, about this untenable debt situation that we're on. The market doesn't care right now. Right? Those may all be things that matter at some date in the future. The market doesn't care about them here.
Are you trolling Lisa while she's on vacation? Is that what you're doing?
I am trolling Lisa.
We're throwing shade at Bremo.
Listen, I think gold has had this figured out all year, right? Gold has been the decider between what could happen and what should happen. What should happen? Should the Fed be cutting into a relatively strong economy all year? Probably not, but I think gold knew that they probably would, and gold strength has likely reflected that.
You mentioned the election. Cutting through the noise, what policies are you looking at that are going to impact the bond market in 2025, and how do you even remotely start to plan for that?
Well, I think a couple weeks ago when we were last on and we were talking about the likelihood of a Trump presidency, or what maybe seemed more likely then, would it result in...
So it's 5 minutes now until we get Chevron's Q2 2024 earnings. Estimated EPS is $2.93 and an estimated revenue of $50.31 billion.
That maybe you get much less fiscal impulse in 25, and I think certainly that's been on display here. I am curious to watch how what were described as the quote Trump trades over the last 6, 7, 8 weeks, financials in particular, maybe small caps to an extent, how they behave here over the next 4, 5, 6 weeks, because there's certainly been, I think, an attitude shift towards the left in terms of a better chance of winning this election. Does the equity market actually continue to reflect that over the next 6, 8 weeks? I'm reluctant to believe any election signal in August. I think it's going to be a noisy month. Let's talk Labor Day and kind of see how these things are starting to shake out.
You were drawing a distinction between what will happen, what should happen. I want to talk about what is happening outside of the United States. Dollar yen is absolutely ripped lower.
Yeah.
We've gone from talking about the 160s to the 140s. The Nikkei 225 in the last 2 days 2 sessions, we're down more than 8%. Yeah. We've had people come on this program repeatedly and say the Japanese equity trade is not about what's happening with the currency. We'll not be upset by what happens over at the BOJ, and then what happens? It's falling apart. Yeah. What do you make of the moves we've seen over the last few weeks?
My favorite part about this business is picking up little clues and then putting together some call around it. And the little clue that we began to get in April, May, June, all the Japanese exporters started to meaningfully underperform. And if yen was going to 170, that should not have happened, right? So you were seeing stocks like Toyota really weak, and we were sitting here, okay, some part of this market knows something, and this market knows yen's about to strengthen. What does that mean? We're very oversold in the short term on dollar-yen, kind of in the high 140s, 150 range. Could you bounce from here? Yes. I think a bounce would fail at 153 to 155. I think you're talking about meaningfully stronger yen in the future. It's the exact opposite of what we saw in 2012 when all these Japanese exporters actually began to outperform in anticipation of a weaker yen. So there's a lot of clues coming from the equity market of where yen is heading. Now, what are the implications of that? Well, sell yen, buy tech has been the global carry for as long as many of us have been doing this. And I wonder if the kind of tech trade is reflecting that here.
Interesting. You think these two stories are connected?
Absolutely. And
is this a trend you want to step in front of?
Absolutely not. I think the change in yen has tentacles far beyond what it means just for Japanese stocks or what it means just for the dollar-yen cross. I think there's a really important kind of pushback against this global carry.
Given what you've just said, then, you couldn't sound more bearish, because basically you just told us that we're going to get meaningful appreciation in the Japanese yen through the rest of this year. That makes it very difficult to be constructive on the rest of the market, doesn't it?
I think we're starting a process where path of least resistance for yen is stronger, not weaker. And that's a change from, obviously, where we've been for a decade. I do think in the very short term, a lot of this stuff, the rubber band's been pulled too far. 155 on dollar-yen would be good resistance. I think, something like maybe 420 to 430 on 10s would be good resistance if you rallied them here. But we've started to change some really big trends.
Super smart. Chris, it's good to see you.
Thank you. Good to be here.
Thank you, sir. Thank you, and great call on the bond market over the last few months. Chris Verrine there of Strategas, a bed company. Equity futures this morning negative across the board. On the S&P 500, we are lower by more than 1 full percentage point. Let's take the opportunity to get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackers. Hey, Yahara.
Hi, John. U.S. President Joe Biden telling Israel's Prime Minister Benjamin Netanyahu it's time to agree to a ceasefire with Hamas. In a call on Thursday, Biden pledged to support Israel against Iran and Hezbollah, but the president said he was, quote, very direct with Netanyahu, saying they have the basis for a ceasefire and Netanyahu should move on it now. Venezuela opposition leader Maria Corina Machado calling for nationwide protests to defend what her party sees as its rightful electoral victory. This coming as U.S. Secretary of State Antony Blinken says the U.S. backs a transition of power. In an address to the nation, President Nicolas Maduro warned that 2 maximum security prisons would soon be ready for the thousands of Venezuelans who have protested the election results. And a joint sports streaming venture between Disney, Fox, and Warner Brothers Discovery now has a name and a price. Venue will launch in the fall and cost $42.99 per month. The platform will provide live access to major leagues, including the NFL and NBA, while including content from both ESPN and TNT. Venue will compete with ESPN Plus, which costs $10.99 a month, and the Hulu Plus Live TV package, which costs $76.99 a month. Smaller competitor Fubo filed an antitrust lawsuit back in February against
Chevron's EPS at $2.55. That's a miss on estimates of $2.93.
I cannot spend any more money on sport. I'm right here. The limit.
Pretty sure you have
Revenue at $51.18 billion. That's a miss on estimates of $50.31 billion. Cash flow from operations at $6.3 billion. A miss on estimates of $8.91 billion.
Come on. I'm done. Up next, threading the AI needle.
If you end up actually with
Upstream earnings at $4.47 billion. A miss on estimates of $5.14 billion.
However, if you actually deliver too much capacity, the economics are pretty woeful, and you don't like the returns of the operating income.
Disappointing outlook from a couple of these big tech titans. Their conversation up next, live from New York City this morning on this Payrolls Friday. Good morning.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
Michael Hartner, Bank of America, called it classic risk-off. Hard landing risks are clearly rising at a time when consensus holds a soft landing or no landing view. South stocks, that dropping a little bit early this morning. We'll talk about that a little bit later. Equity futures, if you are just joining us going into payrolls, the sell-off continues. We're down by more than 1 full percentage point on the S&P, negative. In the bond market, the rally continues. Yields down by 4 basis points. The 10-year, a break of 4% in the last 24 hours. We're down to 393 on a US 10-year yield. Under surveillance this morning, threading the AI needle.
If you end up actually with too little capacity, then you have service disruptions, which really nobody does because it means companies.
Chevron's downstream earnings at $597 million and miss on estimates of $692.1 million.
Too much capacity, the economics are pretty woeful, and you don't like the returns of the operating income. While we're investing a significant amount in the AI space and in infrastructure, we would like to have more capacity than we already have today.
So here's the latest. Amazon falling in the pre-market. The company's outlook for operating income falling short of estimates, telling investors that profit will take a backseat to AI spending in the near term. Meanwhile, weak sales in China overshadowing a generally upbeat report for Apple, the iPhone maker expecting its new AI features to drive device upgrades in the coming months. To break it all down for us is Mandeep Singh of Bloomberg Intelligence. Mandeep, let's start with an absolute dog of a quarter for Intel. Intel just looks absolutely awful. The stock, and we don't use this word often, but I think we can say it, the stock's essentially crashing in the pre-market early trading. Mandeep, what is going wrong at that company?
I mean, clearly they're losing their share on the data center side, and there's a reason why NVIDIA is doing so well, is because not only is it getting all the incremental CapEx spend, it's actually taking share from the likes of Intel. So that's one. The other is Intel has been investing on its foundry business for the last 3 years, and there's nothing to show over there. No revenue, and not even a ramp in terms of what they're doing on the foundry side. And that's what spooked investor, because that's impacting their gross margins. I mean, now we are talking about sub 30% gross margins for Intel, which was unimaginable 5 years back. And I think that's what's going wrong with them.
Mandeep, 50% of its workforce it's letting go. Where are these jobs that they are laying off from?
I mean, look, it's across the board. I think they realize on the chip side, they don't have much exposure in terms of GPUs. So clearly there are cost cuts on that front. And the foundry business is where I think they need to make a decision.
So at 6:30 a.m. Eastern Time, we do get ExxonMobil's Q2 2024 earnings. Estimated EPS of $2.03 and an estimated revenue of $87.74 billion.
And that hasn't helped them either. And I think the time is running out when it comes to showing execution on the foundry side.
To be fair, Intel is by far having one of the worst reactions to an earnings, but it's not just them in the chip-making world. It's ARM, it's Qualcomm falling 16 and 15% after their earnings. This is a really cyclical market, Mandeep. But can we tell where we even are in a chip market, in a chip cycle, when you have distortions coming from both COVID and now AI?
I mean, this quarter is all about AI, and that's where, you're finding out who the real AI winners are. Clearly, that's NVIDIA. AMD, everyone thinks they are getting there, but they are so far behind when it comes to showing the growth around AI relative to NVIDIA. And Qualcomm and others are the same. they don't have as much exposure as NVIDIA does, and that's where the market is really separating, who the real winners are versus who benefit, but just a tad bit.
Mandeep, bear with me. I'm just going to go through NVIDIA over the last 3 days. Yesterday down almost 7%, Wednesday up 13%. Bear in mind, Wednesday was the biggest addition in market cap on a single stock in a single day in the history of US markets. The day before that, we were down 7%. That is some real volatility on one of the biggest companies on the planet. Mandeep, what is going on with that name?
Well, look, I think everyone realizes they're going to have a great quarter. And in fact, the next 2 quarters are going to look great because the market is still undersupplied. But the stock market will look ahead, 12 months from now, 18
According
months
to
from
sources,
now,
the market sees a 50% chance of 100 basis points of Fed cuts in 2024.
Will this growth continue or will it taper slightly? But there's no doubt NVIDIA is the real winner when it comes to this AI wave. Every company has increased their capex this quarter, barring Apple. And that just goes to show that, from the hyperscalers themselves, they're going to see 35 to 40% growth for the next 6 months.
Mandeep, could we talk about China for a moment? Just broadly, how concerned are you about what is going on in potential slowdown in China based off what we saw from Apple as well, the fact that their iPhone market is still hitting some bumps?
Look, I think there's no doubt long-term that Apple business in China, it's going to taper, it's going to decelerate, no matter how they try to, maneuver it in terms of ASPs versus making sure the Chinese government is still on their side. But longer term, it's going to go down. And Apple has done well in terms of making sure they smooth out that transition as opposed to doing it in a knee-jerk way. And credit to them, the services business grew 14%. That's what sort of insulates that steep decline in EPS or margins that everyone was hoping we don't see with Apple.
And can I just ask, what happened to their VR headsets? It literally wasn't in the earnings anywhere, and they made such a deal over it.
Well, look, if you're not talking about AI this quarter, there's something wrong with you as a tech company. And clearly, I think they're realizing they need to make that pivot. Look at Meta. How well they had the best quality beat and raise this quarter, partly because the whole call was about infusing AI into their apps and actually benefiting from it. I think Apple has realized they need to focus more on AI, although still they are very disciplined when it comes to the CapEx side and how much they spend on AI, but clearly the narrative is shifting and it will shift more in the upcoming quarters.
And Mandeep, Anne-Marie mentioned China. Do you think a strong currency is a good excuse for the weakness we saw?
Yeah, FX does have an impact, but it shifts from quarter to quarter, so I wouldn't make much out of it. In the end, it will come down to AI. That's the story. That's what everyone is focused on, and I think that's where you will see the mega caps really separate, the ones that keep growing top line and margins. Like Microsoft beat, 30% revenue growth.
So less than 5 minutes now till we do get ExxonMobil's Q2 2024 earnings. Estimated EPS of $2.03 and estimated revenue of $87.74 billion.
Particularly on Apple, looking ahead to September and this upgrade cycle we've been talking about now for months and months. In fact, I would say for years. A lot of people think this step up is going to be that significant in the next 12 months that a lot of people will ultimately upgrade.
I just wonder if we're really contending with how weak the consumer is and whether they're actually willing to upgrade if it's expensive, even if it has AI.
John's my litmus test for this. He doesn't like upgrades on the iPhones, but will he upgrade for that artificial intelligence tools?
I'll let you know later this year. Kit Jukes of SocGen joins us next on a jobs report 2 hours away.
every single thing I've done, it's almost as if somebody has said it can't be done. I mean, I remember I was in a factory and I said, I want to go in the night shift. And they said, no, we don't put women in the night shift. I said, how will I be a successful production manager or personal manager of a factory if I never went into a night shift and knew how a third of my people worked? So in some ways it has fueled some of my determination. It's fueled some of my, okay, I'm going to show this is possible, a sense of I'm going to go get on and do it. It also gives me courage because I feel sometimes I'm not just doing it for me, I'm doing it for everyone else who comes after me. And I always tell women who ask me for advice saying,
1 minute to go now.
The most difficult job. Put your hand up for things that are challenging. You know, go in there and lean into things that are difficult, that are challenging, because that's what gives you the greatest credibility, respect, reputation.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs, taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Equities look like this on the S&P 500, negative here by a little more than 1%. Some negative follow through from yesterday. We're down by 1.6% on the NASDAQ 100. The underperformance is where the outperformance...
Seeing adjusted EPS at $2.14, a beat on estimates of $2.03.
The real deal. Danny, we've had a few
revenue at $93.06 billion, a beat on estimates of $87.74 billion.
Summer as well. Is this a welcome cooling or an unwelcome deterioration in this labor market?
Again, I go back to the idea that it's all going to matter if this is layoffs, if that's what's forcing this move higher in unemployment, that you have these companies that are letting go of their workforce because they're realizing that just cutting costs is not going to save their margins, that they need to let people go in force. And that's when you get that nonlinear move. And that's when you say, okay, maybe 50 basis points is on the table.
The volatility in this equity market has been unreal. We closed out July with the best day of gains since February. And then we took it all back the following day as we kicked off the month of August. Switch up the board and get to the bond market. Let's sit on a 10-year yield. 7 consecutive days this 10-year has been rallying. Yields are dropping again by 4 basis points. Over this period, we've seen a drop of more than 30 basis points. Danny, that's quite a move in the last week or so.
You take it back to April, we've went from 4.7% to under 4%. You have multiple cuts priced in. You have 150 basis points of cuts over the next 12 months. How much more juice is there really left in this rally? I mean, is the risk not asymmetric? I asked this to Chris Ferrone because you have this narrative building that things are really bad right now, that the jobs data is going to be horrible. 175, what we're expecting, is still fine. That is not the world falling apart. So did we overdo this bond market rally?
What's the danger zone here? What is like a really bad print? What is the bad news story later on this morning?
The thing I worry about, and Managed Cranny has been really good on this, that there's just going to be a lot of confirmation bias in these numbers. That regardless of what we get, people have decided that things are really bad, that even a slight tick lower than what we expected will be enough to continue this bond market going as it is.
There's a feeling that for a lot of people, if we get strength, we'll ignore it, that it's not real. If we get weakness, to your point, it will just confirm previous. Let's turn to the foreign exchange market. I want to sit on this. Dollar yen, the move we've seen on dollar yen from the 160s down to the 140s. We've broken below 150 in the last couple of days, 148.84. We're down another third of 1% on that currency pair. A 5th week the dollar yen has moved lower. That is the longest weekly streak of the year so far. This week, I think we're down another 3 percentage points. But it's the move in the Nikkei 225 that gets your attention as well. As this Japanese yen strengthens, this stock market is getting absolutely hammered. The Japanese equity market, Danny, down by almost 6%. We're down 8 in a couple of sessions.
And I think you've put this so well that so many people have said, look what's happening with Japanese corporates. There is a fundamental shift happening. They're getting more investor friendly. Warren Buffett is in this market. You want to be investing, and it doesn't matter what the macro is. The truth is that it does matter. You can see it in the price action over the past week that a strengthening in the yen is a problem, not to mention just the technicals of it. Japan is a much more liquid market than the rest of Asia. So if you're looking on a day like today where your entire portfolio is getting beaten down, Japan's a really easy place to sell. And I think a lot of people have overlooked the technical factors of this market.
Brutal moves. The consensus calls of the last, 6 months or so getting unwound in a pretty vicious way over the last month or so. Under surveillance this morning, a top story for you. Shares of Amazon falling in the pre-market after warning profits will take a back seat to AI spending in the near term. Meanwhile, Apple seeing poor sales in China overshadow a generally upbeat earnings report. Nvidia is the last of the Mag 7 to report later on this month. Politico reporting the DOJ is investigating the company's acquisition of Run AI, Anne-Marie, on antitrust grounds.
And this was actually, it seems like a pretty small acquisition in terms of NVIDIA, I think $700 million. What it feels like is like potentially you have the DOJ starting to look at these
And Exxon expects over $90 billion of share buyback in 2024.
Or e-commerce behemoths that we already have in the United States. So they're getting in ahead of it and potentially some
The annual buyback pace of $20 billion expected through 2025.
Safety, national security concerns. So I think you're going to start to see a lot more of these crackdowns coming from Washington when it comes to these AI players.
We're seeing this massive spend on AI, and Mandeep Singh of Bloomberg Intelligence was with us about 10 minutes or so ago. And what did he say? NVIDIA wins, Intel loses. That's the story of this quarter.
Well, the great thing for NVIDIA is that all of the hyperscalers we've heard of, despite the market not liking what they've heard, they've all talked about this huge spend they're going to do this year. I think Amazon yesterday was something like over $60 billion for the year. If you look at where NVIDIA gets its revenue from, it is Meta, it is Amazon, it is Microsoft. Microsoft is 20% of its revenue. So you could say, yeah, the market really didn't like these earnings, but these companies are spending, and ultimately, who does that benefit? It's NVIDIA.
That's the earnings story. Let's just take a beat and pause. Just fantastic scenes on American soil in the last 12 hours or so. President Biden and Vice President Kamala Harris welcoming home Wall Street Journal reporter Evan Gershkovich and other Americans freed in the largest prisoner swap with Russia since the Cold War. The swap including 16 people going to the West and 8 returning to Russia. Just beautiful scenes on this side of the world.
Absolutely amazing. And our photographer that was there on the ground actually has this pretty incredible photo of Evan Gershkovich lifting up his mother, just pure joy. And you can actually listen to the conversation President Biden had with all their families around them, phoning into the airplane as they were in Turkey coming over to the United States. Really incredible moment. Obviously, though, I think in the next few weeks, after people start to recalibrate, what does this actually mean? The U.S. got back civilians and they traded for assassins and criminals, basically.
This was a prisoner that was swapped in Germany that the German government did not want to give up. Someone who assassinated someone in broad daylight just for, again, normal journalists. I have to say the Wall Street Journal has such a good piece on this. It's something they've been working for years, essentially since Evan was first jailed. It ends with saying there's basically this pro forma form that you need to send to Putin when you're being released to say, you know, please release me. People usually don't really fill it out. He filled it out, and at the end of it, asked for an interview.
I can't wait to read his book. And I hope it includes a sit down with Putin somewhere not in Russia, maybe when he goes on one of these overseas trips.
Yeah, I'm not sure he'd want to do that again. Just unbelievable. Fantastic scenes here in America in the last day or so. Let's turn to the economic data. The US jobs report just under 2 hours away. The median estimate in our survey looking for a print of 175K. Kit Jukes of SocGen warning the jobs data have more potential to move markets than usual, writing this. The US manufacturing sector has been losing momentum and employment growth has been slowing for months. The question is whether we are near a tipping point where the pace of slowdown picks up enough to make the Fed wish it had started to cut rates sooner than it has. Kit joins us now for more. Kit, it's great to catch up with you, sir. I just read the first line, if you note, as soon as it dropped earlier this morning. Canary in the coal mine or a red herring? Kit, which one is it?
We won't know till September or October. We're at that time of the year where if you think, you know, new people leave school, they look for jobs, companies look ahead at next year and make their plans. And if they feel nervous about next year, they hire fewer people or they lay people off because they don't need them, start making those kind of announcements. When people come back from vacation, they decide whether they're being really cautious with money or whether they fancy going out and spending more. And, you know, it always feels to me, it's one of the reasons August is a fascinating month and a terrifying month, illiquid and a great guide to where we're going next. I think we'll know more by then. So far, you've got to say the unemployment rate is super low. The employment rate is super high. The economy is not weak. It's just losing a bit of momentum. To the earlier question, I think we need to look at the private payrolls number because we should ignore what's happening a little bit on the public sector. That was just under 140,000 last month, 136,000. That comes in under 100. I think there'll be some fireworks in markets this afternoon. That's probably the place to watch. But this has been an extraordinary cycle. It feels tired to me, but hey, I'd have said the same thing last year. It's been so resilient. So I'll watch the numbers for this month and next month.
Yeah.
And then we'll know.
Kit, does it feel tired because we're tired of it? Or are you looking at the economic data and it signals that this cycle is ultimately tired? Because we've had growth scares like this before. We've had head fakes, particularly in jobless claims. Had one last summer. What's the difference between, say, last August when jobless claims were at these levels and what we're seeing right now?
I think there's certainly less spare post-COVID money floating around for a large hunk of the American population. There's less external drivers of strength. There's nothing that sits there and says it's going to make things accelerate. Other parts of the world are more clearly slowing. So there's a lack of things you can put your finger on that says, yeah, this could be okay. And I think that's probably the single biggest piece. But I'm with you. It said this mad cycle has, you would never have guessed we'd have got this far from 2020 without having had a proper recession. I mean, it's just like how did we manage to keep this plane in the air, in the sky for so long? Yeah, it'd be nice if it keeps on happening. I think it gets tougher each mini cycle to do that.
And Kit, that is what has had people thinking that there's going to be a recession for over the past year plus. But this has been a really good year to fade all of those impulses, to fade six cuts priced in at the start of the year, and then on the other side, to fade no cuts priced in. At the moment, for the next meeting for September, 33 basis points of cuts are priced in, which does imply that we have about even odds for a 50 basis point cut, when we just heard from Powell on Wednesday, who was cool, calm, and collected. Are we not getting ahead of ourselves?
Yes, in a sense, we always are. In other words, do I think we're ahead of ourselves on rate cuts? Something dramatic has to happen for us to get a 50 basis point cut next month, and I mean dramatic. At the moment, this is an economy that's, I don't know what it's doing. It's driving along at 55 miles an hour. It's doing perfectly all right, you just worry about it that it's unlikely to be able to accelerate. It's more likely to slow down. But fading recessions is always the right call until the day they start to happen. I think we'll learn a lot this summer. I'll be fascinated to see if this number comes out, because what we do know is that when momentum slows, it slows quite quickly in most cycles. But right now, if you looked at the state of the US economy, all you can say is inflation's coming under control, the Fed's going to cut rates, and the economy is not weak. It's just trundling along just fine and better than anybody would have thought 18 months ago.
Kit, when you say dramatic, what would that mean in today's payrolls report? What's a dramatic number?
Sub 100 on private sector payrolls. So they were 136 last time. So that puts it in context. If you come in with a number at 120 on overall payrolls, I mean, I think I'm going to try to phase out the public sector employment piece just to keep on going. But you get under 100 on the private sector, you start saying, okay, that's more of a problem. But it has to be something at least like that. Otherwise, this is summer noise and we might just overreact to it because we're in August.
Okay, I just want to jump back to dollar yen just quickly. I think we always want that fat directional move in the FX market, and we had it one way on dollar yen, and we're looking to add to it going the other way. Is this move exhausted? How do you sort of gauge how far this one's gone and whether it's running out of steam?
Okay, if the Fed gets rates most of the way back to where they were before we started in 2020, we'll get back to 100. But you cannot go at this speed because it's the rate of change, it's the change in the value of a currency that affects inflation and affects businesses. So this is hurting the equity market because it's having a really aggressive impact on profitability and on what people do. So we have to pause. We have to pause, perhaps bounce. We can't keep on going at this pace for much longer. If the Fed's cutting, I don't think we can be above 140 next year. If they're cutting a long way because there's a serious slowdown, then yeah, we can go back to 120 and see where we go from there. So there's a long way to go for, but this is very much a function of where US interest rates are, right? This was possibly the biggest carry trade that we've ever seen because the Japanese kept still while the Fed hiked and hiked and hiked and hiked, and everybody else did in the rest of the world. And now if everybody else goes all the way back, we will go a long way. But the appreciation hurts profits, cuts inflation, and so the rate of change is massively important. We need to pause. I'm not sure if we can pause much in the middle of August, for what it's worth.
We'll see what happens over the next month. Kit, appreciate it, sir. Kit Jukes there of SocGen. We have to pause again, and we have to pause to read through one quote from one op-ed from one Wall Street giant in the Washington Post this morning. Jamie Dimon of JP Morgan. Now, people often say, why do we always talk about Jamie Dimon and the prospect of Jamie Dimon going into government? Well, Jamie Dimon himself sort of encouraging that conversation this morning. Check out this quote. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. Anne Maria President should put the most talented people, including those from business and the opposite party, into their cabinet.
This is the most blatant ask to be a part of administration I think I've really ever seen. What is so interesting as well is it's almost like Professor Jamie Dimon. He's talking about the U.S. as an inflection point. He's going back in history, but he keeps saying the next U.S. president, the next U.S. president. Well, whose team are you on? Is it the next U.S. president, Donald Trump, or the next U.S. president, Kamala Harris? What remains to be seen, we don't know who he's pushing for, but what's obvious is that he wants a seat at the table, regardless of who's in the White House.
Well, I wonder if some of the points he's making exclude him from one ticket, because he talks about the need to support our allies, to have diplomacy, trade, and the active promotion of democratic values. I don't know, that seems like one administration would not necessarily want to go that way.
It's quite a column, and I suggest everyone will have a read of that here on Wall Street throughout this morning, including JP Morgan employees. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Here's Yahara Heckes. Hey, Yahara.
Hi, John. Chevron missing second quarter earnings expectations, putting renewed pressure on CEO Mike Wirth as he pursues a $53 billion takeover of Hess. The takeover was agreed to nearly 10 months ago, but has been delayed by an arbitration case brought by arch rival Exxon, which claims to have right of first refusal over Hess's stake in a Guyanese oil development. Chevron also saying it will relocate its headquarters from San Ramon, California to Houston, Texas, with full migration of operations completed over the next 5 years. Chevron shares are falling down more than 2% in the pre-market. Meanwhile, Intel shares are plunging in the pre-market after the chipmaker forecast revenue for the third quarter that missed analyst estimates, along with making a string of disappointing announcements. The company said it would suspend its dividends starting in the fourth quarter, and it will begin slashing 15,000 jobs. And Andy Murray ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multiple Grand Slammer jokingly posted on X that he, quote, never even liked tennis anyway. Murray had said this summer's Olympic Games would be his last event. Over the course of his career, Murray won 2 Olympic gold medals, one in London's 2012 Games and the other in Rio de Janeiro in 2016. He won the U.S. Open once and Wimbledon twice, his first win at the All England Club, making him the first British man to win that trophy in 77 years. What a run. That's your Bloomberg Brief. John?
Yahara, thank you. I'm not sure what it is about this Olympics and making me cry. What is it about?
Same.
Last couple of days.
I credit Simone Biles and I credit Andy Murray too. Not him necessarily losing, but the reception he got afterwards. Everyone gave him a standing ovation. The Americans were clapping for him. It's just really tugging on the heartstrings.
Super emotional. A lot of people cried about the opening ceremony too, but for very different reasons. It's a very different kind of crying. Up next on the program, all eyes on the labour market.
The labor market is not necessarily on the precipice of breaking. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
That conversation up next, live from New York. You're watching Bloomberg TV.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this? What we
we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word: winning. You win on the court, you win off the court. And as you do that, you bring people along.
Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's back. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend, only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything. Get your fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
Payrolls 1 hour and about 41 minutes away. The number we're looking for, the estimate on the headline print, 175. That's the estimate in our survey. Going into it, the scores look like this. We're down another 1 percentage point on the S&P 500. Bonds are still rallying. Yields are lower by 3 or 4 basis points. We rally for a 7th consecutive session. The 10-year, 393.95. Under surveillance this morning, all eyes on the labour market.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum. We've seen non-farm payrolls, yes, with increased volatility, but an average pace of over 200,000 thus far for 2024. That's still indicative of a relatively solid labor market.
So here's the latest, counting down to the July jobs report due at 8:30 Eastern. The median estimate in our survey calling for 175K. Sarah House of Wells Fargo has this to say. We've revised down our call for payrolls to 165. Our previous call was 180. We're incorporating the jobs market data of the last few days. Sarah joins us now for more. Sarah, that's a good place to start. The data of the last few days. What was it about that that was a little bit jarring for you, jarring enough to bring down your forecast?
Yeah, it was really a confluence of the data this week. So it started with the last of the Fed services PMIs, which showed that on average, you saw hiring in the service sector, the index declined about 2.5 points. We saw downward trend in job openings, but really the gross hiring rate back to 2014. You look through later in the week, upward drift in jobless claims, and I really think the cherry on top was that ISM manufacturing and employment print, which I think together points to that the trend in hiring really has downshifted over the past month.
Sarah, what number today, if any, could mean the Fed will cut 50 basis points?
Yeah, so I think it would have to be pretty low. I think certainly below 100,000, maybe even closer to negative. I think it's also going to be important in terms of what was driving that. So to what extent do we see some potential effects from Hurricane Beryl hitting during the survey week? And so I think we'll have to try and strip out part of that. But I think it would take a pretty weak number to at least get the Fed to move 50 basis points at its next meeting, given that you still have some hawks that I think are concerned about the overall inflation backdrop still and making sure that they don't want to ease up too soon and they're okay with a little pain in the labor market.
But for those that are the doves, you get this sense that they worry that the Fed's behind the curve and they'll need to cut a lot in order to catch up with where the labor market is going. Michael Hartnett of Bank of America hits on this, that people underestimate how much lower rates need to go to stimulate a weak economy. Sarah, if some 500 basis points of hikes on the way up didn't act that quickly to bring inflation in, what's to say what's needed on the downside to make sure this labor market doesn't deteriorate further?
Well, I think that the Fed will, they do have a lot of ammunition, I think to stimulate the economy. And in many ways, there were so many unique circumstances around this pandemic that I think kept growth strong and made it take a while for inflation to come down. So, of course, the supply shortages impacting inflation, but also as they recovered, helping the growth picture as well. But I think as we get back to a more normal environment, that you could see the impact impact of rate cuts, I think maybe taking on a more traditional role. But I think ultimately the Fed needs to get going soon, just given that we have seen, I think, some market deterioration in the jobs market the past year.
If the Fed needs to get going soon, you think we've already seen the market deterioration. Do you think they've already made a mistake?
So I think it's still a little bit too early to tell, but I think, again, given that you have seen some pretty unique circumstances, and it is hard to parse out just how much of the slowdown over the past year has been this idea of normalization versus outright deterioration. So I think right now it's still more a matter of normalization, but given that negative momentum that we continue to see in the jobs market, something has to change to arrest that, and I think that change is a policy change here soon.
Sarah, I just got a message from a Bloomberg Terminal subscriber. They'd like us to ask you about Hurricane Beryl and the kind of impact we might see in this particular jobs print. How are you framing that? What kind of number will that subtract by from the overall number?
Yeah, so I think it'll have at least some impact, not looking for a huge impact. So if you look, for example, back when you had Hurricane Harvey and Hurricane Irma hitting in 2017, you actually saw a negative payroll print initially. But those were much larger storms, I think, that you saw impacting across the entire survey period. So the hurricane hit in the second week of the month. And so potentially you could see workers who were maybe out following the hurricane were still on the payrolls during the first part. So we're not looking for as big of impact, given that some workers are still going to get paid even in the impacted area.
Got it. Sarah, thank you. Sarah House there of Wells Fargo looking for 165 at 8:30 Eastern. That was down from 180, their previous estimate. The consensus call, the median estimate in our survey is 175. Is the mistake trade already building in the last 24 hours? At 8:31, and I said this on Wednesday after the Fed decision, at 8:31, we're going to have a very different conversation. Either it's going to be one, yes, growth scare, mistake trade on, or the other, things settle down and we all get a nice weekend.
And so much of that just might hinge on what the unemployment number is, just because of this hyper focus on it. I know 4.28% is what triggers the SOM roll. You can argue whether it's important or not, but just so much has been baked into this, so much anticipation of a slowdown. If you get a whiff of that, if you get even close to that, you have the feeling that this is a bond market that's ready to run away with it, and an equity market that's changed to bad news is bad news and will sell off alongside it.
Well, I think that's what Sarah's waiting for, to find out exactly what that unemployment rate might be. Does that mean outright deterioration versus what many think right now potentially is normalization? It's a big debate.
You know, Jeff Rosenberg of BlackRock went against the grain on Wednesday after the Fed decision, and we're going to catch up with him a little bit later after the jobs number drops. And he thinks the biggest risk today is that actually you get a blowout jobs number. Real strength. We'll see. We'll catch up with Jeff shortly after the number drops at 8:30 Eastern Time. We'll catch up with Mohammed Al-Erin next on the programme of Queen's College, Cambridge. He's going to be with us through the next 2 hours from 7 Eastern through to 9 o'clock. We'll be speaking to Priya Misra of JP Morgan, Ed Mills of Raymond James, Nita Richardson of ADP, and we have to say thank you to Danny Berger. Thank you, Danny.
It's a pleasure.
It's good to see you. Quite a session.
Sticking around, I'm going to read some news for you.
Okay, good. We'll get your thoughts on a payrolls report a little bit later as well. Why not? Why not? From New York City this morning, good morning. It is Payrolls Friday. The number we're looking for is 175. A bit of a growth scare brewing over the last 24 hours following ISM manufacturing and jobless claims, both of which moving in the wrong direction. Equities lower. We're down 1 full percentage point on the S&P from New York. Good morning.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
What prompted you to want to get out of just doing surgery to be an administrator and a hospital leader?
Watching others who did it well. I had a dean who recruited me from Birmingham, Alabama to Minneapolis, Minnesota, which is a big jump to convince me to move my family. I realized over time that my training as a surgeon brought a set of credible things to the table. One, if surgeons have a measure of emotional intelligence, not much of our training reinforces that. It reinforces skill, not necessarily emotional intelligence. But if a surgeon has some self-awareness and emotional intelligence, what they bring to the table of leadership are three fundamental things. Number one, they do everything in teams. Their operations, their patients they see is all team focused. Number two, they value process, but they hold themselves very much accountable to execution. They understand that it's good to explore a patient, but what really matters is that you take the tumor out. And then number three, they make difficult decisions on incomplete information. Those things I realized that I could bring to the table as a leader if I had a sort of a passion for working with people and had some sense of self-awareness.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
The labor market is showing some weakening. It's had considerable cooling taking place.
The labor market is not necessarily on the precipice of breaking. We have seen a loss of momentum, but we're still talking about a circa 4% unemployment rate.
I don't know if unemployment is going to stay there or not. It often moves up slowly and then moves up rapidly.
We think unemployment probably ends around where it is now. The labor markets are normalizing.
Labor market renormalization should not be mistaken for any labor market weakness.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
90 minutes away from the payrolls report, the second hour of Bloomberg Surveillance starts right now. Let's start with the price action, and then we can turn to the estimates. The price action, negative. It continues on the S&P 500. We're down across the board, down by more than 1 full percentage point on the S&P. On the NASDAQ, down by 1.6. On the Russell, the small caps, down by 1.9. In the bond market, the rally continues for a 7th consecutive session. Yields lower over that period by more than 30 basis points on a 10-year maturity. The 2-year dropped 50 in the month of July alone. That move continues. Yields lower at the front end by 3 basis points, 4.12 on 10 to break of 4% in the last 24 hours. Your 10-year, 3.94. I promise you the estimates, so here they are. Going into payrolls, just around the corner. 175 is the median estimate in our survey. On unemployment, 4.1%. The question, particularly after the weakness of yesterday, ISM manufacturing, jobless claims, is this a head fake or the real deal? With us around the table, the real deal, Mohammed Al-Aaron of Queen's College, Cambridge, with us for the next 2 hours alongside Anne-Marie. I'm Jonathan Ferro. Mohammed, we've got to go to you first. Head fake or the real deal? What is this?
I think the U.S. economy is slowing faster and in a broader sense than most people anticipated, including the Fed. And I think that the market is catching up to that possibility, which has become a probability.
So I've said repeatedly, I've asked repeatedly, welcome cooling or unwelcome deterioration. Is this starting to sound more like the latter than the former?
It is the latter. There's no need for us to have an excessive slowing in the economy. This remains quite a robust economy, and if we do get it, it is because the Fed was late in recognizing that the economy is slowing.
Now there's a debate if the Fed needs to cut deeper when they go in September. Do you think that they should, in September, go to 50 basis points instead of 25?
I think if they go to, I'm laughing because so many people now are starting to say 50 basis points. To start with a 50 basis points cut means you've made a policy mistake. And this is the Fed that surprised a lot of people by having to hike 4 times in a row by 75 basis points. So they were late starting, and if they cut by 50, they will signal that they're late starting to cut. I think it would be a mistake to cut by 50, but the fact that some people are talking about it, I think, is where the information content is right now.
We've got lots of time with you this morning. You'll be with us through the 7 o'clock hour into the 8 o'clock. We'll go through the jobs number together. I just want to sit on what I think has been the biggest piece of your call, which is listen to corporate America. It worked the first time. It seems to be working the second time. What did you make of the tone of that news conference with Chairman Powell early this week, where he appeared to dismiss any evidence, any signs of weakness?
So I think he was trying to strike that delicate balance, first explaining why it is they didn't cut, but signaling that they're likely to cut. And he on the whole, actually, he struck it quite well. He did come across more dovish than the statement, and you saw the market react in that way yet again, and that is his habit of coming across more dovish. But I understand, you know, it's not like the Bank of England. The Bank of England is very clear. 5 people voted for, 4 people voted against.
Yeah.
You know it's very... He responded by saying, oh, no, it's really good that everybody votes the same way. Actually, it's not good that everybody votes the same way because you don't get a sense of how difficult this judgment call is.
I wonder if we get a sense of that in these speeches over the next few weeks from Fed officials. Mohammed's going to stick with us. You'll line up for the next hour. Priya Misra of JP Morgan. As weak data spooks bond investors in the last 24 hours, we'll catch up with Ed Mills of Raymond James as Kamala Harris prepares for a swing state tour. And we'll catch up with Nita Richardson of ADP, looking ahead to the jobs number. We begin with our top story, weak data fueling a bond market rally going into the latest US payrolls report. Priya Misra of JP Morgan writing this: given recent data, all markets are getting a little nervous about a recession, and I think we'll react more to a downside surprise. The labour market is softening, and we are all focused on whether it is slowing to trend or below. Priya joins us now for more. Priya, it's good to see you. Let's get this conversation started. We've got a lot of work to do. We've had a massive rally in the bond market. What's the limit of this rally, given the move we've already seen at the front end of the curve on a 2-year and further along the curve on a 10-year?
So I think if the soft landing persists, I mean, we've talked about how narrow that path is. I think it got narrower in the last few weeks. But if we remain in the soft landing, I think rates are pretty fairly priced. I mean, the 10-year, 375, 4.25. We were kind of right.
As at 7:15 a.m. Eastern Time, we do see a Bank of England's chief economist Pill briefing the central bank's regional agents after the latest rates decision.
50 or not. Look at the end point. We're priced for 3.2. That, to me, is a soft landing terminal rate. If the economy slows down and the Fed realizes, well, maybe they should have cut earlier, they need to cut faster, they're going to cut a lot below that. So I think then you're talking about the 10-year getting closer to 3%. I don't think we're there yet. So which is why the data over the, I mean, end of cycle data is always difficult. You're getting mixed signals. You have to, figure out the signal from the noise. But if the economy starts to weaken, bond yields are going a lot lower, particularly in that front end, because we should start to price in the Fed taking rates into not just neutral rate, but sort of into accommodative territory.
Priya, you just mentioned that the balance of risk for the employment report coming up is that it's even weaker than what people anticipated. There's the other view, look how much bond yields have moved. The balance of risk is the other way around. The technicals now have changed completely in the market. So how do you judge the balance of risk for today's numbers?
So I agree, we've had a really big move this week. So if you get a 200, 250, I think we should also debate what is break even. Back in the day, we would think 100,000 was break even. I would argue it's closer to 200,000. So if you get a 300,000 payroll number, absolutely, I think rates can rise. We can give back some of the move this week. But here's the thing. We're debating whether the labor market is slowing to trend or it is slowing. Unequivocally, the economy is slowing. The labor market is slowing. So we're not talking about rate hikes. So I think it limits how high the 10-year can go, how high the front end can go. The Fed is getting ready to cut rates. I think it's a series of cuts because here's what's fascinating. The Fed, Chair Powell has said it multiple times, the labor market is back to where it was pre-pandemic. Look at where monetary policy is significantly restrictive. So I would argue, even if, let's say the economy is not slowing that much and we stay in the soft landing, the Fed has a lot of room to get rates to neutral. Maybe it's 3, maybe it's 3.5. It's not 5.5. So I think it's still somewhat asymmetric.
So how quickly should they be going there? Are you in the 50 basis point cuts in September?
So I would like the Fed to cut 50, start the process. Look at the starting point. I don't think they're going to get there because it's going to spook the market. What does the Fed know that we don't know? So I think they start 25, but I think we should take them at their word. Things slow down more. The unemployment rate rises to 4.5. I think they speed up. Just like the hiking cycle, remember, was not a series of 25, as you said, 25, 50, and then a series of 75s. You might have the cutting cycle, and I think the cutting cycle is going to look very similar, where they start slow, and then if things worsen, they're going to really crank it up.
So that means September, November, and December.
I don't understand the let's go really slowly. If the economy is back to normal, get monetary policy to normal quickly. And I think the market's starting to price that in. What we've done is we haven't taken down, the market has not taken out terminal rate estimates that much. They've moved the cuts into 24 and 25. That makes sense. If you want to normalize policy, go every meeting, go 25 every meeting, and that gives you the option that if things start to slow down, you can really, start to accelerate.
You write the market will react to a number below 150,000. We had Kit Juke, Sarah House on the last hour. They said below 100,000 would really be a dramatic market move. What do you think would be so low that really starts to unnerve the Fed and maybe we would see a bigger cut in September?
I think below 100 will do it. And it's the totality of data. So we've got the claims number. It's the best high-frequency measure of the labor market. It's been inching up. So if that continues, I think you could start to think the Fed. And again, the Fed can try and finesse the message by saying we're at 5.5. So we're not panicking. We're not going to zero. But we're just normalizing. The 50 is just the start of normalization. We know monetary policy works with a lag. I mean, that's the one thing we've all learned. We've lived through the lags, these long and variable lags. But I think, if you get a below 100, Joel's continuing to fall, ISM services, that ISM manufacturing was scary. If services is also that weak, I think then that 50 talk just gets a lot louder.
What was scary about it? What component of it really spooked you yesterday?
I think new orders, employment. We know manufacturing is weak, and that's why I'm waiting really for services, because the economy is not really a manufacturing economy, but it tends to be, ISM manufacturing tends to be more cyclical, tends to lead the move. So the broad-based slowdown and, at cycle lows, you start to worry, is that a leading indicator? And we've been getting a bunch. Here's why you don't want to overreact, because you look.
So it's less than 5 minutes away now till we get our comments from Bank of England's Pill speaking.
Healthy. So, which is why I think we're still in a soft landing. But soft landings are all about risk management, and the risk management now, I think, argues for hedge that downside.
So help me understand. 2 to 3 weeks ago, the narrative was they have plenty of time, the economy is fine. Of course, they won't cut in July. Now suddenly, they should have cut in July, they could do 50 in September. What has changed? What is it that has made this narrative change so radically?
So markets do tend to overdo things, and maybe there's an element of that here. But I will say, if you look at the inflation data, we've seen very welcome slowing. The only thing that's high is really shelter. And you look at the totality of data, the one thing that was holding all this up was the job market. That's showing signs of slowing. Again, I think we don't know enough whether it's slowing to just, are we going to normalize? And that's the big question we're all facing. Is this normalization? Chair Powell said it many times. I think he hopes, we all hope this is normalization. But labor market slowdowns are often non-linear. So if the unemployment rate starts to rise, does it just rise a lot faster? And then what does a 25 basis point cut do? I think that's why the market, and I'm hoping they can be a little fast, get to some sort of normal level, neutral, whatever that is, and then they can respond better. At least reduce the level of restrictiveness. We have very restrictive policy right now.
Let's get to the calendar. August 2nd today, jobs report. August 14th, CPI report. September 6th, first Friday of that month, we'll get a jobs report. September 11th, we get a CPI report. September 18th is a Fed decision. And that Fed decision is not just about interest rates or the news conference, it's about new projections. And you talked about finessing the message. They've got to finesse the forecast, don't they? The unemployment rate they've got for year-end for 2024 is 4%. The unemployment rate they've got for year-end 2025 is 4.2. And there are some people think we might be there today in about an hour and 20 minutes. Now, I wonder what that looks like in September. What does that get revised to?
I think the projections are a function of appropriate monetary policy. So we should look at the dots along with the projections. They might keep the projections at 4.2 and just speed up the rate cuts. Because if they think that monetary policy will work, they can cut rates and keep us in the soft landing. And so you may not have a big increase in the unemployment rate. What would worry me a lot is if they have an increase in the unemployment rate and they don't have a lot more cuts. That means they're telling you they're okay with a slowdown. I mean, that's not what Chair Powell's saying. So I do think they're going to hope that they can cut in order to keep us there. But that's the big question. Are we less interest rate sensitive today? And I would argue we are. And we need time for interest rates to work. So if they don't start fast, that unemployment rate's going up.
Pause. You think even if they do start cutting, it's not going to be enough to slow this down?
It's tricky. I think we don't know. But we should think about the scenario where they cut even 50s at 5.5. If they're cutting 50 a quarter, or even, I think 50 a meeting, you might just about get there. Stop QT. It's odd that they're also doing QT on the other side. That's tightening monetary policy. They need to ease, unless you get big fiscal easing, and that's the other, we're on a knife edge right now. The economy, the elections. So there's a lot of unknowns, but I think we should be looking at the outcome where you don't get any more fiscal easing and monetary policy is adjusting too slowly.
Priya, it's great to catch up with you. Priya Misra of JP Morgan. Mohammed, on the money as always. How quickly this conversation has changed in a couple of months?
I'm stunned. I'm absolutely stunned how quickly it has changed. And a lot of what you said, Priya, we knew. We knew that monetary policy adds with a lag. We knew all this stuff, but it's amazing how the market has gone from
Socialists than a minute away now, as we can expect to hear comments from Bank of England. Pill speaking.
Really bad for credit and
That's a
risk.
major change as well in this conversation. This bond rally continues. Equities are still selling off. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. ExxonMobil reported earnings that beat expectations. Shares just up 0.7%. The company's acquisition of Pioneer Natural Resources pushed oil and nat gas output to a record. It does provide assurance to investors that Exxon is well placed to push through its planned 15% ramp up in share buybacks that would put it to $20 billion a year. Exxon is the best performing major oil stock so far this year. Now, Politico is reporting that chip maker NVIDIA is facing antitrust investigations. The probe is focused on the company's business practices and the acquisition of a startup called Run AI. Run AI helps users do more processing with fewer chips. Regulators, though, want to know if NVIDIA is just simply buying the company in order to bury it. Both the DOJ and Run AI did not comment when asked by Politico. And JP Morgan CEO Jamie Dimon writing in a Washington Post op-ed that the private sector should, quote, have a seat at the table in a future presidential cabinet. Dimon writing, a president should put the most talented people, including those from business and the opposition party, into their cabinet. The editorial leads with the call for, quote, strong American leadership to bolster U.S. influence and strength, saying the country is at an inflection point and that could determine the fate of free and democratic nations for decades. And that's your brief. John.
Danny, thank you. That's the sound of Priya running out of the room with no comment. Up next, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. Even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
The conversation's up next, live from New York City. Good morning.
In global leadership are on Bloomberg.
Japan has made
changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
Well, the real-time data aspect is going to be important.
We're going to bring you expert analysis on that.
Don't miss Bloomberg's interview with the
If you are just tuning in, welcome to the program. Pulling back a little bit on the S&P 500. I say a little bit because we've got used to these kind of moves in the last 24 hours, haven't we? We're down by 1.2% on the S&P. The rally continues in the bond market. Yields are lower by 4 basis points. A break of 4% yesterday. 493.57 on a 10-year going into payrolls later this morning. Under surveillance this morning, new dynamics in play for November.
The common theme, in my view, is this sort of populism that has taken on a very nationalistic fervor. And our country is not immune from that either. I look at the left, and they have always been about populism versus business and Main Street. We're going to be set up in the Republican Party for a real debate now going forward. There is no incumbent running. So even if the other side, if Kamala Harris were to win, she's not Joe Biden. So let's see what that means.
Here's the latest. The Harris campaign announcing a record-breaking fundraising haul of $310 million in July. That's more than double the nearly $140 million that Donald Trump's campaign pulled in. Ed Mills of Raymond James has this to say. Harris's campaign launch arguably could not have gone better for her, but we're on the cusp of her first major governing decisions with her selection of a vice president. Ed joins us now for more. Ed, we've got some time this morning to go through the VP stuff. I want to start with this column in a Washington Post this morning. I'm sure you've seen it, Ed. It's from Jamie Dimon of JP Morgan. I'll share the quote with you so our audience who are just joining us can see it as well. The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table. Yet in recent years, government leaders have often failed to engage those in industry. A president should put the most talented people, including those from business and the opposite party, into their cabinet. Ed Mills, is that wishful thinking from the CEO of JP Morgan?
Well, John, I think it depends on who wins. I think there has been a frustration in D.C. I've talked to a number of folks within the financial services industry where they feel as if experience within industry is actually something that makes it almost impossible to get Senate confirmation on any position that requires to go through the Senate Banking Committee where Elizabeth Warren serves. I do think that Jamie Dimon is setting up to possibly be a Treasury Secretary in a Trump administration. And one of the big debates that I've had with clients at Raymond James is if Trump wins, will there be people that join his cabinet, join his administration that the market likes, like we saw back in 2016? And I think op-eds like the one this morning, John, say the answer is most likely yes. And I do think, to former Majority Leader Cantor's point, Kamala Harris is very different from Joe Biden on a lot of things. And personnel equals policy. I do think she would be more open to certain individuals serving in the administration. A big debate over does FTC Chair Lena Khan stay? Her term expires in September, or would she put in someone that is more tech-friendly, given the fact that she's the former senator from California and has strong ties within the tech industry?
Ed, why do you think it's a Treasury Secretary position under Trump? He doesn't mention Trump or Harris in this op-ed. And we've seen this individual talk badly about Trump openly, but also give him credit when credit is due.
So seeing here according to sources, oil loadings from Russia's western ports are seen at 1.95 million barrels per day in August, 1.8 million barrels per day in July.
In Davos, where he seemed to open up this opportunity when we've gone through possible list of Treasury secretaries. We put him on the list in the Trump election. I would not have put him on the list in a Biden re-election. I think it's a maybe should Harris win. So, Anne-Marie, it's an important point. I just think that given some of the comments that he's made, it's slightly more likely. And talking about having someone from the other team, Dimon is viewed kind of in D.C. as a Democrat. So the other team would be the Republican Party.
Based on the comments we've seen from him repeatedly, I think he'd say the team he's on is the United States. And that's the point he's trying to make in the piece this morning. Ed, the difficulty I have with the Vice President, and I think a lot of people do, and it's still early days, and we'll find out more about her position on a range of things. Ed, it's difficult to understand what she actually stands for, what the policy platform will be, because as far as we understand at the moment, there's been some distance created between her and the sitting president, some distance created between her and her views back in 2019 when she was running for 2020. What's your understanding of what this policy platform might look like?
Yeah, John, so first and foremost, I think it's easy for her to say that this is a continuation of the Biden-Harris administration, should she win. And the Biden administration would point to the different successes that they've had on the Inflation Reduction Act, the bipartisan infrastructure bill, and what Biden was trying to make as a campaign promise for his second term is the full implementation of those. So that's where we start. But you are right. She was only in the Senate for a relatively short period of time compared to what we've had for other candidates. With Donald Trump, we've had him as president for 4 years, so we have a much greater understanding. When we go back to her time as Attorney General of California, what stands out the most is her settlement with 50 attorneys general on a foreclosure settlement against the largest banks in this country. But besides that, it's a lot of things that are popular within the Democratic base. She has led on reproductive rights. But in politics, what I've always said is that when you're explaining, you're losing. So right now, she is in a honeymoon period of her campaign to go out there and launch that 10-point plan, to go through kind of the details. They think that that gets her into the explaining part of the conversation. They'd rather have the honeymoon last as long as possible. So the fewer policy details you give today, the easier it is for the honeymoon to continue, versus really going through this conversation as to why did the comments about fracking or Medicare for all back in 2020 could be so different than today. Well, a lot of that's because states like Pennsylvania are probably the tipping state, and it makes it much harder to win in swing states, win in states that have a lot of fracking, if you keep those former positions. So just allow the kind of independent validators to make your case and step back and see how long it can be until you have to take some of these positions.
Ed Mills of Raymond James. Ed, thank you. Appreciate the update. Mohammed, you've been following this conversation. You've been following the news over the last few weeks. What do you make of all of this? What's your view of things currently?
So I think that the Vice President's campaign is gaining traction much faster than anybody anticipated. Ed didn't mention the $310 million in July that she raised. That's a lot of money, and that's quite a reaction from the base. So suddenly we've got a really interesting race going on.
I've heard this phrase repeatedly, Anne-Marie. Honeymoon, VP pick, honeymoon continues. Keep going to these campaign rallies, big audiences, drum up all that enthusiasm. And then we get to the explanation, the explaining, as we get closer and closer to the DNC.
The DNC obviously is going to be this celebration. They're going to have a ticket, and then the real election starts. You really will have, she'll have to sit down, she'll have to answer in an interview policy questions. If she wants to win Pennsylvania, she needs to decide whether or not she wants to ban fracking or not, because that's going to be replayed constantly on Trump ads.
I go back to what Libby Cantrell told us all, good friend of all of ours. Get a cocktail, go to the beach, and come back on Labor Day. After Labor Day, all right? And then we'll talk about politics. From New York, this is Bloomberg.
season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
DOJ or other authorities.
Could face bigger challenges next.
It was going to keep Rain World Cup. This is a three.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg.
So if you thought July was exhausting, welcome to August. Here we go. Check this out. Down by more than 1% across the board. On the S&P 500, negative by 1.2. On the NASDAQ 100, down by 1.7. On the Russell, the small caps, up 10% in July, down 2% this morning. We are heading towards a third week of losses on the S&P 500 unless we get a turnaround sparked potentially by a payrolls report dropping in about 60 minutes' time. Switch on the board, turn a page, and let's get into the bond market. We'll sit on a 2-year and a 10-year. Let's start with a 2-year, down to 4.1%. We're down 4 basis points. We were down 50 in July. We add to that move. We drop 4 on a 10-year, 7 consecutive sessions. This maturity has been rallying. Over that period, that yield has dropped by more than 30 basis points. We're down 5 this morning to 392.81 after breaking through 4% for the first time since spring of this year. I want to turn to foreign exchange. As yields drop, we've engineered this massive unlocking of yen strength, promoted and endorsed and encouraged by what we heard from the BOJ earlier this week as well. We're through 150, we're down to 148.93, we're down about a third of 1%. Dollar yen down for a 5th consecutive week. That is another week of yen strength, and that has unlocked some real weakness in the Japanese equity market. Take a look at the topics, the Nikkei 225, pick your poison. It's all poison. Over the last 2 days, we're down hard by something like 8% on the Nikkei 225. Mohammed, we're down by almost 6% in today's session. What do you make of what's developing, not just in the United States, but worldwide in places like Japan? Because it hasn't just been a US market move, it's been global.
Yeah, but I think Japan is an outlier, and that's why you're seeing the much bigger move, because the equity market there is having to cope both with a weaker currency, with a stronger currency, and higher rates. And these two things are adding or amplifying the pressure that's coming from outside. Ironically, that's what they needed to do. They really did need to normalize faster, and we got that message clearly this week when the governor said that a weak currency is problematic for inflation, and he sees no limit, no ceiling to that. So it doesn't surprise me. They are doing something they should have done earlier, which is normalize at a faster rate.
Based on the guidance we got from Governor Ueda, it looks like the bar to go again is pretty low, looking for another rate hike. We spent a number of months this year talking about the prospect of central bank divergence, and at the time we were talking about the ECB versus the Federal Reserve. I'm wondering more now about the BOJ versus the Federal Reserve, real pure divergence. How far do you think that could extend?
I think in that case it could extend quite far. What I think cannot extend that far is between the Fed and the ECB, the Fed and the Bank of England. That trades in a similar world. But with Japan, divergence could extend quite far.
Dollar yen right now, 148.97. We're negative on that currency pair by about 1/4% or so. That's the price action. I just want to turn to some top stories for you. When the surveillance this morning, let's start with this one. President Biden vowing more US support to Israel. This coming as Israel faces fresh threats following the assassinations of Hamas and Hezbollah leaders. At the same time, Biden pressing Netanyahu to move forward with ceasefire efforts. How much progress are we going to see in the next few days?
Well, I think what is interesting is you see Biden really leaning into foreign policy issues right now. He is a lame dunk president. If he's going to have any legacy in the next few months, it's going to be to try to shore up some of these deals, try to put a bow on some of these negotiations he's been working on. What I find interesting is this comes after Ismail Haniyeh was assassinated. So Biden also said when he was briefing reporters that Israel should take this deal, they should move on it fast. He said that it hasn't helped that this individual was assassinated. So potentially got on the phone with Netanyahu to say, yes, we're going to send you more material, but what you did actually didn't help in these negotiations. Also, what I find interesting, the end of May, Biden came out with this ceasefire proposal, and I looked up the text this morning because he's saying Israel should move on it. Biden presented the ceasefire proposal at the end of May saying Israel has now offered. Israel has offered a comprehensive new proposal. Well, which is it? Is the United States pressuring Israel to take this proposal, or was it the end of May Biden saying this was Israel's proposal that they've outlined this 3 steps?
Kamala Harris is not exactly known for her foreign policy expertise. How closely is she going to be aligned with the president in the coming days on this issue, the coming weeks, the coming months for the rest of this campaign?
If he gets a ceasefire negotiation, she's going to want to bask in that, and that's going to be very helpful when it comes to young voters and progressives. But you have seen her try to take a slightly different tone when it comes to Netanyahu, and that's obviously especially important with Democratic politics heading into November. And you saw last week she had a separate meeting with Benjamin Netanyahu. So Netanyahu comes here and he has 3 different meetings: Biden, Harris, and Trump, because November 6th, it does not unclear who he's going to get, but he still needs to deal with the sitting president at the moment.
I think we're all trying to figure that out, that's for sure. I want to turn to China and talk about Apple. So Apple's seeing some poor sales in China, despite a generally upbeat earnings report from one of the biggest companies on the planet. The company predicting that its new AI features will spur iPhone upgrades in coming months. It's a different story for Intel, the company delivering a grim growth forecast and plans to slash 15,000 jobs. Mohammed, let's start with Apple and the weakness in China. They would attribute this to the FX market and the strong US dollar, and perhaps we can run with that argument. But we've seen this repeatedly in China over the last few weeks from corporate America, and I would say from corporations worldwide. What can they do to address this weakness? Because what we hear, particularly over the last week or so, is that they've got some room to move on the fiscal side, but they want to wait to see what happens in the election before they do it. They want to keep that dry powder for 2025. What's your interpretation of what's developing there?
So unfortunately, China is going back to its old game of trying to use the global markets to turbocharge their own growth. And we see this in exports, we see this in the currency. What they need to do, and I think they know that, is they need fundamental reforms. And they understand what sort of reforms they need. They need to develop new engines of growth. And right now, they do not want to suffer the consequences of structural reforms. And what are the consequences? The benefits are long-term, the costs are upfront. So what you're seeing them is going back to some old place. Look, China is going to be slower for longer. People, I don't think, fully realize this. Apple has an extra disadvantage. It's an American company. So you are looking at 2 headwinds for American companies. One is from the economy, and 2 is from the fact that China is slowly diversifying away from American companies. The Chinese consumer is diversifying away.
That's the important point here. The Chinese consumer is backing away. Is that a trend that you think has legs? Is that going to be difficult for American companies that are ultimately looking at China, have a big presence there, and are looking to sell to that Chinese consumer?
I think any American company that's not putting this into its growth projections is making a mistake. Yes, that's going to be around for a while.
That's corporate America. Can we talk about companies that have to engage, countries that have to engage on this issue as well? I remember an opinion column you wrote maybe a number of years ago, and you talked about the fence sitters, the countries that wanted the security blanket from America and at the same time wanted to have that presence in China. How sustainable is fence sitting in the world that we're going into now?
So it depends who you are. If you're India, if you're Brazil, if you're Saudi Arabia, if you're the United Arab Emirates, fence sitting is sustainable. You can play both sides. Why? You've got something special. If you're New Zealand, Australia, Singapore, Mexico, fence sitting is not a sustainable approach. And then you've got a third category that we never talk about, is that countries that are going to be left out completely. Think of some countries in Africa. So what you're going to see is the middle powers, some of them being able to fence sit. A second category will be forced to make a choice at some point. And then a third category that get the worth of both sides.
What about a fence sitter like Germany? pressured by the United States. Are they a fence sitter? They're pressured by the United States to put up the walls, yet they're desperate to be in the Chinese market.
Yeah, I don't think they're going to be a fence sitter long term. And Italy is another example where the Prime Minister is trying to fence sit. I think ultimately Europe is going to align on national security rather than economic.
Interesting. That's the latest on China and Europe. Let's turn to this. I want to get to Amazon earnings and the latest from big tech, delivering some disappointing results, telling investors that profits for now will take a backseat to heavy AI spending. The company also providing conservative revenue guidance for the third quarter as well. This was a line that came from the CFO. We're seeing a lot of the same consumer trends that we've been talking about for the last year. Consumers being careful with their spend, trading down, looking for deals. Poonam Goyal of Bloomberg Intelligence joins us now for more. Poonam, we have heard this repeatedly. And Mohammed Alarin, who's with us around the table, has talked about this repeatedly as well. P&G, slower price increases. Kimberly-Clark, slower price increases. Pepsi, consumers more challenged. Internationally, Nestle, value-seeking behavior. Poonam, how is Amazon dealing with that at the moment?
You know, Amazon's focused on price, so you're absolutely right. The consumer remains selective. They're trading down, and they're playing for value. And in that instance, Amazon has to discount more. And we saw that over Prime Day just recently. And we expect them to continue to push the pedal on price, which is in part of the reasons for their weaker operating margin guidance for the third quarter.
Poonam, I want to focus a little bit on all the investments that we're hearing about. And what that does to the structure of the industry. So if the big ones, if the mega companies are investing so much money, what happens to the belly of the curve? What happens to the mid-sized companies that are trying to establish a footing here?
I think, you know, the bigger you are, the more power you have to invest, the more capital you have. So you're going to grow faster. When it comes to the smaller, the middle companies, I think they're going to have to find a way to lease some of this infrastructure, some of this technology investments, because they don't have the capital to invest like an Amazon or even a Walmart. And I think they will be challenged, and we're seeing that already.
Yeah, so just seeing here, Exxon's CEO says he sees very healthy oil demand.
Technology and AI, many of the other retailers that I follow, they're nowhere near that today.
Also further saying that the global oil supply is keeping the crude prices healthy.
Small pockets of opportunity.
So what do you tell people in Washington that are concerned about consumer protection, that are concerned about competition, that are seeing a natural tendency for the big to get bigger and the smaller to get squeezed?
I think they have to, you know, figure out the big can't get bigger through acquisitions anymore. It's very hard for an Amazon to buy something today. So the growth is all organic. That said, you know, will there be pressure from Washington on allowing companies like Temu and Shein, which are creating this added pressure, especially on the consumer side, right? With these rock bottom prices, it's really challenging everyone, not just the big, but also the mid and the small sized businesses, because you can't compete with those prices unless you're big and you can afford to take the loss.
The Amazon CEO, speaking to investors, said that it's a pretty tough experience with how much is locked behind cabinets. Currently, he's talking about U.S. drugstores. We have to press a button to get somebody to come out and open the cabinets for you, and shoplifting going on in the store. How much are the issues that Americans face at drugstores actually benefiting Amazon right now?
So Amazon benefits largely from convenience. And yes, it is a little uncomfortable to, you know, have to go into a store and have to ask someone to open up these cabinets. It's not the best shopping experience. And we are seeing that shift to online really help with that. But that said, it depends on when you need it and how you need it, especially when you're at a drugstore. If you need your medicine in the next 30 minutes, in the next hour, you're going to walk into a CVS or somewhere else. But if you can wait a day, then you can go to Amazon and have it fulfilled, or to any other online retailer.
The retail experience with some of these companies, Anne-Marie, dead on. It's awful. You don't want to go in there. Why would you?
And the CEO is saying the combination of what's happening in the physical real world and how much progress Amazon is making in their e-commerce pharmacy is helping them tremendously, because people don't want to wait around 10 minutes and then have the sales attendant hover over you while I decide which deodorant to buy.
To Poonam's point, you know, you get out the phone, order the toothpaste, put it back down and walk away. Do I want to go into name your franchise, whatever it might be, and get them to unlock the thing to get the toothpaste out? Who wants to do that anymore? It's ridiculous.
Not when you have the convenience of Amazon. A lot of people aren't, and they're stealing their market share.
big time. I mean, literally, stealing. Poonam Goyal at Bloomberg Intelligence. Poonam, thank you. Appreciate it. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Speaking of not wanting to shop in physical stores, DoorDash shares are up 9.5% pre-market. They reported a stronger than expected profit forecast for the current quarter, and that defied the consumer slump elsewhere. Analysts praised its resilient demand and growth from categories beyond restaurant orders. It expanded its marketplace to include items, again, like grocery, beauty, home improvement, and sporting goods. Now, there's a bit of bad news for bankers in London. Say goodbye to your business class flights. According to Bloomberg reporting, travel is the latest target for UK lenders trying to cut costs. As Standard Chartered, employees now must fly economy for flights under 5 hours. At Lloyd's, they're being told to take public transportation instead of taxis. And at HSBC, employees can only book work travel if they've set up at least 3 meetings a day for that trip. And Andy Murray has ended his tennis career with a quarterfinals defeat in men's doubles at the Olympics. The multi-Grand Slammer jokingly posted on X that he, quote, never liked tennis anyway. Murray had said his summer's Olympic game would be his last event. Over the course of Murray's career, he won 2 gold medals and the U.S. Open once. He won Wimbledon in 2013 and 2016, the first of which made him the first British man to do so in 77 years. And that's your brief, John.
You did all you did. Danny, thank you. Appreciate it. If the stuff's free, can you just walk out with it yourself? We should do a package on this. I'll do the camera work. You can go into, say, a CVS. And we'll see how much you can get away with.
And just, yeah,
and then go to a Lululemon. Because this takes place at Lulu all the time as well. I see the same thing.
Why are you behind the camera and I'm the thief?
You're going to be, you want me to be the thief and you can be the
just
camera
in case.
person. All right, now I was just going to make the package for you. It's going to do the hard work.
I'm staying out of this.
You probably don't want to get involved in this. I'm not sure management wants us to do it either. Up next on the programme, the data in a driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way.
That conversation just around the corner. The jobs report 45 minutes away from New York. This is Bloomberg.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. And you know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal. The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? What are y'all's in trouble?
Wow.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering.
We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Counting you down to the jobs report, about 43 minutes away. The headline number, the expectation about 175. We'll get into those numbers in just a moment. Let's talk about the price action. Equity futures negative by more than 1 full percentage point. The bond rally continues. Yields are lower by 3 or 4 basis points. 393.76. Under surveillance this morning, the data in the driving seat.
I'm not worried about the state of the labor market. That said, the unemployment rate has moved higher. This is typically the tough part to really navigate, is getting that unemployment rate to move slowly up and not just shoot higher in an asymmetric way. So the next 6 months will be really important for the unemployment rate.
Here's the latest. Less than 1 hour until the July payrolls report. This marking the first of 2 jobs reports and 2 CPI prints before the next Fed decision in September. Neela Richardson of ADP writes this. Right now, the preponderance of jobs data shows a cooling but solid labour market. What's playing in the Fed's favour is how low the unemployment rate continues to be, so they can afford to be patient. Neela joins us now for more. Neela, it's good to see you.
Good to see you too.
What a great day to catch up. Let's talk about the jobs market. You sound a little bit more constructive, dare I say a lot more constructive than some of the guests we've already spoken to this morning. You've got a load of data in front of you. Walk through what you see and why that gives you a little bit more confidence that this Federal Reserve has some time.
Well, first of all, we're still seeing hiring. And the hiring is robust, and the hiring is different than what it was 2 years ago. It's not just lower, it's less replacement hiring. Remember, this was the time of the Great Resignation. That meant if you had, for example, 30 employees and you owned a small firm, you might have seen 100 employees over a course of a year because your turnover rate was so high. We're not in that situation now. When a firm is hiring today, it's because they're trying to expand their workforce, not replace it. And I think that's an important point to keep in mind. Also, when we're looking at the unemployment rate, we are also seeing more people coming into the labor market, maybe lured by higher wage growth. So this jobs market is robust in some ways, and there are some concerns in the other. I'll just mention one concern that I have is how lopsided our job gains are right now, how positioned towards the service sector, and only certain sectors within the service sector are really seeing strong job growth. I think that is a concern going into the second half of the year.
So now people point to 2 things. Like you say, you're absolutely right that hiring is now more and more concentrated, which makes it more vulnerable.
Right.
And second, the nonlinearity of the labor market, that when it starts weakening, companies feel they're safer, if you like, to lay off people. Mm-hmm. The consumer gets more cautious, and then you start a process that's self-feeding. How worried are you about that second point, that it's a non-linear behavior when it starts weakening?
You know, I think companies are dealing with a lot of things right now. One of the things when I talk to companies they're dealing with is people aren't leaving. They're staying in role, and you see that in the JOLTS report. They're staying in role longer than anticipated. So companies hired coming into 2004 thinking there'd be more turnover than they actually saw. So the layoffs that you're seeing is not just a firm trying to right size because of margins or profit concerns. There's some of that. But it's also a correction to maybe overhiring a year ago or 2 years ago. So yes, there is a tendency for that employment rate to reflect weakness, but it must also reflect a little bit of self-correction on the part of companies as they're trying to right-size their employment going in, again, to maybe a weaker GDP growth and demand environment.
So take it to the data. We had a 4.1% unemployment rate. Mm-hmm. The Fed thinks we end the year at 4.
Right.
Where do you think we end the year?
I think we end the year around 4. I mean, I think that's plausible given the pace of hiring, given how strong consumer demand still is. It's fairly resilient, weakening in spots, but still overall good. And where you're seeing growth in the labor market is in those consumer-facing industries. So yeah, overall, I am constructive, but that doesn't mean that I have rose-colored glasses on this hot summer day.
I would just say constructive relative to the gloom that we've heard around this table.
Well, when you look at the labor market, like I have been for, through the pandemic, we've seen the highs and the lows of this labor market. We've seen very low lows. We've seen highs that were unsustainable. Right now, yes, it's a more normal labor market, but normal isn't always going up. There's a little volatility even in normal.
Bank of England's Pill says it's a little quick to say inflation is down.
I think we're seeing in this
further saying there is still a little way to go on inflation.
Very responsive to economic conditions.
We've just had a lot of doom and gloom on the show. People coming on using the R word. Danny was talking about before that even 0.1% higher on the unemployment rate to go to 4.2% would trigger the SOM rule.
Pill says it's too soon to say the job is done on inflation.
In the unemployment rate.
Always concerned about the unemployment rate, but less now than usual because I really think levels matter, and we started at a record low level of unemployment. So yes, unemployment rates are ticking up, but they're starting from a low level, and I think that gets lost.
Bank from Ms. Pill says we focused on the inflation expectations in the UK.
And it matters where you finish. And if we're finishing at 4%, if we're finishing under 4.5%, I'll take that. That's very different than finishing at 6 or 7%, which has happened in other recessions. So that context is really important.
You've got some data as well, I believe, on job changes. You talked about people not leaving.
That's right.
What's happening with the wage growth that they can achieve from leaving if they wanted to, if they can find a job?
It's shrinking. In 22...
Quickly?
Yeah, very. In 22, 23, you could actually see maybe a 9% pay bump from your old job to moving to a new job. That's a pretty significant pay raise, especially if you're not making a lot. If you're in an hourly job in a consumer, like retail, restaurants, leisure and hospitality writ large. And so the premium from switching jobs has shrunk, which is why people are staying in place longer, why the labor market is less dynamic, and why we might see less hiring over time.
Is that what we saw in job openings, the jobs data, the quits rate, the hiring data? Did we start to see some of that?
Starting to see that. You're not seeing as many openings. You're not seeing as many quits. Quits are down double digits from last year. And so there's no returns for a worker. The returns for switching have been getting smaller over time, and that's what we're seeing in the data.
Fascinating. Nida, appreciate it. Nida Richardson there of ADP, a Bloomberg contributor. I have to say, from my perspective, super rosy, given the doom and gloom. It's all relative. The doom and gloom on this program over the last 24 hours, Mohammed, we've gone from talking about soft landings just like that. Literally in the last 24 hours, it feels like consensus has shifted towards this hard landing story very, very quickly.
So is it the market?
Bank from Ms. Pill says we still need to bear down on bits of inflation.
I think it's the data shaping the narrative, and that's shaping the price action. I do. I've got to say it's the economic data of the last 24 hours that spooked people. The employment component of ISM manufacturing, jobless claims getting to close to 250. The problem that I've got with this, Mohammed, and I think a lot of people feel the same way, we've had a few head fakes over the last 12 months. We've got claims the highest since August of last year.
Pill says we need to keep restrictive policy at least for a while.
Again, Nida's talking about the dynamism of the labour market. I wonder if that's what's in store for us again. This is another head fake. 8:30 is going to be a big part of this story and how people write about this economy and this labour market going into next week.
Agreed. And let me just say I wrote down, Ella, normal is dynamic in the labour market. I like that.
It's a great line. Coming up in the next hour of Bloomberg Surveillance, the third hour just around the corner, we'll catch up with Nadia Lovell of UBS, Robert Tipp of PGIM, Jeff Rosenberg of BlackRock, Dana Peterson of the Conference Board. Your jobs report is 34 minutes away. Your estimate is 175K. The previous month, 206 on unemployment. Big focus on unemployment. Does it carry
Bank of England's Pill says the MPC agrees we still see a second round inflation.
Previous month of 4.1%. Mohammed talked about the market narrative. It's running away over the last couple of days, that's for sure.
With Pill saying we are continuing to see some second round effects from inflation.
On the S&P and the bond market, the rally continues. The jobs report, 34 minutes away.
Pill says wages and prices margins are expanding strongly.
You look at the number of women that want to learn the game, young girls that are joining on the tee. Really an exciting time for all of us to really capitalize on this moment. When you look at women who are making most of the purchasing decisions in households, whether that's cars or that is home or financial services, and who are going to drive the wealth of the future, it's women.
Obviously, we have our car business and we need to have games here and all that sort of thing, but what else can we do? How do we grow the platform? The whole ticket pricing process. It used to be very yellow sheet of paper, maybe some numbers around it. There was not a lot of science behind it. We're now in the world and have been for many years, as most other similar businesses are, to dynamic pricing. So our pricing for a seat may change hourly if we see demand for that, all driven to maximize revenues.
The balance sheet is so important to the success of the team. And a big part of my role is to make sure that the balance sheet stays strong and that we are prudent stewards of capital. There are things that we can do that are irrespective of winning or losing. Take a look at the first budget that comes from one of the teams and ask questions about, do you really need to spend that much? Are you really shooting high enough when it comes to partnership revenue?
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Bill says we can't be complacent on inflation.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
Pill says we shouldn't promise that UK rates will drop more.
Investigation. How do you eat an elephant one bite at a time?
It jumped off the page at me.
So that is Pill there saying we should not promise rates are going down to we're not going to move further down in the very short term.
These are the holders of truth and justice. They cannot be possibly be doing this, but then they are. They are. And the evidence is there. It's overwhelming.
People ask me all the time, what is the key
Secured
to
out
being a
financing
really
rate
good
5.35%
I
for
tell them
August
it's
the
to surround
1st
yourself
versus
with people who work with the
5.38%
best
for July the
investors you can
31st.
find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
In our eyes, it all comes down to the labor market.
The markets have definitely moved from worries around inflation to worries around labor.
The labor market can turn very quickly, which is why I think Fed officials have to be cautious as they watch these data.
A strong report's probably not going to prevent them from cutting, but obviously a weak one could.
I just feel like the risks on the employment side are increasing to the point that you want to put more weight on that.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
Okay, we are 30 minutes away from the jobs report. Let's do one thing first. Let's check out the price action, then we'll get to the guesses. As for the price action, still negative on the S&P 500. We're down across the board. On the board right now by more than 1 full percentage point on the S&P. Down by 1.8 on the NASDAQ. Down by 1.6 on a Russell. The small caps pull in lower. Switch up the board and let's turn to what we're looking for a little bit later. Jobs guesses, 175 is the median estimate for the number that drops in 29 minutes' time. The previous read, 206. A big focus on unemployment. Hardly talked about wage growth. Just a big focus on unemployment and whether this continues to climb higher. 4.1% is the estimate in our survey, in line with the previous number. I can tell you one bank looking for 4.2. It's Citi. Citigroup and Andrew Hollenhorst. And Citi just published. And this is the title of the piece. And Mohammed, you mentioned this in the last hour or so, how quickly this conversation has changed. Citigroup today are looking for 150K. They're looking for unemployment to get to 4.2%. And the title of this piece today is 75 basis points of cuts for 2024 might be too few. How quickly has this story changed in just a couple of weeks?
Incredibly quickly. I mean, it's amazing. I'm absolutely stunned because consensus is moving so fast. I'm absolutely stunned.
Do you think it makes sense the consensus has moved this far? Is it validated by the incoming information that we've had over the last few weeks from corporate America and the economic data alike?
So I felt, as you know, it should have moved earlier than it did. it's taken time, and now it has moved. It's actually overshot where I am. When I hear people say 50 basis points in September, I think that's really, really difficult for the Fed to start a cutting cycle with 50 basis points. But that's where the narrative is going.
And you think that if they cut 50 in September, they've made a mistake?
Oh, absolutely. I do think they should have started cutting in July. But having said that, I wouldn't say now they should cut 50. I think they've got to be really careful to handle the start of this cycle. You know, you do impact behaviors. We haven't talked about this, but the major issue in the labor market is going to be behavioral. Are people feeling more insecure about their future income, and therefore are they cutting down on their income now? That's going to be the major question.
They're certainly cutting down on spending based on what we've heard from corporate America over the last few weeks or so. I've mentioned this calendar a few times. September 18th is the next Fed decision. At that decision, they also need to produce some new forecasts. And at the moment, they've got year-end unemployment of around 4%. They've actually got year-end unemployment for 2025 at around the same number. And that's basically where we are right now. For the data points still to come, after 8:30 this morning, August 14th, we've got a CPI report, another jobs report on September 6th, another CPI report on September 11th. A key feature, Mohammed, of your call, and you've written about this over the last few weeks, going into the decision this week, you said we were 2 decisions away from a policy mistake, including the July meeting and the September meeting. And the reason you said that was because you think this Federal Reserve could be pushed away from cutting interest rates based on one freaky CPI print between now and then. After that news conference, when the chairman kind of backed away from this view of saying we're not data point dependent, we're data dependent, has he done enough to convince you, after you blessed him with your thoughts on what the Federal Reserve should do? Are you convinced that maybe he's seen your way of things?
So I'm glad he picked up on Christine Lagarde, the ECB president's phrase of we are data dependent, not data point dependent. And he stressed that by saying we look at the whole data. He kept on being pushed. You look at this, you look at that. He said, no, we look at the whole data. Look, John, in your series of dates coming up, let's not forget Jackson Hole.
Sure.
Because our star now becomes much more important. What is your destination? If people are pushing you to start the journey earlier, if they are building in quite a few cuts in that journey, what is your destination? And I think that the Fed needs to spend a lot more time thinking about the destination issues than it has so far.
We can explore that this hour. Coming up this hour, we'll catch up with Nadia Lovell of UBS as the stock market sell-off extends into Friday. Robert Tipp of PGIM, fixed income, as risk aversion sparks a major bond market rally over the last 7 days. And Dana Peterson of the Conference Board on why she doesn't anticipate a hard landing. We begin with our top story, the payrolls report just under 30 minutes away. The first of 4 data points that the Fed will be watching ahead of September's rate decision. Nadia Lovell of UBS saying this: the Fed remains on track to start cutting in September with the economy on course for a soft landing. Easing financial conditions should be supportive to a further broadening out of equity market performance. Nadia joins us now for more. Nadia, good to see you. Before we talk about the call in the equity market, can we talk about the call in the economy? Soft landing was consensus for a long, long time, but it feels like things are changing quickly over the last few days. Why are you and the team sticking with that view?
Yes, you know, we do think that the economy is slowing, but this is what normalization looks like. And when we heard from the companies throughout the earnings season, it does feel like things are slowing, but not necessarily deteriorating at a fast clip. So we still think that you can get economic growth in the 1.5% to 2% range in the back half of the year. You know, we do think that the Fed will start to cut, and that will help the economy as we enter into year end, and that should be all supportive for the market. But there are data points coming out of earnings season that did give us some pause around the consumer. So we're watching that closely. But again, it doesn't feel like things are falling off of a cliff, at least not yet.
So what do you make of the change in the market narrative? What do you make of the fact that people have become so negative about the economy suddenly?
We're sort of in this regime again where we're shifting again where, you know, good news is good news and bad news is bad news. And so it's clear to us, and I think to the market, that the rate cuts are imminent. Powell sort of blessed that, thanks to you as well, for blessing the September cut. And so the focus shifts to the data in terms of the growth data. Yesterday, ISM spooked the market, manufacturing, but reality is, you know, manufacturing has been sort of below, on average, 50 since late October of 2022, right? And to my understanding, the Fed had a preview of the ISM manufacturing data, and they didn't seem overly concerned with it. So again, I go back to things are slowing, but not deteriorating in a fast clip. And I think that the market, again, has gotten ahead of itself, particularly the rate markets that's now pricing in 90 basis points of cut this year. We think that it's going to be 50 starting in September and then another one in December.
So let me ask you about your distribution of potential outcomes. And I've put a soft landing at 50%, a recession at 35%, and then the really good scenario of bigger but not hotter because of positive supply shocks at 15%. So let's focus on the soft landing. Is it a lot higher than 50% in your mind?
I think it's much higher than that. But again, you know, whether it's 50 or 60 sort of range, we still think that it's hard to see the economy go from, you know, growing above 2% in the first half of the year to then in significant contraction in the second half, particularly when you have a labor market that, yes, is softening, but still producing job growth.
Nadia, you mentioned ISM yesterday. Reading through some of these responses, there's serious concern. One food and beverage company, consumer behavior is changing more than normal. Another company saying, we are hoping for an increase in customer demand, or we will possibly need to make organizational changes, i.e. layoffs. If you're viewing in a soft landing, what does it take for you to see in the data to potentially pivot and say, actually, this is going to be a hard landing?
I think you need to see, obviously, the labor market is quite important. We all know that that is the last shoe to drop. You are seeing a pickup in claims, but some of the data is quite mixed. I think some of the comments that you're seeing in the ISM has to do with reality is the consumer has been under pressure from inflation. I mean, food inflation itself has been up 30%. Since the start of a pandemic. So it feels like what companies are experiencing, they got used to the last few years of increasing prices and passing that on to the consumer, and the consumer just, you know, continuing to spend. Now things are going back to pre-pandemic trends, and it feels like that companies have forgotten what that felt like.
One of your least preferred sectors, consumer discretionary. Does that speak to that?
So in terms of it, consumer discretionary, our view on that, it's less about the consumer. We just do think that the consumer as a whole is okay, particularly when you look at the wealth effect. You know, you have the equity markets at all-time, home equity at record levels. It's more to do with the mix in terms of the sector being skewed more towards goods, and you're seeing a slowdown with that. You're starting to see, yes, some of that weakness translate into restaurants and even a pullback now on travel.
Airlines too, yeah.
Exactly, and even the high-end consumer throughout the earnings season, it feels like they're throttling back a little bit as well. So it's less more so about like, oh, we think that the consumer is really deteriorating, and more so of the fact that that sector skews towards more goods. Even home furnishing, you know, this past week down a lot as well.
Broadening. You're looking for broadening. Where's it come from? Who's leading it?
The broadening is more coming from some of the, I would say, in terms of some more value, cyclical value, if you will. Think about, like, whether you think about financials and them benefited from rates moving lower, them benefited from, you know, Basel III endgame and sort of easing regulation as well. So that's where some of the broad. Also, I would say even in the industrials, some of the more longer cycle industrials are benefiting from the increase in spending that we're seeing in AI, electrification, and automation as well. So the broadening that we're speaking of is not small cap per se, that I know has become a hot topic, but more some of the cyclical value.
So if you had looked at the S&P, there were three drivers of what has been strong performance. One is the notion that the sky is the limit for anything that has to do with AI. Second is U.S. economic exceptionalism that's going to continue supporting the broader market. And third, a responsive Fed. And over the last few weeks, we've seen all three being questioned and questioned in a significant manner. Looking forward, the repair process, where does it start? How far does it extend in terms of those three drivers?
So I think the Fed needs to start in September. The AI CapEx cycle, we are not, I would say I put more confidence in that than the other two that you spoke about. Because reality is, again, as you always say, listen to the companies, what have we heard this earnings season is that CapEx continues to go higher. You know, without commenting on single stock, if you look at Microsoft in their 10K, CapEx is be higher beyond 2025. So the hyperscalers are spending a lot of money, and they continue to emphasize that they're rather, like a Meta, Zucker has said, I'd rather have capacity that's not needed today than be late to that. So when we think about positioning in tech, we want to be positioned in those enablers. Those are geared towards AI infrastructure. And let's not forget the utilities are part of that. I think that's where some of the broadening out is coming from. So that's where we will put our confidence in, and sort of like, because at the end of the day, what matters for this market is earnings growth. We think it is going to be continue to be led by tech, and then sort of the Fed behind that.
It was a powerful quote from Zuckerberg, powerful from Alphabet as well. Picked up on the same thing.
Exactly.
Nadia, it's good to see you. Thank you.
Thanks.
Nadia Lovell there of UBS on this equity market. This equity market is lower. We're down about 1% on the S&P 500. The jobs report about 17, 18 minutes away. Let's take the opportunity, just a minute or so, to get you an update on stories elsewhere. With the Bloomberg Brief, here's Danny Berger. Hey, Danny.
Hey, John. The president and vice president were at Joint Base Andrews last night to welcome home Wall Street Journal reporter Evan Gershkovich, former Marine Paul Whelan, and other Americans as they arrived home. It was all part of the largest prisoner swap with Russia since the Cold War. In return for the Americans and other prisoners, Russia won the release of Vadim Krasikov, who's been serving life in Germany for killing a Chechen separatist. Germany had long resisted Krasikov's release. Chevron has made plans to move its headquarters from California to Texas. It is just the latest major company to leave the West Coast, complaining of excess regulation. It ends more than 140 years of Chevron in California. The company, though, does have already about 7,000 employees in Houston versus just 2,000 in San Ramon, California. In January, Chevron lashed out at what it called increasingly harsh regulatory environment in California, writing down the value of its assets in the state. And it is day 7 of the Olympics today. 7 U.S. teams compete across 5 team sports. In swimming, there are 3 finals on the schedule today. The attention turns to Caleb Dressel in the 50-meter freestyle race. In track and field, all eyes to Sha'Carri Richardson, the reigning world champion, in the 100-meter dash when she runs in the prelim of that event, plus the men's 100,000-meter final. And the U.S. is still leading the overall medal count, 39. 9 of them are gold. China has 12 gold medals and 26 overall. And that's your brief, John.
We've got a population adjuster table. Going to do that for you next week. Someone's going to do that. No one's going to do. Okay, we should do that then. Up next on the programme, the morning calls, plus Robert Tipper-Peach in fixed income on the bond market rally heading into July payrolls. That payrolls report 15 minutes away from New York, your equity market lower. This is Bloomberg.
Jumpstart your trading day with 2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
Bloomberg Open Interest, weekdays at 9 a.m. Eastern, only on Bloomberg Television.
The top names in global leadership are on Bloomberg.
Japan has made changes to 5 separate 70-year-old policies. They've gone from 1% to 2% on GDP for defense. They'll become the 3rd largest military. They've changed their export capability. They've opened up and stabilized their relationship with Korea. Japan can be a significant partner in the region.
Nobody covers the top global leaders like Bloomberg Television and Radio. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close, weekdays at 3 p.m. only on Bloomberg Television. Context changes everything.
a question I've thought of, and a question I know that you at home in the office working away have thought of as well this morning. What happens if the jobs number is really strong? How does this conversation change? Ian Lincoln of BMO wrote this just yesterday. I'll share it with you now. NFP represents the biggest near-term risk event, even if it is decidedly one-sided, as investors will be quick to dismiss strength as status quo, while a sharp slowdown could be interpreted as a game changer for the Fed. We're going to find out in about 13 minutes' time. Equities right now on the S&P 500, negative by 1.1%. It yields down by 4 basis points on a 10-year, 393.76. Let's get you some morning calls. First up, Raymond James cutting Intel to market perform. The analyst saying AI PC growth has turned out to be a bigger headwind than anticipated. Intel's getting hammered. We're down 23% in early trading. Next up, Barclays raising its price target on Amazon to $235, keeping an overweight rating. The firm noting that web services, quote, deliver the goods, as Amazon faced an extremely high bar for AI investments. That stock is negative by 8.3% in pre-market trading. And finally, Citi raising its price target on Apple to $255. They keep a buy rating. The firm encouraged by early developer feedback on iOS 18 AI features, as well as management's confidence in AI-driven upgrade cycles. That's the story for the morning calls. The payrolls report just moments away. Treasury's rallying into the report as traders boost their bets for Fed rate cuts. Robert Tipper, PGIM Fixed Income, saying this. Exactly how weak is the jobs market? Employment statistics have been moderating, but not evenly. Non-farm payrolls have the potential fill or kill market expectations for a steady streak of rate cuts. Robert Tipp joins us now for more. Robert, I'll start with your own question. How weak is this jobs market? What are you expecting in 11 minutes?
I think that, the market pricing here is looking for rate cuts straight through the middle of next year. So this market is pretty much braced for a steady downturn in the job market that the Fed is going to meet with at least 25 basis points per meeting this year. And on average, we'll hit every meeting through the middle of next year. So, I don't know what's going to happen, but I can tell you that the numbers to date have hollowed out in terms of the cyclical aspects of the economy. There's more government, there's more healthcare. So you can make the case that seeing a big drop-off in the numbers today is to be expected, and that the Fed, if they get another set of weak numbers, just like 2 out of 3 of the last cycles, could end up cutting intermeeting.
Cutting
That's
into a
why
meeting?
they would do it.
It's been 10 minutes time now at the bottom of the hour. See the release of the highly anticipated US employment situation report for the month of July. Non-farm payrolls forecast 175k on the prior 206k, with a range of 230k to 70k expected. The unemployment rate forecast to remain unchanged at 4.1%, with a range of 4.2% to 4% expected. Average earnings year over year forecast 3.7% on the prior 3.9%, with a range of 3.9 to 3.6% expected. Average earnings month over month forecast 0.3% on the prior 0.3%. Average work week hours forecast 34.3 on the prior 34.3. Private payrolls forecast 140k on the prior 136k. Manufacturing payrolls forecast minus 5k on the prior minus 8k. And labour force participation forecast 62.6% on the prior 62.6%.
Have a very moderate slowdown, aside from any, hurricane side effects and that kind of thing.
So taking a look at a note from UniCredit ahead of this employment situation report, who forecast non-farm payrolls to rise 180k, slower than the 206k previously, and 3-month average increase of 177k as well. So while UniCredit note this would be a solid pace, in part due to labour force gains, they continue to think that the BLS's birth-death model overestimates payroll gains. Weekly continued jobless claims figures have continued to rise. The unemployment rate likely held at 4.1% according to UniCredit, after 3 consecutive increases. They would not be surprised, however, if the unemployment rate rose by 2 decimal places, which could trigger the SARM rule, which has historically coincided with a recession, UniCredit notes. So with the labour market coming into better balance, average hourly earnings likely rose 0.3% on a monthly basis with downside risks. Such a rise would likely take the year-over-year rate down 2 percentage points to 3.7%, which is a slight increase from the 3 to 3.5% range that most Fed officials judge to be consistent with meeting the Fed's 2% inflation target over time.
Under them, like a 2008 scenario. Believe me, I do not think that's what's going on. I think the underpinnings here are solid. Could we have, very modest growth, a big slowdown to something subpar? Absolutely. But I don't think we're going to drop off like we have in 08 or like we saw in the 2001. But that's the fear. I think this is going to be a lot more like a 1995, where they get the numbers under control. They cut on a moderate basis. Because if you think about it, we've just seen a couple good inflation numbers. Before that, we saw a handful of worrisome ones. If it turns out things are moving higher, the Fed doesn't want to be wrong-footed in the other direction.
Hey, Robert, great to get your thoughts. Appreciate it. Robert Tivdev, PGIM, fixed income with a lot to think about. We often joke around this table that the jobs number we're about to get is the most important jobs report since the last one until the next one. Mike McKee joined us. And Mike McKee, I have to say, this jobs report does feel a little bit more important this time.
It does seem to carry a little bit more weight. I'm not going to say it's the most important one in our lifetime, but certainly the most important since the June report. This is maybe a turning point that we're at here, and that's what everybody wants to, as Robert says, fill or kill the idea, because if it is a turning point, then you're going to maintain the trade that we've had the last couple of days. And if we get a strong report, it'll be interesting to see what happens. And of course, the big question is our good friend Mohammed wrong in saying that the Fed had was two meetings away from a policy mistake. We get a bad number today, it might have been just one meeting away from a policy mistake.
So, Mike, what is going on? A few weeks ago, everybody was comfortable. Yes, they can wait till September.
According to a survey, OPEC crude output fell 60,000 barrels per day in July to 26.99 million barrels per day. OPEC keeps oil output steady while cautiously watching the markets.
Well, I think what you're seeing is
also some commentary from the PBOC, who are to keep the yuan basically stable and are to continue to implement prudent monetary policy.
The Fed has a reaction function. Markets have an overreaction function. I don't think we're going to get 50, and I certainly don't think we would get an intermediate cut because, well, first of all, one number isn't going to change anything in their minds. But I do think they're probably more divided at this last meeting than Chairman Powell led on. They all agreed at the end. But what did they say in the middle? We're going to have to check the minutes on that one.
Sintra Portugal, the ECB's get together. It really wasn't that long ago. It's about a month ago. And Chairman Powell spoke in Sintra Portugal and he talked about the strength
and the
of the labour
PBOC
market
says they are to prevent the risk of exchange rates overshooting and are to deepen the financial reform and opening up.
The news conference that you were in this week, that he didn't really stray too far away from that line. What would upset them today? You look at the jobs report, you look at the estimates in front of us, we get the numbers in a moment. What would upset them today? What would change
Brings us now to 5 minutes away from the bottom of the hour, where we see the release of the US employment situation report for the month of July. Non-farm payrolls forecast 175k on the prior 206k, with a range of 230k to 70k expected. The unemployment rate forecast is to remain unchanged at 4.1%, with a range of 4.2 to 4% expected. Average earnings year over year forecast 3.7% on the prior 3.9%, range of 3.9 to 3.6% expected.
Ratchet down to the 150s or 130s. So I think it's much more on the unemployment side.
So Morgan Stanley note that their forecast is that payrolls slowed to 195k in July to reflect slower public sector employment. But they expect the private payrolls re-accelerated from 136k in June to 155k in this coming report. There's still some modest slowing from their 174k per month year-to-date average gain. There are important downside risks from Hurricane Beryl, Morgan Stanley notes, from seasonal factors and from teacher employment as well.
Just around the corner.
PBOC knows that they are to maintain reasonable liquidity.
season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
Brent crude futures fall $1 a barrel to around $78.52 a barrel.
Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks. 24
1 minute
hours
remaining
a day,
now. I'll be leading with the US non-farm payrolls.
Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia is here.
inspired by the fusion of East and West,
I'm like the ambassador of the tour.
Hong Kong designer Vivienne Tam explores a future where fashion and technology.
People say, Vivian, it's not possible. I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg.
10 seconds.
The jobs report 25 seconds away. The estimate 175k. That's on headline payrolls. On unemployment, the estimate 4.1%.
114k, lower than forecast 175k. The unemployment rate 4.3%, 4.3%, higher than forecast 4.1%. Average earnings at 3.6%, 3.6%, lower than forecast 3.7%. Looking to the markets, drops in the dollar and the S&P 500 as well as US Treasury yields here as well. Private payrolls 97k, lower than forecast 140k. Average work week hours 34.2. That's lower than forecast 34.3. Average earnings month over month at 0.2%, lower than forecast 0.3%. Manufacturing payrolls at 1k, higher than forecast minus 5k. Labour force participation 62.7%, lower than forecast 62.6%.
That might be, we're going to have to check, that might be related.
Noting prior revisions here, average earnings year over year, prior revised down to 3.8% from 3.9%. Manufacturing payrolls revised down to minus 9k from minus 8k. Non-farm payrolls revised down as well to 179k from 206k.
That seems to have been in June because that's revised down to 179 from 206. Manufacturing payrolls up 1,000. That is a surprise. All the pre-indicators, including ISM, suggesting that that was going to be bad news. And I know Mohammed's looking at the labor force participation rate, 62.7. That's up from 62.6 before.
Ladies and gentlemen, we have a growth scare. Let's get to the price action. Equity futures on the S&P down 1.5, on the NASDAQ down 2.2, on the Russell down 2.6. Want to see something dramatic? It's a word that gets overused on Wall Street, but this is a dramatic move. Switch up the board and get to the bond market. Front end of the curve on a 2-year yield. Look at this move on a 2-year yield. We're down 25 basis points. The 2-year is now below where the 10-year was.
So again, Treasury yields extending their falls following the US payrolls data. Traders bet that the Fed had to cut rates by a half percentage point in September after the July unemployment rate rising to 4.3%. So again, traders betting for a 50 basis point cut at the September meeting now, following that higher than expected unemployment rates and lower than expected non-farm payrolls number.
And it is, I think the way you characterize it, a growth scare is a good way to put it.
As you speak, Mike McKee, dollar-yen gap in lower, down by 1.2%. A stronger Japanese yen at 147.60. If you are just joining us, jobless claims yesterday, higher than expected. ISM manufacturing, lower than expected. The employment component spooked this market. And based
Traders
on
now
this,
see a 2 in 3 chance that the Fed will cut rates by a half point in September, up from 30% before the data.
Unemployment comes in at 4.3. The estimate was 4.1. And once I've given you that, you can guess what this market's doing. Equities selling off, bonds rallying, the dollar weaker. Mohammed, I want your view on this as well. What is your view on the totality of the economic data? And at 8:32 this morning, looking back at that Fed decision on Wednesday, how bad was that call to wait until September?
So I'm hearing the market scream two things, John. Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from
The US two-year yield falling 29 basis points at the lowest level in a year. Traders ramping up bets on easing now in 2024, seeing 111 basis points in total now.
Starting its cutting cycle.
I do need to give one small correction here. We did not technically trigger the SOM rule because the 3-digit unemployment rate is 4.253, rounds up to 4.3. You would have had to have 4.8. I just plugged into my Excel spreadsheet the numbers, and we come out at 4.085. So we're very close to the SOM rule, whether that matters or not.
Can I just say this market's trading as if we have triggered the SOM rule and we're already in a recession? That's what this feels like, Mohammed. Is that what it feels like to you?
So Bill Dudley explained it, I think, really well, is the notion that all you need is people to start worrying about something, and then you don't actually have to have it happen. I think people underestimate the behavioral aspects when it comes to the labor market. I do worry, John. I've been worried for a while. You know that. I do worry. Now it's going to be really interesting to hear what Fed speakers say now that they're out of the blackout period, and what are they going to tell us?
Let's just take a step back, Mohammed. We've had growth scares before in this cycle. A lot of people have been humbled by how well this economy has held up. Why does this moment feel so different compared to all those other moments over the last few years?
So this is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the US to fall into recession. I think people underestimated the lagged effects of higher interest rates, and these are hitting in a much bigger way now. Chair Powell admitted
Money markets price in about 70 basis points of further ECB rate cuts this year now, from around 60 basis points before that US data.
Economic exceptionalism because of a policy mistake.
Just to recap, if you are just joining the program, welcome. We got payrolls just moments ago, 114 against an estimate in our survey of 175. The unemployment rate climbed to 4.3%. The estimate was 4.1. That's unlocked a lot of weakness in this equity market. Already on top of the weakness we've already seen. If we start with the equity board on the S&P 500, we are down across the board. Equity futures negative on the S&P, on the NASDAQ, on the Russell. On the S&P, we're down 1.8, on the NASDAQ 2.5. Look at this move in small caps now. Negative by more than 4 full percentage points. This was the trade in July, up by more than 10%. It was the big rotation, the broadening. We'd get lower interest rates, but we wouldn't get the growth scare with it. And that's what's changed in the last couple of days off the back of this economic data. And check out this bond market move. I want to keep going to the front end of the yield curve, the 2-year. The 2-year yield is lower by 26 basis points to 3.89. And once you've seen that board, you know exactly what foreign exchange is doing. Check out dollar yen. Dollar yen's had a massive week already. Yen strength, you get some more yen strength through this market. Dollar yen gapping lower on my screen to 147.35. To break it down, joining us now, I'm really pleased to say, is Dana Peterson of the Conference Board.
US Treasury 2 to 10 yield curve, the least inverted since July of 2022 now.
What do you make of this? A lot of people around this table, including Mohammed Al-Arian, saying this is the growth scare and there's good reason for it. Do you agree?
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic, where we know millions of people were let go, and then you had to recover them. So this is probably about normal for the labor market right now. And also, when you look at an unemployment rate at 4.3%, that is still very low. And what we're hearing from CEOs is that they're not really looking to let people go. They're holding on to their workers. And we have to remember, payrolls are a net number, right? And the thing is that on net, we're still adding jobs here.
So the reason why people say this may be different, and Dana push back on this, is that there are no more buffers for certain segments of the households. There are no more pandemic savings. There's very little credit availability left for them. That it's all about labor income. And if labor income starts falling, then you're going to get a much quicker sort of non-linear reaction in the economy than otherwise. So push back on this notion that the problem is that there are no other buffers in this economy.
Well, it's correct that the pandemic's excess savings is gone, but most people are working who want to work. Wages are still rising year on year, and they're still above what we saw during the great financial crisis and pandemic period. So yes, we are seeing people lever up on debt. All this is suggesting that yes, the economy is going to slow. That's what happens when you raise interest rates, and the goal was to lower inflation.
The trade is now seeing a 90% chance of a half-point cut at the September meeting.
But we're not there yet, and certainly there are a number of factors that are putting upward pressure on inflation. And remember, Fed Chair Powell said he doesn't want to see material further weakening in the labor market. I'm not sure that this report gets us there. And again, they're probably going to want to see next month's report also, plus the inflation data.
So Anne-Marie read out a few of the quotes that from yesterday's report about companies thinking, do we now have to realign our cost side, given what we're seeing on demand? How seriously should we take these comments?
Well, yes, I think some companies are probably running out of room to raise prices for customers, and that's the goal, right? The Fed wants companies to start cutting prices, which will help lower inflation. So on the demand side, everything is working according to plan. But the risk here is that you still have wages growing pretty aggressively, and that does raise labor costs for companies. And certainly smaller businesses are passing that right along to the customer. So that's leaning against the Fed's desire to get inflation back to 2%. So I think the Fed, certainly there's a signal that September will be the first cut, but I think the Fed will still move very cautiously, may spread out those cuts over time so that it can watch and make sure, yes, the economy is not going into recession, but also that inflation is slowing. Remember, inflation impacts everyone.
How can they move slowly and cautiously, though, if potentially they are behind the curve? A number of analysts came on the show today, Kit Juke, Sarah Howe, saying it would be a dramatic figure of under 100,000 for them to maybe go 50 basis points in September. Well, if you take into account the revisions as well from last month, we're basically there.
The revisions were small, and again, they were in June. And if you average out the second quarter, we roughly had around 165,000 jobs added. That's a lot. And I'm not sure the Fed is behind the curve. I think the Fed has been moving cautiously. And even look at GDP for the second quarter. It was stronger, especially domestic demand, and consumers went out and bought cars, and they also continue to spend on services. So that's not really economy, certainly in the second quarter, that I would say is collapsing. Now, we do think the economy will continue to slow. And again, that's according to plan. But as long as the labor market was still printing positive payrolls and the unemployment rate doesn't rise too much and approach 5%, I think the Fed can move cautiously and potentially 25 basis points for a meeting or even skip some meetings.
Dana, appreciate your perspective. A much more constructive view. Dana Peterson there at the conference board. As Dana speaks, some of these moves fade just a little bit, but a lot of it sticks. Equities are down hard. We'll start with stocks first. On the S&P 500, down 1.8%. The small caps down by 3.7%. Talked about this tremendous rally coming into the front end of the yield curve off the back of these numbers. Switch up the board and turn a page, and we'll look at the two-year together. The two-year yield is lower by 23 basis points at 392. Mohammed, we can talk about levels, and then we can talk about change. If you look at levels coming into this, 4.3% unemployment, payrolls of around 114. If we were sort of taking the last couple of years off and came back and looked at a jobs report like that, doesn't look terrible. You look at change. The change from where we were and where we are now, I think that's what the market's trading on. And you might, as an economist, sit here and say the Fed's not behind the curve. This market is trading as if it is behind the curve this morning.
It is. This market is taking change as much more important than levels. And I'm interested in Mike's view on this, because you were in the room, Mike, when the chair pushed back and said, well, look at the levels. Look at the levels. Do you think this report makes them worry more, or do you think that they think this is as planned? We're normalizing, nothing to worry about, levels are not that far out of whack?
I think you're probably right that they would say this is kind of what we're looking for. Now, it was a more abrupt move than perhaps they were looking for in terms of overall job creation, but the unemployment rate, while it sounded terrible at 4.3, it's a rounding issue, so it went up by about 0.5 point overall. And then you look at average weekly earnings, and on a year-over-year basis, it's significantly down. It's down to 3.6 now, and they have been looking for that. They've been wanting to get that below 4%. They've been wanting to get the inflation pressures, particularly in service industry jobs, back down to a level that they think is sustainable. So they'll see good things in this. The problem is to go back to what you said earlier, it only takes, you were quoting Bill Dudley, it's a confidence situation, and that's what people are going to be worried about, is are people going to stop spending, and therefore the companies have to lay people off, et cetera, et cetera.
Stay on the Fed for a minute. When they look at what's happening to the short end of the curve, will they think this is an overreaction?
I suspect they will, and it probably is to a certain extent because the short end of the curve is pinned to the Fed. And so what people are saying is we think there's going to be a rate cut, but that was already sort of priced in. So now you're going way beyond where the Fed thinks it needs to be. And if they're already planning a September rate cut, this certainly pushes in that direction, then it shouldn't change the short end yields that much.
At the start of the year, there was one trade everyone wanted to put on, and it was the bull steepener. They were all looking for this massive rally at the front end of the curve and this big rate cutting cycle to begin at the Federal Reserve. And it's been delayed. And here we are in August talking about September. That was back in January, but I can tell you it's developing right now. The distance between a 2-year and a 10-year is down to about 11 basis points. So that yield curve inversion is disinverting, and it does so again this morning. If you're just joining us again, I want to recap these numbers for you. So payrolls comes in much lighter than expected, softer at 114. The estimate was 175. The unemployment rate climbs to 4.3%. The estimate was 4.1. Back on Wednesday, after the Federal Reserve decision and the Chairman Powell news conference, we caught up with Jeff Rosenberg of BlackRock. And I said to Jeff, how will we view this Federal Reserve meeting at 8:31 Eastern Time on Friday once we get the payrolls report? And Jeff promised me his response. Jeff Rosenberg joins us now for more. Jeff, what is your response? How do we view that Federal Reserve meeting after seeing this data this morning?
Well, the data changes, and so does the view on what happened on Wednesday. You know, the big reaction here is that almost entirely across the board, this is a disappointingly weak number. So I'm very sympathetic to what Dana was saying earlier. The problem is that markets react to data relative to expectations. And so this is disappointing, particularly in the lack of a hurricane impact. You know, there's your 20,000 additional right there. And the issue now going forward is what's priced into the bond market is 50 basis points of a cut in September. So it's this issue of reflexivity now that we're going to get into, and it sets up the Jackson Hole speech really importantly to try to calibrate what is the Fed going to do relative to bond market expectations. You had Dudley on earlier this week talking about how the Fed incorporates that. And if it's priced in at 50, does that mean that the Fed has to go 50? And so the pushback on that is going to be really important around Jackson Hole. But this is now starting to change. And Jonathan, you highlighted what I think is the most interesting market price reaction, which isn't in the bond market, it's in the stock market. And it's that Russell 2000 leading the way downward. So this absolutely, and you pointed out, that had been the rotational trade. If it's maintenance cuts and the Fed can just ease us into a soft landing, then the denominator is what's driving the movement into Russell 2000. But you see the movement today. Absolutely. This is about a growth scare. And now it's about worries that the numerator, earnings and growth and cash flows, are falling. And so you're fleeing the rotation trade into small caps. I think it's a really important observation of market reaction. We can debate whether this is overreaction or not, but the reaction is clearly to almost entirely across the board a disappointing report this morning.
So let's debate this, Jeff, because the Jeff I know would have faded this move in markets, would have been where Mike is, that this is an overreaction, especially the short end of the curve. Is that where you are now?
You know, when the data changes, you change. You know, what do you do? So, you know, I think we've had a little bit of a string here of disappointment on the data, and that's pushing more, you know, Mohammed, on your point about the lags of monetary policy. So it's hard to, you know, stand too far firmly against that. My points in the past, I think, are still valid, that you've had, you know, financial conditions, which we haven't heard as much about from policymakers in this cycle. Financial conditions have been much easier, and that has been supportive. But those financial conditions, as we're seeing today, can change, and they can tighten very quickly, and they can unwind. And so I think that the reaction here, you know, is probably the right reaction. All right, maybe it's a bit of an overreaction, but you're going to push on changing the trajectory from maintenance cuts to calibration cuts, that policy needs to move a bit faster.
So is calibration cut a 50% cut come September? What probability would you put to a 50 basis points cut in September?
I think there's what the market wants them to do, and it's what they will do. I think they want to push back against 50 basis points. I think that's why Jackson Hole becomes important to kind of get that message out, that the Fed doesn't want to overreact. So I'd put a little bit less probability on 50 basis points than what we're getting in the market today. So I guess that says short term, a little bit of an overreaction. But I think the market wants to push for the 50.
Jeff, I want to talk about this market in a little bit more detail and talk about some of the things that I've heard over the last few months. The Fed put its back. And I've been told the Fed put its back because inflation is coming down and they have the ability to respond to adverse shocks if they need to. Another thing's come up on this program as well repeatedly, Jeff, and that there are two different kinds of rate cuts, and they're not created equally. You can cut interest rates because you've got disinflation and growth is still holding up, and that's great for risk. And you can cut interest rates because inflation is no longer a problem, but ultimately the problem now is the labour market. Jeff, do you think we've shifted to the latter? And if that is the case, can you make an argument for markets to do well in the face of interest rate cuts into year end?
Well, it was what I was highlighting. You're mentioning the Russell 2000 performance. There's a shift here. Again, to Dana's points, you got to be careful. You talk about it a lot. The first reaction isn't the only reaction, but you're introducing into the debate a higher probability of policy mistake, into the debate that this is no longer about maintenance cuts, that it is more risk of the hard landing, as opposed to the soft landing narrative and calibration cuts that, you can cut interest rates and that's a good story for risk. You're adding a bit more probability mass on the downside scenarios. Again, it's one data print. It's relatively still strong, but the pace of change, I think, as we've highlighted earlier in this call, the pace of change is a little bit worrisome.
Jeff, so are you on the side that this is deterioration, not normalization?
Well, the kind of knee-jerk reaction this morning is clearly that this is deterioration, again, because the pace of change is kind of accelerating. And when you take kind of the totality of the week's data, it's all kind of piling into that side. Now, it's obviously affected by some other things. You've got the tech earnings side. You've got the Middle East uncertainty. So we have to be careful about kind of lumping all of the market moves into the economics. But clearly on the morning reaction, this is a reaction to an acceleration to the downside relative to that more expected consensus view around, more gradual. So it is a bit worrisome in that regard.
Jeff, awesome to catch up, buddy. As always, Jeff Rosenberg there of BlackRock. Just got a note straight from Andrew Honhorst of Citi. Here's one for you. 50 basis points is absolutely on the table after the rise in the unemployment rate, with the SARM rule all but triggered and financial conditions tightening as equities sell off. The Fed may need to over-deliver on even the more dovish pricing now in the market. High inflation meant the Fed waited to cut rates, and now they may need to cut more sharply. That last line again. The Fed waited to cut rates because of high inflation, and now they may need to cut more sharply. We've had a conversation in the last 15 minutes. We've had one guest who's been constructive on the economic data in front of us, and they've talked about the levels. And then we've spoken to a market participant who's talking about the change plus the pace of that change. And Mohammed, it's the latter that's driving this market in quite a material way this morning.
It is, and I think rightly so, because we are seeing a rapid deterioration in the economy. John, I'm really glad you brought up inflation, because we have stopped talking about inflation. The assumption is that the inflation is conquered, and conquered per the Fed's 2% target. I'm not sure that's quite correct. I think inflation is conquered if you're willing to live with 2.5% to 3%. But if you're willing to live with 2%, we're not there yet, and that is going to complicate the Fed's policy reaction function even more.
Jackson Hole is going to be fascinating, isn't it? The speech that this chairman's got to deliver after a payrolls report like that.
If he's willing to address the major monetary policy issues, he may not want to do so.
Getting a lot of Fed speak through the next week or so, including a sit-down interview with Mr. Goolsbee of Chicago. President Goolsbee and Michael McKee. Mike McKee, I imagine that interview's changed after that data from 20 minutes ago.
Well, yeah, the first question might be a little different than in the past. I might let Mohammed come along and ask you. Hold up your column from the other day.
He's been on the right side of this conversation out of everyone on the committee.
He has. The interesting thing, though, is what comes next in a month where there's maybe going to be speeches, although nobody at the Fed has speeches scheduled for next week. And we got to wait till the end of the month to hear from Chairman Powell. There's no meeting in the month of August. We have to go till September 18th. So if these numbers keep coming in poorly, then, you know, what does the Fed do about that?
You don't think we get any speakers between now and the end of next week?
Oh, well, I'm just saying we have the schedule for the Board of Governors, and they're on vacation, so you know, I hope they have a good time.
Mike, out of all the data points now between now and Jackson Hole, I'm thinking of ISM services, a few more jobless claims read, CPI print in the mix as well. When you look at the totality of the data, when you see notes like this from Andrew Honhorst and Citi, not a base case, but saying 50s on the table for September, you've been through a few of these growth scares in the past. I don't know where we're going to be by the time we get to September, but do you think 50s on the table for September?
I still don't think so, because I think that that would be read as panic. Now, obviously, they'll have another jobs report. If we get another 100,000 jobs and unemployment continues going up, that could change everything. But as of today, they're going to say, well, we have a lot of data in front of us. Let's see what that says. Markets have to price minute by minute. The Fed doesn't. So I think you're going to see some volatility in this, and they'll push back on that.
What do you think they do with the 4.0% unemployment rate by the end of 2024?
Well, that's something they're probably going to have to adjust. 4.1% is what they thought they would have, and we have just blown through that. We have to see if it comes back. Interestingly, got a note from Omar Sharif, who takes this stuff apart in minute levels, and he notes that most of the rise in unemployment was people who are on temporary layoff. Permanent job losers only went up by 40,000, and he thinks that we might see a reversal next month in the unemployment rate, in which case the Fed comes out and says, well, so we were right.
Mike, do you think the White House and Democratic leaders are going to turn on Jay Powell?
No, they won't turn on Jay Powell. They recognize that it's kind of out of their control, and we're talking about a very blunt instrument. You can't fine-tune the economy that well, but if we continue to see this and we don't get a rate cut, then they might. But you've already heard the governor of Illinois say Fed rate policy is slowing down companies. They can't.
We're going to hear more of that for sure in the next few weeks. Mohammed, just in the final 60 seconds, final word. What a morning, what a week, what a start to August.
Yeah, I thought what a week before today, and now are we just 2 days into August?
I know, seriously, it's August 2nd. Amazing. I thought July was exhausting, and August is absolutely exhausting. I want to run you through next week at the trading diary, because this is what it looks like. There's some important data on Monday when we get S&P Global PMIs, ISM Services, and the Senior Loan Officer Opinion Survey. Lots of Fed speak as well picking up through the week too. On Tuesday, we've got a US trade balance. On Wednesday, get more corporate results. On Thursday, another round of jobless claims. And Thursday and jobless claims is like the big data point alongside ISM Services for the week ahead. On Monday, what a lineup. Claudia Sahm of New Century Advisors, Sarah Hunt of Alpine Saxon Woods, Lindsay Rosen of Goldman Sachs, Andrew Hollenhorst of Citi. Sahm on the Sahm rule. Hollenhorst on the potential for a 50 basis point cut in September. Hello, August, I guess, from New York. This was Bloomberg Surveillance.
Welcome to the world of decentralized finance.
We thought we'd take a look at Bitcoin versus the S&P 500.
Bloomberg's covering all things crypto, the people.
A tectonic shift emanating from Washington.
It's really a tale of two cities in crypto.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, Tuesdays, only on Bloomberg.
You are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
Right? And you're the first woman, as I understand it, the first woman to own 3 major, have a stake in 3 major sports teams. Is that right?
Yes, I'm going to say African American.
You were approached by the owner then of the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, Zabe Poland. He did come to me and Susan O'Malley, and they said, Abe Poland says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
All right, soft earnings plus a weak jobs report equals an absolute wipeout in futures. 30 minutes until the start of the cash trade. I'm Katie Greifeld.
And I'm Shonali Bassick. Matt Miller is off today, and Bloomberg Open Interest starts right now.
Coming up, a sea of red. The global sell-off in stocks intensifies as a weak jobs report really adds fuel to that fire. Also, big tech troubles mount. Intel, Amazon, and Apple continue the string of disappointing results this earnings season. We've got an all-star lineup of guests ahead. Acting Labor Secretary Julie Su, BlackRock's Rick Reeder, and Bank of America's Savita Subramanian join us this hour. Let's take a check at where markets are trading right now, because it is not pretty. As you can see on the screen behind me, S&P 500 futures down 1.5% pre-market. Even worse if you take a look at big tech. The NASDAQ 100 currently off by about 2.2%. And the bond market, all the action is in the bond market once again today. You can see the 10-year yield currently down 12 basis points, Shonali. We are well below that 4% level.
We certainly are. And let's take a look here really quickly at some of these big tech stocks, of course, reporting earnings. We're watching big tech, Amazon, Intel plunging. Amazon now down almost 10%. Intel another 24%. Apple getting a drop lower by 1.4% despite getting a boost from its AI features. You have a worry here about that growth scare, but also about that CapEx spending. Let's look also at the big oil earnings really quickly here at the stocks pre-market. We have Chevron falling 1.8%, Exxon falling.
The IMF projects China's 2024 economic growth to be 5%. Next year, they see full spot 5%, according to Chinese state media, again citing the IMF projections.
Yeah, it seems like everything is getting just thrown out with the bathwater today, and you've been so good on this, Shonali. The 2-year Treasury yield, just incredible moves. You take a look at that rate, currently down by 20 basis points. That, of course, comes after this morning's jobs data, coming in with a major miss to the downside. Let's break it down with Michael McKee. He is Bloomberg's chief international economics and policy correspondent. So we had a Fed meeting 2 days ago. Do you think that Jerome Powell is just wishing that he had cut rates now?
Well, we knew there'd be a risk element to this week because the jobs report was 2 days after their meeting, and it does look like risk went the wrong way for the Fed. And whether or not they think this is a terrible report, it does suggest that maybe they want to reconsider policy going forward. At least that'll be the debate on Wall Street. You can see the numbers, 114,000. The forecast was for 175. We had the last 2 months were kind of revised down, not much. But it's the unemployment rate that catches everybody's eye. It works out 4.3%.
All right, Mike McKee, thank you. We welcome now our Bloomberg TV and radio audiences, because joining us now, I am thrilled to say we have Acting Labor Secretary Julie Su, along with our own Anne-Marie Hordern. And it's great to have you with us. Obviously, a big reaction to this jobs report. So we had a 114,000 increase in payrolls. You actually spoke to us back in June and said that we were looking at the definition of a soft landing. As you parse through these numbers, would you still say that today?
Hi, thank you. It's so good to be here. I mean, we, look at the 3-month average. The 3-month average in growth is still 170,000 jobs. Remember, we spent a year talking about how the numbers were too high and too hot, and we had always planned for a transition to a more sustainable, steady level of growth. This number did come in below expectations. It's still over 100,000 jobs. It's still broad-based. We saw growth in multiple industries. We saw it in construction. We saw it in healthcare. We saw it in leisure and hospitality. There was a dramatic drop in one industry, information. But generally, this is an indicator of continued strength in the economy. And when you look at other things, including labor force participation, which is at an all-time high for prime age workers, and we continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
The unemployment rate came in at 4.3%, and Claudia Sahm has already said that this has now triggered the Sahm rule, which basically means we potentially are on the cusp of a recession. How concerned are you in the White House about that?
Well, we're not concerned about that specifically, in part because the unemployment rate that it grew from has been so historically low, and has been so historically low for such a long time. I believe even Claudia Sahm herself expressed some questions about whether the rule applies when you start at 4% or just above 4% unemployment rate. So again, we have to keep in mind, these numbers come in not in a vacuum, but as part of a overall picture of an economy that we've been talking about for some time, that did not happen by accident, that was not inevitable, in which there's been tremendous growth and an economic recovery that is frankly the envy of the world. And so we know that the work is not finished. We know that you don't get we don't stop doing the work that we've been doing. But one example of the effectiveness of the president's economic policies is that some of the growth is being driven by private investment into areas in which the president's Investing in America agenda has brought in public investments. And so those investments continue to hit the street. We'll continue to keep delivering them in different communities, and we'll continue to watch the numbers.
And of course, we're continuing to watch the numbers. We're also watching the stock market reaction right now, because we're seeing a big wipeout in futures. And the conversation that's happening among investors, among market participants, is this concern that the Federal Reserve is behind the curve, that they waited too long to cut interest rates. Is that the view of the White House as well?
I mean, we don't comment on Fed policy. I know they have, they've indicated plans and what they are likely to do. We still believe that this is an economy that, again, did not recover by accident, but also is one that reflects, the Biden-Harris commitment to working people. The real wages remain up over the year. They're still higher than the rate of inflation. This, as I've said over and over again, means more money in the pockets of working people. And some of the story that's not part of the labor market data is that we continue to see more workers join unions, more workers reach first union contracts, more contracts result in record wage increases.
U.S. Standing Labor Secretary Su says new jobs report shows sustainable level of growth.
Essential to a strong economy, which is that working people do well, working people share in the profits that they help create, and working people get a voice at the table.
We had Governor J.B. Pritzker, though, yesterday talking about the loss of manufacturing jobs in Illinois, calling on the Federal Reserve to move. If the White House is not going to take a stance, I imagine more Democratic leaders are going to come out and also say that this partially may blame the Fed, because it is an election year and they don't want themselves to be blamed. how concerned are you that Fed potentially acted in a way that means that more Americans would be losing their job?
I mean, manufacturing is a good example, right, of something President Biden has said from the very beginning, that we need to bring manufacturing jobs back to the
US
United
Acting
States.
Labour Secretary Sue says that the jobs growth at the 3-month average shows strength.
Powered this country's middle class continue to do so. Illinois is a place where, due to the UAW's historic contract, the president and I traveled to Belvedere, Illinois, talking about factories that are going to open that have been closed for a really long time. These reversals of decades-long trends that were not good for workers, that were not good for unions due to failed policy of the past cannot be reversed overnight, but we are seeing movement. And so that progress.
But Julie, many industries barely grew. Manufacturing, retail, information, all negative over the last 2 months.
If you look at manufacturing, since President Biden came into office, those numbers are up, and there's continued investments that we are making. If you look at construction jobs, those are also up. Those are two areas in which, again, federal investments are helping to drive that change, helping to drive that growth. And so we don't make too much of any one month, but when you look at the trend, those are both sectors that are up. Doesn't mean we don't have more work to do. Doesn't mean there aren't communities that remain devastated from failed economic policies of the past, that have failed working people, that have left working people behind. We remain committed to doing that work, and the overall numbers still demonstrate growth there, and we'll continue to put dollars into communities to rebuild them and bring jobs back.
And parsing through these numbers, it did seem that manufacturing payrolls did add 1,000 jobs last month, but to Anne Marie's point, that comes after 2 straight months of declines. I want to talk about revisions here, because on the top headline number, there was another revision to last month's number, and we've seen that increasingly over the past several months, that the prior month's numbers are revised down. And I'm curious what your thoughts are as to why that dynamic is unfolding, because again, the question among investors is, how do I trust these numbers?
Well, you noted at the top that this month's revisions were fairly minor. Revisions, I always say this too, are a feature of the numbers, not a bug. It's not an error. It's basically continuously these numbers get revised because it's the trade-off between getting out numbers quickly and getting complete numbers. So to get the numbers out every single month, as we do, it requires a certain amount of projection. And then once the real data comes in, because these aren't just numbers, these are actual people, right? They're people who respond to surveys. They're people who answer questions. They don't always answer them at the time that I come here to talk about it, and that's why we revise when we get the more accurate numbers. That has always been the case, and that is why the BLS data is the gold standard when it comes to labor market information.
If we have 4.3% today, where do you see the unemployment rate year end?
Well, I'm not going to make a prediction about that, but I will say, again, we look at everything in the context of the whole. And so GDP remains very strong. Layoffs remain relatively low. The labor force participation rate remains high. All of these are counter indicators. They're not indicators of recession. And so, of course, we keep an eye out. Of course, we have to keep on doing the work that we are doing.
OPEC oil output in July rose by 100,000 barrels per day from the revised June to 26.7 million barrels per day, according to a survey.
114,000 a month. There were, in the last administration, 7 months of numbers that were less than 100,000. And so, again, we're in a transition period. We've always said there would be. That was part of the plan. This number is cooler than expected, and so we have continued work that we need to do. And the investments in the President's Investing in America agenda are going to be really key to continue to power our strong economy.
Well, we have to leave it there. Really appreciate your time on this busy morning. Our thanks, of course, to Acting Labor Secretary Julie Su and, of course, Bloomberg's Anne Marie Hordern. And later today, catch our exclusive interview with Chicago Fed President Austin Goolsbee. That's at 12 p.m. Eastern. But don't go anywhere, because right now, Rick Reeder, he is the Global Fixed Income CIO at BlackRock. He joins us now. And Rick, my first question to you, has the Fed made a policy mistake?
So I think the price for interest rates is wrong today. I mean, should they have moved? I don't know that they were set up to move, given what they had told the market prior to this. That being said, if you're running, inflation is running 3-month moving average of inflation is pretty darn close to 2 by almost every metric. And if you've got slack building in the labor force, which we knew prior to this, 5 3/8 is the wrong funds rate when you've got inflation running at certainly low to mid twos. So, yeah, I think they're behind the curve, and I think this price for rates is not consistent with where the economy is today. Certainly not consistent with where inflation is today.
Rick, when you look over to September now, and if you look at market pricing too, it's starting to think so as well. Do you think that they're needing to go 50 basis points to really get caught up to where we're seeing the market headed?
So I don't know. I mean, there's data between now and then. I'm not sure today. If you ask them today, are they going to go 50? Listen, some of why you're seeing the increase in the unemployment rate is you're actually expanding the labor force. I mean, so much labor has come in to the labor force that's outpaced the amount of job creation, or quite frankly, it's getting those people integrated into the labor force. So I think the economy's still in pretty good shape. Is it slowing? Yes. Should the rate be lower? Yes. Would I do 50? I would do 50. I would have cut by June. I just think they need to get the rate to, if you got the interest rate to 4.5% quickly, that is much more consistent where the economy is and where inflation is today, and they should get there.
Well, let's talk about the reaction in the bond market, because the rally has been absolutely breathtaking. You take a look at the 10-year Treasury yield now, well below 4%. Rick, you and I spoke after the June numbers came out. We were at 4.4%. You think about where we are right now. Even with that in mind, what the Fed probably should do here, do you think that this rally has gone too far?
So what's pretty extraordinary is the markets have basically ignored what the Fed's saying. The markets have said, the Fed's behind. They're just going to have to get there. And so it's pretty remarkable how far the markets have come. I still think it makes sense to own interest rates. We talked about last time we were on. You keep owning the belly of the curve, hold this yield in the belly of the yield curve. How much the front end has moved for the Fed to fulfill that obligation? They're going to have to do 50, and they're going to have to move at every meeting subsequent to that. Listen, has the front end moved a bit too far? Maybe, but I'd still own the belly of the yield curve, and quite frankly, I'd still own yielding assets and hold them for 2024 and probably into the next year.
And speaking of the next year, you think about the play on duration here. If you're holding the belly, how do you feel, Rick, about the longer end of the curve, given that growth scare is the pervasive word of the day, and there's a lot of concerns about what an election could mean, what the fiscal situation of the United States could mean, and what Treasury issuance looking like into next year could mean?
I feel less good about it than I do the belly of the yield curve. I mean, the belly yield curve is the fulcrum point of where the Fed's got to go. Listen, the Treasury, like you said, it's got to issue an awful lot of debt. If you're a pension fund, you're an insurance company, you have liabilities trying to defease a liability stream. Would you match it longer out the yield curve? I guess so. But if you're not, I mean, the belly yield curve is where you want to be. I mean, I think the curve will steepen. Obviously, we've seen a significant steepening from here. I think it'll take some time. You see the demand in some of these corporate deals. You see the lack, when you take out the Fed's balance sheet, the lack of available supply in the back end. It keeps the curve flatter than it should be. But will it steepen? I think it will continue to steepen. I just think it will take some time.
All right, Rick, we are just getting started. Stick with us. We're going to take another quick check on futures right now because it's ugly. You take a look at where we're trading with about 15 minutes to go. 1.3% lower on the S&P 500, 2% lower on the NASDAQ 100 in the pre-market. Small caps just taking a beating here, down 3.3% pre-market. You take a look at some of the individual moves. That's actually shocking to look at in some cases. You take a look at Intel, down 24%, close to 25% after that disappointing earnings report last night. Amazon also down about 9% pre-market with big plans to spend, and Nvidia continuing its sell-off, currently down about 4% pre-market. This is Bloomberg.
this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
A look at what's making headlines around the world. President Biden told Israel's Prime Minister Benjamin Netanyahu to agree to a ceasefire with Hamas on Thursday. The relationship between the two has been strained by the conflict as the White House's frustrations have grown over the continuation of the war in Gaza. And Vice President Harris raised a record $311 million in July, doubling Republican nominee Donald Trump's haul last month. The campaign for the presumptive Democratic nominee begins in August with $377 million in cash on hand, giving her the biggest war chest at this point in an election cycle. And Pennsylvania Governor Josh Shapiro has the edge in the race to be vice president, Kamala Harris's running mate in the upcoming presidential election. The 51-year-old has displayed agility and appeal. He could help to deliver a key state in the race and has consistently won his governorship with increasing vote shares, Katie.
And we're back now with Rick Reeder. He is Global Fixed Income CIO over at BlackRock. And Rick, I'm an ETF person. You increasingly are too. You manage the BlackRock Flexible Income ETF, ticker BINC. What's interesting to me is that you've held this consistent 40% allocation to high yield. And if we're in a situation where the Fed should maybe cut interest rates by 50 basis points in September, are you thinking about adjusting that allocation?
Not really. I mean, quite frankly, I think I said last time we were talking, high yield is not junk anymore. High yield market's in pretty good shape from a credit perspective. They term their debt out. So I still like owning high yield. What I like doing is owning it in yield, i.e., historically you think about spread. A lot of people think about what the spread of high yield is. I mean, these yields are super attractive. Part of what I'm pretty comfortable with today, or very comfortable with today, rates are coming down. They should come down. And then if you just hold this yield, I mean, I think people a year from now are going to say, gosh, I got to buy high yield. I got to buy, like you were saying, I think we're creating almost 7% yield by buying some high yield, buying some investment grade credit, agency mortgages, creating some balanced AAA CLOs. Gosh, those yields are pretty darn attractive. In a world where the equity market's clearly more uncertain, gosh, clipping that sort of yield still feels pretty good to me.
Well, you are seeing finally a little bit of spread widening. They have been super, super tight. Rick, when you see spreads start to widen, where do you start to pick up more at this point? Do you have more of an inclination to even dive in, given that people do expect a rate cut at this juncture?
So, I mean, I like owning the assets. I think the comment, we own them. We like high yield. We definitely buy more. We'd like to see, quite frankly, the price come down. What's happened is obviously rates, treasuries just rally. The market moves up a bit, doesn't move up that much. So spreads optically widen out or actually widen out. I'd like to just see the price come under a bit of pressure, a la what's happened in the equity market, and then we would definitely add some more. I mean, I'm very comfortable. The technicals, people don't realize. You talk about total supply we get in Europe. I think we get 8 to 10 billion a month in European high yield. US, you get 20 to 25 billion. We're getting 400 billion a week of Treasury bills. We get 100 billion on average of coupon supply in Treasuries. There's just not that many bonds. in the high yield market.
Right.
So I'm hoping they come under some pressure.
So Rick, you're waiting for those bonds, of course, to go on sale. What's going to cause that? If we haven't seen that sell-off start already, like we're seeing in the equity market, as you pointed out, what's going to be the catalyst?
The only thing, I think most people feel like U.S. economy, while clearly slowing, while clearly moderating, it's still in pretty good shape. If you felt like we were going into recession or deeper recession, then would you start to say, gosh, I'm going to manage a bit more of my credit risk? I think so. But I still think we're pretty far from that. Even take consumer slowing, we see that. The labor market is slowing. You still have tremendous amounts of CapEx, R&D spend. Like we said, we're expanding the labor force. Part of why this unemployment rate's going up, you're expanding the labor force. That actually helps instigate better levels of nominal GDP. So if you felt like we were going into deep recession, which I'm certainly not seeing in terms of the data, then you would start to bring it down. But I think we're far from that.
Rick, I want to go back to the Treasury market here, because in addition to the moves that you've seen in the spot market, the swaps market also looks pretty drastic. Pull-up function WIRP on the terminal, and you now have traders really pricing in more than 4 rate cuts this year, including more and more of a possibility here of that 50 basis point cut in September. Goodness knows if we get there. Do you think 4 is even possible, let alone reasonable, or what would amount to 4 given where pricing is expected to be at the end of this year?
So I think it's somewhat ironic. If you ask me, I'd say yes. If you ask the members of the Fed, given what they are articulating publicly, I would think they would tell you no, or at least that's not their predisposition today. But yes, I think so. Like I said, I think you've got to get the funds rate down to 4.5, and I think you should get it there. It's the wrong price today. So is it a possibility? Yes, it's a possibility. Listen, I think the Fed would still like to be deliberate. I still think they would like to see more time, more confidence. But would I do it? Yes, I think, and I think the markets are clearly suggesting to the Fed that it's time to go and it's time to move that rate down faster and more profound.
Square the square here for me, Rick, because if you believe that rates are still too high, what else breaks in this market as we wait for that first cut, even second and third cut?
So I'll tell you what's breaking is play out. I mean, the reason why the rate is clearly wrong is you look at the retailing data, the travel data, lower income is getting hurt by these rates. You look at credit card charge-offs, you look at loan delinquency, auto loan delinquencies, is a very consistent message across retailers, across travel, across auto. It's very clear that lower income, if you're a borrower, this rate is quite restrictive. What's happening in an economy today that's not that in aggregate that reliant on interest rates, but a big part of the population is, and that's what you're seeing. I know breaking, but you're seeing some pressure there, and which I would argue is too intense relative to where the economy is and clearly where inflation is.
Rick, we have 30 seconds left with you. Let's talk quickly about cash, because a lot of people are still happy to sit in cash right now. Is that trade over, though, as you think about what the next month or so could bring?
I mean, I still think cash deserves a seat at the table. I mean, when you got markets this volatile and you're still getting, because of the amount the Treasury has to issue, because of where the funds rate is still too high, cash deserves a seat at the table. I think that seat at the table should be pulled a bit further from the table, if that's the right analogy. I think listen, would I lock in these yields and get a bit longer on the curve? We talk about the belly. I would. And you start to see that certainly over the last month. You're seeing flows come in and people start to move out. But yeah, I'd still own cash. It's, it dulls beta that you see in some of the equity market, but lower than before.
Rick, we got to leave it there. Perfect day to have you. Of course, stunning moves in the bond market. That is Rick Reeder of BlackRock. Stick with us. This is Bloomberg Open Interest.
in recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that started in 1977 when by then I had a little research station and 4 of my students were kidnapped and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to
So 1 minute now to the US cash equity open and the market on open imbalance.
from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
We are moments away from looking like it's going to be a brutal start to the trading day. This is Bloomberg Open Interest. I'm Katie Greifeld. Not quite a happy Friday, of course.
So we're looking now to the market on open imbalance. S&P 500, 525 million to the sell side. NASDAQ 100, 45 million to the sell side. Dow 30 stocks, 5 million to the sell side. Mag 7 stocks flat at just 1 million to the buy side.
If this holds. So let's take a check now on the major averages, because you have the S&P 500 currently off by about 1.4%, but big tech is really where you're seeing a lot of that pain. The NASDAQ 100 currently off by about 2% or so, but all of that selling, the real brunt of the action right now is in the small caps, your smaller companies in the Russell 2000 currently off by about 3.3%. But let's get back to earnings and 2 stocks to watch in the oil market. Chevron missing estimates and announcing it's moving its headquarters to Houston. Meanwhile, Exxon surpassing expectations after the acquisition of Pioneer. You're not necessarily seeing that in the share prices, Shonali.
Taking a look at the big tech names, also reporting Apple finally getting a breather up actually at the open, about 0.6, 0.5% roughly. Amazon still dropping more than 9%. Listen, Intel dropping 25%. Katie, you're looking at the worst drop.
So Amazon shares down 10% on the open here, raising $197 billion in value.
With Bloomberg Technology co-host Ed
A
Ludlow.
NASDAQ composite seen on a correction course, sinking 10% below its record closing high now.
The same story, capital expenditures, the numbers more than $30
The
billion.
US stocks extending their fall across the curve here. Dow Jones down 1% as well.
For investors, stock down 9.5% is simple. They still don't see the translation to direct top-line growth, specifically from selling stuff that is AI. You know, AWS top-line growth 19%, exceeding expectations. That's great, but it's the money machine formula that we've been talking about all week.
Also, Intel plunging 26% on its biggest drop since 1982 following disappointing earnings last night.
Spending on AWS, right? Which of course is sort of the bright spot there. It's interesting to compare and contrast these reactions to what we saw from Meta, for example, because that was a stock where it seemed like investors were okay with that big capital spend.
So the point of absolute similarity is that you call it infrastructure spend or cloud. They're building data centers. It's an expensive enterprise. Meta's not a hyperscaler, but it does control its own infrastructure spend more directly. what they were able to show in Meta's case is that AI is helping the pricing on the ad side. So the core legacy bread and butter business is actually pretty good. In case you don't know, there's a social platform called Facebook, and it makes money with ads. And,
I've heard of that.
One was reminded of that this week. Yeah.
Listen, I want to point out here that the NASDAQ 100 falling 10% at the open means that it's sent to enter a correction territory here.
Yeah.
Intel today being the worst of the decliners in that NASDAQ 100.
Yeah.
Give us a little sense of how deep the pain is there. I mean, the drop you're seeing today is staggering.
This is very bad for Intel. It's very bad. And when the numbers dropped, the CFO, Dave Zinsner, phoned me, and basically the admission is that they had not, in a timely manner, adjusted to the reality of their revenues. Their core businesses are not doing enough to support what they want to do, which is move into data center. They're overexposed in the CPU market, when what we just talked about is investment in GPUs. And so they have to cut headcount 15%, adjust OPEX and CAPEX, and make some very painful operating decisions to protect cash flow to change this business going forward. The turnaround plan, unfortunately, is not working right now.
And I have a great guest sitting to my left, but can I just say it's been so lovely to have you in New York this week?
It's been really good to sit here next to you. It's like Super Bowl week for me. And it happens 4 times a year, but it's been great. Yeah.
Come back to New York every time for it.
Ed Ludlow, it's great to see you. That, of course, is Bloomberg Technology co-host Ed Ludlow. And joining us now, also, I'm thrilled to say, we have Savita Subramanian. She is head of U.S. equity and quantitative strategy over at Bank of America Securities. Great to see you in person.
Great to be here.
Let's talk about tech.
Oh, goodness.
It feels like for so long, at least the last couple of years, that tech has been the safety trade. When you would see an ugly jobs report like this, you just go into the big FANG stocks. Now we have not so great earnings.
Right.
Is tech still the safety trade?
Well, look, I think parts of tech are still a safety trade. And I think what we're seeing right now is pretty classic. You're seeing software, which is more defensive, hold up better than semis, which is more cyclical. We are seeing some of the more crowded areas of the benchmark get sold off harder. And I think what's interesting in tech is that companies that are beating on sales are outperforming companies that are beating on earnings. So it's not just about margin, it's about top line. But I think the problem is we're at a point where all these, these tech companies and the Magnificent Seven and this AI theme has been kind of buy the story, and now it's show me the money. And that's where we're seeing real differentiation between companies that are doing things well. As your former guest was pointing out, some companies are actually monetizing their CapEx. They're seeing better pricing. Other companies aren't. And that's where we're seeing this differentiation.
So where are you seeing the strategy behind some of these pullbacks? You look at some of the exuberance finally popped out of the market, but is there kind of more pain still to come given what we're seeing in the economic data?
What I think is very interesting is that if you look at cyclical pockets, it's more of a tech sell-off than an actual cyclical, kind of collapse. And I would highlight that within industrials, you're seeing machinery companies, which would typically do quite poorly if it were just an economic malaise story. Those companies are actually holding up better than semis, which is unusual. So I think we're actually seeing a bit of a trade down or a sell-off in secular growth as well as cyclical tech companies. And I think that's where it gets a little bit more interesting. I like areas like industrials because I think there is this strong and longer-term story about a CapEx cycle outside of just AI and chips. There's, infrastructure and grid and bridges and, the entire U.S. needs to be refurbished. But I think this tech sell-off is telling us that the secular growth story is maybe petering out. We are seeing more CapEx and less free cash flow. We're seeing, kind of the end of just this, wonderful period of cost cutting and just reaping sales benefits for tech companies.
Well, not to almost immediately go to politics, but you talk about that longer-term CapEx trend that you're seeing in the industrials. And I have to ask, if we get a new administration in November, now either way we're going to, does that potentially put that story at risk?
I don't think so. So we've done a lot of work looking at how much of this CapEx story is driven by fiscal stimulus versus just, kind of traditional spending. And I think there's an argument to be made that fiscal stimulus is not necessarily what's going to keep this going. In fact, when you look at fiscal spend as a percentage of total CapEx is just a tiny fraction of what companies, of what, the overall capital spending and business investment story is that's taking place. In fact, I think it's less than a tenth of total CapEx over the next 10 years. On top of that, you've got tech companies spending on old economy CapEx, building out data centers, and requires a little bit of, other stuff besides just tech CapEx. And we've got an environment where both sides of the aisle are focused on bringing IP back to the U.S. and bringing jobs to the U.S. What does that mean? Activity in the U.S. has basically doubled from 2018 to now in terms of driving and moving stuff around, and that is taxing the infrastructure, which is already super old, right? I mean, you look at our economy, our manufacturing complex.
You take the subway.
Exactly. Take the subway as a case study in old infrastructure. I think that's the story here.
I want to talk a little bit more, not about the fiscal, but the monetary as well. What would one rate cut really mean for the market? You have Michael Hartnett over at Bank of America as well. With you guys saying that the first rate cut should mean you should sell stocks. It would be a signal of a hard landing. How do you see this?
I think it's nuanced. So I think that this is a different rate cycle than prior rate cycles. I think the Fed is kind of, at a point where they're trying to normalize rather than really juice up the economy. The economy is slowing, but I don't know if we're at a point yet where we really need to worry about a hard landing. I do think that we are seeing some of that nervousness around the economy playing through right now, and that might make the first Fed rate cut less extreme. In fact, the old kind of playbook is buy on the rate cuts, and I think that might be, kind of more of a story for maybe next year, but our target for the S&P is 5,400, and we're sticking with that. We didn't raise it as the market shot past it. I would stick with it today unless we see demand, consumer, all of the attributes, and business investment really fall off a cliff. So far, CapEx has been strong, and I don't think it's changing.
And just to go back to that point, buy on the rate cut, that was also supposed to be the playbook for small caps.
Yes.
And I'm almost scared to look at what the Russell 2000 is doing right now.
The Russell 2000 is a different animal than in prior cycles, and I think that's what we need to remember. The Russell 2000 used to be small, economically sensitive companies that would benefit from a growing economy. Today, it's half that, but also half a graveyard of old large cap companies that have refinancing risk.
Fallen angels.
Fallen angels, exactly. Those can do all right in a Fed rate cutting scenario because their refinancing risk is capped and mollified. But I think the idea of small caps just being this monolithic structure that's all going to do the same thing in a rate cut scenario is not necessarily the case.
Savita, stick with us. Of course, we're going to get right back to you. We're going to take a check on the markets, though, because, of course, as Katie has been talking about, we are looking at an ugly tape. We are looking at an S&P 500 down 1.3%. NASDAQ 100, 1.6% lower, really flirting with correction territory here. The Russell 2000 is just taking a beating at 3.5% lower. On the week, it's nearly 7% lower. We'll bring you more as we have it. Stick with us. This is Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg.
This is Bloomberg Open Interest. A quick check on stocks here. Of course, we're looking at a tough tape. A lot of red on the screen here. The S&P 500 down 1.3%. NASDAQ 100 looking at correction territory, 1.7% lower on the day. Russell 2000 down 3.4%. Katie down roughly 7% on the week.
All right, it's time now for Top Calls. Some of the analyst action in focus this morning. And first up, Oppenheimer is upgrading Blue Owl Capital to outperform after the company saw its worst day in a year yesterday. The analyst sees a rare, attractive entry point for the company. Next up, Intel getting a downgrade, a number of downgrades today. HSBC cut its recommendation on the stock to reduce, while Raymond James downgraded it to a market perform. Now remember, the U.S. chip bellwether missed earnings estimates. It announced 15,000 job cuts, also suspended its dividend beginning in the fourth quarter. And finally, Wells Fargo analyst Mike Mayo downgrading Morgan Stanley to underweight, also trimming his price target. He cites caution over the bank's significant valuation premium, Shonali.
And back with us is Savita Subramanian, head of U.S. equity and quantitative strategy at Bank of America Securities. And I want to ask you how you think about a day like today. You see the tech sell-off underway. Is this a moment to let it breathe, or do you start to dive in and start to buy these dips in certain names?
I think you do buy the dip in certain names. I think this is a very stock-specific environment. So, as I mentioned, I think we're in an environment where you really need to see that monetization story for AI play out. And we're actually seeing that. Some of the tech companies that have done really well over the last few weeks have been companies that have exhibited that ability to turn investment into profitability and pricing. I think there's also a big pocket of stocks that look very interesting right now, which is dividend yield. So let's say we're in a risk-off environment, which it kind of feels like. What does well when the market's tanking? You want to be paid in total return, clip a coupon. And right now, even with the Fed cutting interest rates, I think there is a bigger demand for dividend yield. Because if you think about all the cash sitting on the sidelines making 5%, that 5% is going to drop when the Fed starts cutting, and we think they start, later this year. Where do these retirees go for real returns? I know bonds are offering a pretty high 10-year yield, but on a real basis, that's really more like 2% if you take the yield and subtract inflation. retirees need investments they can live off of, and dividends offer real returns. They're inflation protected, and I think that's a great theme to hide in.
On the CapEx story, you've been talking a lot about it. What do you think about this investor sentiment changing here around the CapEx story for big tech? Do you agree that it should be punished the way it has been?
Well, look, I think that big tech spending, the hyperscalers, is a huge chunk of CapEx, but even outside of that, you're seeing CapEx from other areas. And, you know, I think that we're kind of setting ourselves up for an old school CapEx cycle, because where we are now, we have extra activity in the U.S. The U.S. infrastructure actually receives a C- in terms of, you know, its health. And I think that's a huge liability for all of these cities and municipalities that are trying to court people and jobs and companies to move to their locations. So I think there's almost this must-do CapEx cycle just to keep that story going. And again, that gets political support from both sides of the aisle. Both sides of the aisle want jobs growth in America. They want manufacturing in America. They want IP in America. They want tech dominance. I mean, another reason that I don't think we're going to see a lot of regulation for these tech companies outside of consumer protection is the idea that the U.S. definitely wants to keep its pole position as the tech leader. And regulating these companies to the point where they are no longer competitive with other regions, I think is a hard to argue stance.
Savita, I want to go back to just the price action, because again, just watching this sell-off materialize in the S&P 500, also in the NASDAQ 100, it looks like we're down more than 10% from all-time highs. Correction territory.
Correction.
Could we be heading to bear market territory?
I mean, okay, so far our S&P indicators are telling us it's going to be okay. But we have a set of 10 indicators that we look at. 5 of them are flashing red. Usually ahead of these full-fledged bear markets, you see 7 or more indicators go off. So we're not necessarily at the point of absolute, you know, anathema for equities. I do think that part of the reason is that when you look at high yield investment grade, healthy and really kind of unusually healthy, maybe the cycle's a little bit different in that a lot of the lending and the low quality lending activity took place outside of the traditional lenders and really took place in shadow lending, private equity, private credit. Those are the areas I worry about from a kind of a full-fledged risk-off perspective. But I think that publicly traded U.S. equities at least are pricing in the current environment when it comes to rates, inflation. You know, private equity, private credit, unmarked, who knows? You know, it takes a long time for these things to really reveal themselves, but that's where I see more risk.
Oh, you are playing at my heartstrings with that conversation. Savita Subramanian, we have to leave it there, but what a day to have you, of course, at a Savita Subramanian of Bank of America Securities. And coming up, we're going to talk about JP Morgan CEO Jamie Dimon. He's calling for private sector representation in the White House in his latest op-ed. Is Jamie Dimon running for Treasury Secretary? We're going to discuss what's happening next in today's Wall Street Beat. This is Bloomberg.
In 10 minutes time now at the top of the hour, we see the release of the US factory orders month over month for the month of June. Forecast minus 3.2% on the prior minus 0.5%, with a range of 3.2% to minus 3.6% expected. Revised durable goods numbers forecast minus 6.6% on the prior minus 6.6%. Core durable goods also looking to be unrevised 0.5%.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
inspired by the fusion of East and West,
I'm the the ambassador of the tomorrow.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend, only on Bloomberg.
This is Bloomberg Open Interest. Let's take a quick check on this stock market right now. About 20 minutes into the session, still doesn't look too good. The S&P 500 down about 1.4%, more so on the NASDAQ 100, off by about 2%. But if you think that's bad, take a look at the small caps. The Russell 2000 currently off by about 3%, Shanali.
We were off of session lows, at least for the Russell, but it's looking pretty grim over there in the NASDAQ 100, of course, in correction territory, as you had mentioned. And it's time now, switching gears, we're going to talk about the Wall Street beat. Today, we're looking at Jamie Dimon's call for private sector representation in the White House in an op-ed in the Washington Post. He outlined a series of measures. Joining us now is Bloomberg finance reporter Catherine Doherty to talk about Jamie Dimon's call here and his motive.
Bank of America sees Fed cuts now starting in September versus December previously.
The motive, because what does this all say about his mission moving forward? He has been much more intense about succession planning at JP Morgan, and realistically, he could be a Treasury Secretary at this point in either potential White House.
That's right. So the leader of the largest U.S. bank, he's not speaking like a banker. He's really sounding like a politician here, which is, I think, the tone of this piece is what struck me the most, is he's not calling on either candidate, really, or aligning himself with either party. He's speaking about the unity of what he hopes America will be in the future. And I think he's being very strategic about how he's coming across in this message, so that if either candidate is picked, no matter what administration we see in November, he could potentially take a seat as the Treasury for either candidate.
It's pretty funny, right? He's kind of playing both sides here, but of course not endorsing either candidate. What did he have to say when it comes to actual policies, though?
So he really focused a lot on economic inequality. He points out that there's a lack of policies with mortgages. He says that's a very simple fix. You could give those who have trouble or affording a home the ability through mortgages and just tweaking the economics behind that, which is something that possibly a banker would think about. That is one solution. He's also calling on the border policies to be tougher. He's calling on the stance with immigration, having just to take a harder stance and to develop policies that aren't so wishy-washy. Those are not his words. But I think that there was a call for just better policies and planning, and to be more clear going forward for either candidate.
So in 5 minutes time now at the top of the hour, do you see the release of the US factory orders month over month for the month of June?
He's not the only one, by the
Forecast minus 3.2% on the prior minus 0.5%, with a range of 3.2 to minus 3.6% expected. We also get the US revised durable goods numbers, a forecast minus 6.6%, unrevised from the prior minus 6.6%, and core durable goods also forecast at 0.5%, unrevised from the prior 0.5%.
And how there's not a clear candidate that is really pulling together the nation in this way.
Bloomberg's Catherine Doherty, we thank you so much for your time here. Of course, a very highly watched letter there from Jamie Dimon in the Washington Post. Now, also part of the Wall Street beat, want to take a quick check here on Ares Management Corp, dropping about 4% after reporting earnings this morning. Interestingly enough, the earnings beat expectations, but I did have a conversation this morning with the CEO on the impact of rate cuts. And something interesting, Katie, that he told me is that he thinks the capital markets, and I quote, will rip if you finally see those rate cuts, he says there will be a pretty significant amount of relief in markets and that transaction volumes are picking up already in anticipation of that relief.
Yeah, I think a lot of people would agree with him this morning, especially in the public markets too. I mean, you think about what we're seeing across the board when it comes to the indexes. We're going to continue to talk about that next hour with Max Kettner. He is HSBC's chief multi-asset strategist, why he isn't terribly concerned about a slowdown. This is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day.
1 minute remaining. I'll be leading with US factory orders month over month.
May have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close. Welcome to Balance of Power.
This is Bloomberg.
Ten seconds. -3.3%, -3.3%, lower than forecast, -3.2%. Durable goods revised, -6.7%, -6.7%, lower than forecast, -6.6%. Core durable goods revised at 0.4%, 0.4%, lower than forecast, 0.5%.
Continue the string of disappointing results this earnings season. Apple really wavering this morning, though. We'll keep an eye on all of it for you. An earnings miss for Chevron as the oil giant quits California for Texas. An interview with the CEO just a moment away. Katie.
And let's get a check on these markets right now. As I mentioned, not too pretty. The S&P 500 off by about 1.6%. That NASDAQ 100 sell-off picking up a little bit of steam here. Currently down about 2.4%. We're going to end up with a pretty ugly weekly drop there. And then you take a look at the bond market. At least you have your bonds acting as a haven this morning. The 10-year yield currently lower by about 13 basis points. We are well below 4%.
And of course, we have an even starker move in that a 2-year yield. Also, just wanted to point out durable goods orders also out. Orders falling 6.7% month over month. The estimate had been for 6%, so a little more than expected. And June factory orders also falling 3.3% month over month. The estimate was 3.2%. More signs of weakness in this economy. And acting U.S. Labor Secretary Julie Su joined us last hour on the jobs data. Take a listen.
We continue, know that there's continued work left to do to make sure that we maintain a strong economy, but we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
Let's get some thoughts now on the week payrolls number with Max Kettner, HSBC Chief Multi-Asset Strategist. Max, the last time we spoke, I think it was on a green day, and you're looking at today, and the sell-off is pretty swift at what you're looking at here. Have your thoughts changed at all about the direction of travel given the latest data?
So Bank of America now expect the US Federal Reserve to deliver a 25 basis point rate cut in September.
Yeah, I don't think our fundamental view has changed an awful lot, actually. A lot of it, I think, is positioning driven. When we look at CTA positioning, for example, in equities, that was as long equities as has last been during that mean craziness in summer 2021. So there's a bit of positioning clearing. We are, of course, seeing most of the setback is driven by tech, right? So it's not really driven by the most cyclical names and then getting beaten up. No, it's mostly really a tech-driven sell-off. It's mostly that repositioning, that sort of overhang that we had from systematic investors. And honestly, when we look at the fundamentals, even at the payrolls today, I get it. Yes, they've been weaker than expected, but it's not like we've lost 100,000 jobs. In fact, when we look at something like challenger job cards, they're still almost as low as the absolute lows from the 2010s, which I think were sort of December 2015. When we look at the layoffs, the number of layoffs, they're still lower than the absolute lows from the 2010s. So what we're not seeing is that the unemployment rate is going up because really companies are shedding jobs everywhere. I get it that, the job cards from the likes of Intel, they're grabbing the headlines, but on aggregate, we're not seeing those broad-based layoffs yet. And that doesn't, for me, change the fundamental bullish picture then.
So, Max, you think about the phrase of the day, growth scare. It sounds like you're not quite buying into that.
No, absolutely not. I don't buy into it. I do think that actually the 50 basis points rate cuts in September, that is now being touted, that is really a bit overblown, that those fears or even fears of an intra-meeting cut that really aren't justified. Think about Q2 GDP growth. We saw an almost 6% nominal GDP growth. I don't know if that qualifies as recession. I don't know. I might have skipped my lectures at uni too much then. But when we look at the earnings season, of the Q2 reporting season, we're talking about a 14% earnings growth year over year. We're talking about it that it's more broadening out. We're seeing an almost 80% beat rate. We're looking at sort of surprise factors on the earnings side of more than 4.5%, which is bang in line with average. So on aggregate, things are still pretty fine, right? They are decelerating in some pockets. There are some cracks in some pockets, absolutely fine. But that doesn't automatically equate to a recession is coming.
So what is the trading strategy at this point in time? To the point that you're making here, it's pretty interesting. If you look at the S&P 500 today, you do have most sectors here in the red, but you do have a little green on the screen. And in some areas of the consumer, you still see some green. In real estate, so interest rate sensitive sectors, if you get a relief, then perhaps you can see a tear. In some of the more badly beaten sectors, is there still a rotation to be had? Even if that rotation may not be the same type of rotation that we've seen maybe even just a week ago?
Yeah, I don't think that rotation from a week ago still makes sense. I really don't think that sort of Russell 2000 or US small cap rotation made an awful lot of sense, because if indeed growth is slowing and you're buying small caps just because of the notion of lower yields, then that's really just on borrowed time. So I don't think that rotation into the Russell, where it was really, let's remember in the Russell, there's almost 40% of the companies that which the debt is on a floating rate, so slightly higher yields, pricing out 50 basis points of rate cuts in September would really hurt them. And we know that almost 40% of the companies don't make profits. So that rotation doesn't make sense. In fact, I still am pretty positive, and we continue to be pretty positive on the tech sector. Whereas, three weeks ago, it was all about AI, and it was all about AI, and everything was great. Now it's all about, well, are they really making money out of it and all this sort of stuff? Well, in fact, that correction, what we've seen right now, that positioning overhang that is now being cleared, that's probably more of a healthy correction. And you probably want to more lean into that rather than really throw in the towel there.
All right, so there you go. Some pushback against that story that we've been hearing. Again, people really shying away from that big spending going on at the tech names. I do want to point out the VIX. I was kind of ragging on it earlier in the week, but it has skyrocketed over the past few sessions, currently trading at 22. That is the highest level in at least a year, Max. I hear what you're saying about positioning clearing out. The fundamental story is still there, but you think about the volatility being injected back into this market. How do you handle it over at HSBC?
Well, in fact, it means that we're very close to buying opportunities. It really means that we're much closer to the end of the dip rather than the beginning of it. What we've done was a study a couple of years ago where we looked at forward returns, not only of things like EM equities or credit, but most plainly equities over rates, equities over treasuries. So when is it time to buy the dip when the VIX goes up? And usually the threshold starts to be sort of 23, 24. Once we start going over 23, 24, then really sort of 3-month forward returns of equities relative to fixed income start becoming really, really favorable. So given that we're almost now, as you've just shown, we're almost at 23 in the VIX, we're much closer to buying territory now rather than throwing in the towel.
All right, Max, really great to speak with you. A real different perspective here from what we've been hearing this morning. So appreciate you making the time for us on this Friday. That, of course, is Max Kettner of HSBC. Of course, we have much more on the FOMC throughout the day. At noon, we'll be speaking exclusively to Chicago Fed President Austin Goolsbee. Meanwhile, let's take a check of these markets, take stock of what's happening. The S&P 500 now down by more than 2%. The NASDAQ 100 accelerating as well. That sell-off underway, nearing in on a 3% drawdown for the day. All the while, you actually have the bond market rallying, providing a little bit of that haven buffer. 10-year yields currently down by 15 to 16 basis points. Meanwhile, let's take a quick check of some of the stocks really driving the action today. Good news on Apple, it's up 1.6%. So we do have some green there, but that's, of course, outweighed by what we're seeing in Amazon with shares down 12%. Even though you have the Max Kettner view, investors broadly spooked by just how much money they're spending. Then Intel, of course, down nearly 30%. Now coming up, Chevron earnings disappoint, and the company announces plans to move its headquarters from California to Texas. We'll hear from the CEO next. This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
I want to take a quick look here at the two-year yield because, of course, you started the week at normally around 4.4%. You are down now to 3.9%. There was a 21 basis point drop-off today, and you saw that hold really after that jobs print this morning. Just a stunning move in the bond market and a recalibration of expectations heading into the September Fed meeting. Now to high interest, a look at what's making headlines around the world. On front pages around the world is the news that Evan Gershkovich arrived home in the United States yesterday to a hero's welcome. The Wall Street Journal reporter and 15 others were released by Russia in exchange for 8 Russian prisoners. The president and the vice president greeted them after the largest prisoner swap between the East and the West since the Cold War. And JP Morgan CEO Jamie Dimon said the next U.S. president must work to bring together a deeply divided nation as issues mount at home and abroad. The banking boss also said that the business world should have representation in the cabinet in an opinion piece published today in the Washington Post. And President Biden told Israel's Prime Minister Benjamin Netanyahu to agree to a ceasefire with Hamas on Thursday. The relationship between the two has been strained by the conflict as the White House's frustrations have grown over the continuation of the war in Gaza. Katie.
Meanwhile, in the energy sector, Chevron missing profit estimates despite record production in the Permian Basin. The company also announcing plans to move its headquarters from California to Texas. Now, the disappointing quarter adding pressure to the company's $53 billion effort to acquire Hess. Bloomberg's Alex Steele caught up with Chevron CEO Mike Wirth.
We had some higher maintenance. We had a couple of events at LNG facilities that required maintenance during the quarter, which brought liftings down. And so it's a little bit hard, I think, for analysts to anticipate that. We tried to communicate those events, but we had that. Refining margins came off hard in some of our key markets. And then there were some one-time items, well write-offs and tax items that are very difficult to forecast. So these are non-recurring items that made the quarter a little bit light versus expectations, but the underlying execution is good. And as I said, the growth remains strong.
So now you don't have to wait till May 2025 for the arbitration to work out when it comes to that Hess deal. Why is this taking so long? Like, if it's a simple issue or it's an issue of scheduling, what's the problem?
Well, international arbitration often is a lengthy process. Selecting the arbitrators, getting schedules aligned between all the parties and the arbitrators is more complex sometimes than one might expect. We do continue to see this as a straightforward contract interpretation question, and we continue to remain confident that the arbitration will affirm Hess and Chevron's interpretation of it. But you're correct; it is taking more time than we had originally anticipated, and that's unfortunately not unusual when you get into international arbitration.
Moving to some of the intricacies of the quarter, you mentioned it, that record production for Chevron in the Permian, which kind of leads me to you guys moving
VIX sits its highest level since March 2023 now, last up 5.44 at 24 points.
Business operations right now?
Well, it's really to be closer to the core, epicenter of our industry. Houston is the energy capital of the world. We have key partners that are there, suppliers, vendors, the universities that we do a lot of research with and recruiting from are there. And so it's a natural place for companies in our industry to have their home office and headquarters. And in fact, over the last many years, we've seen our Houston-based employee population go up and our California-based employee population come down. And this is really concluding a process that has been underway. We know how to work around the world in kind of a virtual environment, but there's no substitute for being face-to-face with people in terms of collaboration, innovation, mentoring and development, external relations and engagement. And Houston really is the place for our company to be for all of those reasons. We do have a big business footprint in Texas, which is now larger than our business footprint in California.
Citigroup now predicting a half-point Fed rate cut in September and November.
And it was where our largest business footprint is. And so that's certainly a change that has occurred. But the primary motivator here is to get our people together to increase engagement and collaboration.
So pro-Texas versus anti-California.
I wouldn't necessarily put it that way. I would, look, we've had some policy differences with California, and certainly California and Texas approach energy very differently. And so we speak up on that. We advocate for policies that keep prices low, that keep supply reliable, that encourage investment. And California's advanced policies that do the opposite. And so we've certainly expressed our views that we don't think that's good for the California economy. But this isn't a move about politics. It's a move about what's good for our company to compete and perform.
And I'm pleased to say that Alex Steele joins us now. Great interview, of course. And I have to say, I didn't know that Chevron was headquartered in California. It seems like Texas would be the natural home here.
It does. But remember, the Permian wasn't always the Permian. The Permian was just some rock that no one drilled. So now that that's become so important, whether through Exxon and the Pioneer acquisition or through Noble and a PDC acquisition for Chevron, it does make sense from that aspect. Also, now the U.S. is a huge exporter of energy, right? So it also kind of makes sense for you to be headquartered in the Gulf Coast, which is where so much is also being exported. Plus, they're starting a Gulf of Mexico asset, so that's really big for them now as well. So from that perspective, it'll be a slow, few years until this happens, but that's
so
part of it.
not necessarily politics that's driving them there.
I mean,
maybe
yes,
a little
no.
bit of everything.
Yes, no. I mean, I don't think politics helps any either at the end of the day.
I want to talk a little bit about the pressure here that Chevron is under when it comes to Hess. This is a massive $53 billion deal, a lot of delays. How did they really respond to that uncertainty?
I mean, the problem is it keeps getting pushed out, and that's really the problem. That it went into FTC review, yeah, sure. The arbitration was definitely a surprise, but that it keeps getting pushed out and the lack of visibility is actually quite difficult. And the problem is it just highlights what Exxon has and what Chevron doesn't. And if you're an oil investor, can you really own both of those stocks in your portfolio? If you can, great. If you can't, do you go with the one that has Guyana, or you go with
So
the one
looking
that
now
might
to
not
the
have
Fear and
Guyana
Greed
until May
Index,
of
28 out of 100 indicating fear. Crypto Fear and Greed Index, 57 out of 100 indicating greed. We're keeping an eye on the VIX as well, which is again up 32.6% now. It's around 5.44 points. It's up 24.64.
But he's going to talk pretty positively about that production profile. But you know what? It's still not Guyana, and that's really where the growth profile is going to be coming from.
Well, this goes to what you were saying in the commercial break, right, Shonali? Is this a pair trade that's developing? How are investors thinking about this?
I mean, I don't want to say yes, but I don't want to say no to that. I mean, I don't know if
you're doing a very good economist.
Yeah, thank you. I don't know if it's easy to be short Chevron, buy Exxon. I don't think it's that clear in any way whatsoever because, Chevron isn't just maybe Guyana. They do have a behemoth assets in the Permian. They have great stuff going on there as well. But that is a tough asset to then live without. They're going to say they can live without it, but still.
Can you explain a little bit more behind the stock move today? Because ultimately it wasn't just about Hess.
It wasn't just about Hess. So it was about a couple things, largely about Hess, but also they had a huge earnings miss, and a large part of that is due to some international earnings revenue miss. And you heard Mike Wirth talking about that on the tape, that some of it was like a one-off. He doesn't necessarily expect that to continue. That's one-off, tax things, the stuff you wouldn't have had clarity on before. But what we do know is that Tengizig in Kazakhstan has had a lot of cost overruns over the years. It's supposed to be on track, but that's always going to be a question mark. You've also had Chevron be hit really hard with the war in Israel and Gaza because they have a natural gas deposit over there as well. And the Gorgon facility, LNG facility over in Australia has also had a lot of difficulties. So there are just production stuff that is happening, as you do when you're an oil company. You always have production stuff that you got to maintain and take care of.
What about renewables? I know that this did come up in fits and starts, but I understand that they took a little bit of a different approach here in how they address the question around renewables.
So particularly when it comes to Exxon, actually. So they actually addressed this on the call and saying the complexity of low carbon markets is particularly challenging. And they talk about how it involves new technology and new markets and not an existing customer base.
that is very different than the European guys like Shell and BP and the approach that they've taken. They invested heavily in renewables, are now pulling back a little bit and sort of not moving away from oil and gas in the same way. Chevron is somewhere like in the middle. I mean, they have their own venture profile where they can put money into new cool stuff. They have a hydrogen project they're working on. So I think that for both Chevron and Exxon, what they're doing is they're trying to stick to their knitting. Like, what can I do in the energy transition space that already is stuff that I'm doing? Like, I'm drilling stuff out of rocks, I'm putting stuff in rocks. Like, how can I keep doing that when it comes to the energy transition? And that's sort of that approach versus like, hey, let me go buy this wind farm, for example.
Alex, we thank you so very much for your time, for your reporting, for your great interview as well. That is, of course, Bloomberg's Alex Steele. Now, I want to get a check on the markets here because you are seeing a VIX flying to a 25 handle. Remember, we started the week lower to around 16, so a very significant move over the day and over the week. We started the show at 20, Katie. I mean, just sitting here, we see the index level volatility rising.
It's like a rubber band.
It is like a rubber band, and it is interesting because you had market participants complaining for months, really, that there has been volatility just more in the single stock name, more in the options market. Underneath the surface, you are seeing that come to light in a very significant way. Remember, over the 1 year, the average VIX was 14, so 25 is pretty hefty, and you have to wonder if that will start to stifle some of the capital markets activity that people have been so long awaiting for. I also want to flip up the board here, take a look at yields, because you now have Citigroup coming out predicting a half-point Fed rate cut in September and November. And you look at the rating removes here in the Fed swaps market, you really have the market starting to get in line with that idea at a little more of a rate. Right now, the implied rate as more than 40 basis points in September alone. We'll keep an eye on it for you, but of course, the market's moving under the surface and at the surface as well. This is Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
All right, it's time now for Social Climbers. The company's making waves this morning. And first up, Hertz reporting a worse than expected loss after its bet on Tesla EVs took a wrong turn. Remember, back in 2021, the car rental company made a massive purchase of Model 3 and Model Y vehicles. But Tesla started slashing prices of those models just a year later, really demolishing the resale value. Hertz now selling its EVs at a loss. Next up, Warren Buffett's Bank of America selling spree still in full effect. Yesterday marked the 12th straight day that Berkshire Hathaway has trimmed its massive stake in the lender. Now, since mid-July, Buffett has banked $3.8 billion on that unwind. And finally, Taco Bell also shelling out a lot of dough for AI technology in its drive-thru lanes. Parent company Yum Brands announcing it will expand its voice AI technology to hundreds of locations before the end of the year. And that news comes after McDonald's pulls the plug on its own AI technology after consumers complained about the system getting their orders wrong. You can follow all the latest company buzz on TREN Go on your Bloomberg terminal, but take a quick check of these markets right now because that is the story today. The S&P 500 currently off by about 2.3%. More so if you take a look at the NASDAQ 100 off by about 3%. And that rally in the bond market, Shonali, it just continues. The 10-year yield currently off by about 15 basis points.
We are in correction territory on that NASDAQ 100 and, of course, quickening those losses on the S&P 500. We will keep you on these markets as we go throughout the hour. But coming up next, solar giant Nextracker posts an earnings beat, a bright spot in this earnings season. We're going to speak to CEO Daniel Sugar next. Stick with us. This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Solar giant Nextracker soaking up the revenue in the first quarter, the revenue coming in over $100 million. That is above the Bloomberg consensus estimate. Now, despite that massive beat, the company still maintaining its 2025 forecast. And joining us now, I'm pleased to say we have Daniel Sugar. He is the CEO of Nextracker, which of course is the leading provider of intelligent solar trackers. So let's talk through the guide, because you take a look at the share reaction right now, currently down about 8%. A lot of the sell side pointing to the guide. Walk us through it.
Well, we couldn't be more pleased with our results. 50% year-on-year growth from last year. It's been our sixth quarter of double-digit growth, and that's because solar is the lowest cost way to generate power on most places on the earth. We are forecasting for this year another year of significant growth. This is our first quarter, so we exceeded plan. We're going to manage the business appropriately.
To that end, yes, it was only really months ago that you were spun out of Flex. And as a standalone company now, what are you doing differently than when you were not a standalone?
Well, we just announced two super exciting acquisitions. We acquired a company called Ojo and another company called Solar Pile International. And let me explain what they do. Nextracker makes intelligent tracking systems that help the panels be aimed at the sun. And what these two
Goldman Sachs adds a third quarter point Fed cut to their 2024 forecast. So again, that's Goldman Sachs now seeing a quarter point Fed cut for their 2024 forecast.
Set the foundations of these systems, or in softer soils and places like that. So now that we're a spun out, fully independent company, we're in a very strong liquidity position. What we've done is, in a diligent way, done prudent, disciplined acquisitions to really help increase the total available market and solve problems for customers.
And so with that in mind, that strong liquidity position, you mentioned the acquisitions that you've made recently. Are more potentially on the horizon?
Well, we're always open to great ideas. The main thing is driving value for customers and helping solar continue to be the lowest cost way to generate energy, breaking away from polluting industries like coal and nuclear and things like that. And so what we're really focused on is discipline and in our evaluations, and making acquisitions that deliver value and that are accretive over time.
Dan, there's a lot of question about what this election cycle means for solar, for other forms of greener energy sources. And if Trump were to win the White House, what would you think the biggest change would be in energy policy, and how would that be impacting you?
Right. Well, the growth in solar is really about fantastic technological progress, innovation, and cost reduction. We grew significantly under Obama. We grew more under Trump. And we're growing more now. It's not about politics. It's about what's the lowest cost, lowest risk way to generate power. And the thing folks don't necessarily appreciate is how much power is needed both in the US and abroad. Nextracker operates in 40 countries around the world. And what we're seeing is very strong load growth driven by data centers, electrification of vehicles and other demand, and in the US, reindustrialization. So we need power, the lowest cost, best return for investors, and safest way for us to build, which advances our energy security and energy independence, is to use renewable energy. So the other thing Nextracker has done is we've stood up 20 factories with our partners across the US. Across the political spectrum, most of our manufacturing facilities are in traditionally red states. And so we're generating thousands of additional jobs. Our industries announced over 150 factory openings in the last few years. So this is really about jobs, energy independence, and lowering costs for customers.
Dan, we thank you so very much for your time. Of course, that is Dan Sugar, Nextracker founder and CEO, off the heels of the company's earnings report. Let's kind of check on these markets now, because that sell-off still underway. The S&P 500 just off of session lows, but still the sell-off has quickened throughout the morning. You're at 2.3% lower on the day on the S&P 500. Even worse so on the NASDAQ 100, nearly 3% down on the day into correction territory. The 10-year yield has a 14 basis point move lower. Significant moves on both long and even much more so on
Euro
the short end
extends
of the
gains
curve.
against the dollar to the
Two-year
high since
yield
July 18th.
down about 21 basis points or so, and the VIX just soaring. And joining us now, we're going to talk more about the markets here with Nir Kesar, Bloomberg opinion columnist covering markets. He's also founder of Unison Advisors, an asset management firm. And you look at the moves that we're seeing today, there's pretty broad-based moves you're seeing in the market. But let's hone in here on what we see in technology, in those magnificent 7 names, now that we have much more information about what earnings look like. Is this a greater selling opportunity at bay when you see how much there has already been selling pressure on an industry that has been a haven industry for so long?
Hi, Shanali. I think it very well might be, and investors have to take that very seriously. And because this week, earnings numbers were not as glowing as they might have been, let's say. And that might be just enough of a jolt for investors, which they didn't really need if they were looking at the numbers. And the reason I say that is because for the better part of 10 years, the market in general, and the NASDAQ in particular, has lived on the earnings growth of the Mag 7, collectively have grown earnings by more than 40% a year. I mean, that's obviously long-term unsustainable, amazing in the short run, but long-term unsustainable. And then look at the earnings assumptions inside the Mag 7. Bloomberg helpfully has a Bloomberg Mag 7 index, so you can dial those numbers up. And what you'll see is that the expected earnings growth collectively for this year is roughly 17%, and for next year, it's roughly 19%. That's still incredible, but it's well short, less than half of the kind of earnings growth we've seen previously over the last 10 years. And that means that we're going to have some sort of repricing. How fast that repricing happens and to what extent investors have a runway is an open question. But I think you're starting to see investors look at this and say, we just can't ignore this anymore.
It's so interesting to be having this conversation because I remember a few months ago when we were still, of course, those halcyon days where big tech was just leading the pack and we were rallying, that the answer that I got most often was that the fundamentals justify the valuations. But it now sounds like the story that we're talking about and that you're telling right now is basically that expectations just got too high for some of these huge tech names to your point, they're still putting up huge numbers.
Yeah, the numbers are great. There's another way. I think that's right. And there's another way to look at this is you can look at estimates further out. It's a little bit dicey because the further out you go, the more volatility there are in those estimates. In other words, there's more disagreement about what those estimates are going to be, obviously, because it's harder to tell the further you look out. But when you look at those estimates, what you see is, if you look 3 to 5 years out, let's just say, what you see is that on a PE basis, these stocks are roughly the same. But the earnings that are built into them look like the earnings of the previous decade. They don't look like the earnings that a lot of people expect over the next year or two. And so you have to ask yourself, what is the probability that they will continue to grow at these rates? And if the answer is not that high, then, obviously the multiples that we're seeing now based on those earnings are garbage. I mean, they're just not something you can rely on.
Nir, I want to take a look at the Philadelphia Semiconductor Index. Katie all day has been making this great point that if the big tech companies are getting burned on CapEx, they are still spending, then you would not think that you would see this kind of pain to their suppliers. NVIDIA has Microsoft as a massive client, for example. If they're spending, that would be good for NVIDIA. Yet you see this semiconductor index fall off another 6% today, nearly 7% yesterday. It has been ugly. Most of these names are in the red. Of course, Intel, that is an absolutely spectacular drop that we are seeing today as well. What do you make of this story when it comes to chips, when it comes to semis, when it comes to the infrastructure of this AI story?
I think that's a really interesting proxy, Shanali, for what we're talking about now, because ultimately, I think the enthusiasm that's built in going forward for a lot of the Mag 7 is around the AI story. It's not necessarily around core business, although there is some of that as well, obviously. And so the question is, and there's been a lot of questions about this, to what extent is that AI story overdone? To what extent is the investment they're making going to pay off? I mean, it has to pay off in a reasonable near term. I mean, if it pays off in 20 to 30 years, that's wonderful, but that's not going to help investors at these valuations. And so one way to think about that is to look at the semiconductor space and to say, okay, what is the enthusiasm around there? Because if the AI story is real, you would think that semiconductors are going to do well. And if there are doubts about that story, then you would think that would be the first line to get hit. And I think the fact that you're seeing some softness there tells you, and dovetails in with what we're talking about. I think it tells you that maybe the AI trade or the AI enthusiasm around future earnings is overdone, and we need to start rethinking about what reasonable earnings growth is and what then a reasonable multiple is based on that.
And NVIDIA shares down 9% this week. It is just going to be so fascinating to see them report. But we have to wait all the way until the end of August. So we'll put a pin in that. Let's talk about the Fed, because you've seen a lot of big, bold Fed calls come out for what they're going to do in September. Where are you leaning right now?
You know, Katie, I do not think I don't think a rate hike is a done deal by any
stretch. A rate cut, you mean?
I'm sorry, thank you. A rate cut is a done deal by any stretch of the imagination. In a rate hike, wouldn't that be a surprise?
Right.
In September. And the reason I say that is because if you look at the dual mandate, on the one hand, payrolls are still growing. The unemployment rate today at 4.3% is higher than it was, but still lower than what a lot of people see as the unofficial Fed target of 5%. And in any event, it's well below what you would see during recessionary unemployment. On the other hand, you have the PCE ex food and energy year over year that's going down, but it still is about 2.6% year over year over at the last read. And so the Fed is not there yet. And so reasonable people can look at these two things and say, okay, you know, which way should we go on rate cuts? But I think the Fed has already signaled to us what it's going to do, in my opinion, because if you look at what happened in 2021 when they had to raise rates, they waited about 6 months. Inflation ticked up before they even started making noise about raising rates. And then once they got there, they waited another 6 months to actually raise rates. And so they just started making noise at this last meeting about cutting rates. And my guess is they're going to be afraid of a replay of the 1970s. They're going to wait, even though I know everyone is.
So Brent oil falls to February lows amid demand concerns.
I would not bank on it. I think you may be a few meetings away.
Yeah, painful history lesson there. Nir, always great to speak with you. Have a great weekend when you get there. Our thanks to Nir Kesar of Bloomberg Opinion. Now let's take a quick check on these markets, because the S&P 500 at session lows right now, down 2.6%. Similar story if you take a look at the NASDAQ 100, down about 3%. And meanwhile, that bond market rally building steam, 10-year yields down 16 basis points. This is Bloomberg.
Names in global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US, or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business
with external and data set signals. And I think that's a lot of times where the opportunity is.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, Bloomberg's David Weston spoke with key players in economics and business this week at the Aspen Economic Strategy Group's annual meeting. David asked former Treasury Secretary Larry Summers how economic discussions have changed over the past 5 years.
Whether it's about the defense industrial base and making sure it's strong when we discuss industrial type policies, whether it's the danger that an overly indebted country won't be able to find the will to mount sufficient response, that perhaps the world's greatest debtor can't remain the world's greatest superpower, whether it is the questions of just growing our economy and maintaining our technological leadership, I think there's a kind of seriousness to the economic policy discussion that's framed, as some people have put it here, that it's a 1938-like moment, or at least it might be a 1938-like moment. And that, coupled with the complexity of our internal political challenges, makes this a very, very serious moment.
And when you think about those questions, at least it occurs to me there are two categories of questions. One is, will we have enough money? Do we have the fiscal headroom to spend what we need to on defense? The other is, are we spending money the right way? I mean, you mentioned Ukraine. The experience in Ukraine suggests warfare is really changing as we see these low-cost drones, what they did, for example, to the fleet of the Russians in the Black Sea.
David, I think there are two different things.
Crude futures down by $3 now.
One is, I think we need a greatly enhanced focus on implementation in everything we do in government. You know, you look at how much it costs to build a mile of highway versus how much it costs to build a mile of highway in 1955. You look at the New York City subway in the 21st century and the New York City subway in the 19th century. You look at the difficulties that the Boeing Corporation is having, whether it's with the space shuttle or whether it is with safe airplanes. You look at how much more productive in terms of putting things into space Elon Musk has been than, frankly, NASA has been. You look at the security threat our country faced a week ago from that cyber attack. I think the task of doing things effectively, as well as conceiving policy, is going to be profoundly important.
Another subject on the agenda for the Aspen Economic Strategy Group this year is higher education, which you know backwards and forwards, having been president of Harvard as well as having been a faculty member there for so many years. That I'm not sure would have been on the agenda 5 years ago. What is the state of higher education? How concerned should we be?
Look, I think any discussion has to begin with the fact that so many students from so many other parts of the world want to come to American universities, and that American universities are a magnet. They are an export industry for our country. They're a source of knowledge. There's plenty to criticize, and I will in just a moment, but our higher education system in its totality is the envy of the world. But I do think in some ways, particularly in the elite aspects, they've lost their way.
And that, of course, was former Treasury Secretary and Wall Street Week contributor Larry Summers speaking with Wall Street Week host David Weston. This is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Well, Dr. Doom is looking for his next patient. Economist Nouriel Roubini is looking to enter the $9.4 trillion ETF universe. And for more on this ETF Friday, we're joined now by James Seyfert. He is ETF analyst over at Bloomberg Intelligence. And James, this is just a filing. It hasn't launched yet, but feels like today would be a pretty good day for a Dr. Doom ETF.
Yeah, I mean, honestly, this ETF filing says he's going to go anywhere, but some of the things he mentions, like real estate and a few other things in the market, they're actually doing really well today. So, I mean, right now the market obviously is it's not doing well, but if you're looking at real estate ETFs and utilities ETFs, real assets, the types of things that he seems to most likely kind of be focusing on, he kind of leaves it open to go wherever he wants. But he'd probably be doing okay today as far as ETF performance goes.
So we'll see, of course, when this one gets to the finish line. This is interesting because, of course, you have Nouriel Roubini filing for an ETF this week. You also had Tom Lee filing for an ETF this week. And I think this trend is really interesting, James, that you have more of these sort of high-profile names coming into the ETF wrapper.
Yeah, I mean, I think it shows that everyone's looking at ETFs now, right? Which is something we've been talking about. I mean, you're on ETF IQ. It's something we've believed for many years, but it seems to be kind of hitting the zeitgeist, if you will. I mean, a few years ago, maybe even 5, 6, 7 years ago, these guys probably would be just launching a hedge fund. They wouldn't really be looking at the ETF space, but they've seen a bunch of different people have a lot of success. And they're going to give it a try. There's been plenty of examples of active managers. There's even people that are have a huge.
The City forecasts 125 basis points in Fed cuts this year after the jobs data, 50 basis points seen in each in September and December.
Rather than a closed-end fund.
Yeah, I mean, I think he should just launch an ETF. But there are some things you can do in a closed-end fund that you can't do in an ETF. You can issue debt. You can be a little more activist in the way you do things. But I think, honestly, if he couldn't raise the type of money he wanted to raise in an IPO for his closed-end fund, maybe he should just look at launching an ETF, and we'll see what type of interest he actually gets.
And it's also important to point out, in a closed-end fund, you have permanent capital. I have to imagine that is very attractive to a lot of managers, including Bill Ackman. But who knows, now that we've put that out into the universe. James Seyfert of Bloomberg Intelligence, thank you so much for your time. And, of course, tune in to ETF IQ every Monday at 12 p.m. Eastern. Meanwhile, Wall Street banks, of course, revising their forecasts for rate cuts after today's weak jobs number. Let's get into some of it right now because Goldman adding a third quarter-point cut to their 2024 forecast. Citi predicting a half-point cut in September and November. Pretty dramatic there. And Bank of America now sees cuts starting in September instead of its previous call of December. So it feels like we've all coalesced around September. That had already been the case. Now you're hearing more people say the Fed should have cut this week. They should have cut rates on Wednesday.
Yeah, and it's fascinating. You're seeing that violent move right underneath the surface here in the bond market as well. We had the 2-year really drop as low as 384 on the day. We're standing at 3.9% right now, Katie.
Yeah.
So really significant move. That VIX is now at 27, a 27 handle. If you could imagine, that is more than 10 ticks higher than where we started the week. And as Mohamed Al-Arian had been saying all morning, these moves, if they were alone, that's one thing. But the fact that you're seeing the bond market moves again, already extreme bond market moves this week, makes it all the more exciting.
And you made a really good point earlier that there has been volatility in this market, but it's been at the single stock level. If you take a look at the average single stock volatility, it's been higher than the VIX, but now you're starting to see it break out to that broad index level volatility as well. That's something that this market has been missing. You've seen people saying that it would come back, and now it's sort of a be careful what you wish for moment.
The NASDAQ 100 is in a correction, but the VIX is certainly here to party. It is Friday after all, Katie. And you know what? We have a massive, massive, massive week ahead. Coming up next week on Open Interest, we're going to have a lot of C-suite conversations. We're going to be talking to the CEOs of Vanguard, Lucid, Robinhood, just to name a few. We're going to give you the micro to the macro, of course, all week long, and another big week of earnings, though we are through the brunt of it. Take a breather, guys. It is almost the weekend, but a long day ahead for you still.
Yeah, absolutely. Have a great weekend when you get there. This has been Bloomberg Open Interest, and this is Bloomberg.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
innovation, money, and power collide in Silicon Valley and beyond. This is Bloomberg Technology with Caroline Hyde and Ed Ludlow.
Live from New York, this is Bloomberg Technology. Coming up, the NASDAQ 100 plunges into correction territory as the rotation from big tech continues. Plus, we break down the results from tech heavyweights Amazon and Apple, and Intel shares falling by the most since 1982 as the company offers a grim forecast and slashes thousands of jobs. The picture in financial markets is severe this Friday. The focus is the technology sector. This is the NASDAQ 100 over the course of the week. We are on track for our fourth straight week of declines, matching the run that we saw in April of this year. We have entered a technical correction on the NASDAQ 100. In the moment, about 80 names on that index in the red, fewer than 20 in the green. The story is about 3 names in particular. Let's bring them up. We're going to go into the earnings story with Amazon and Apple with our reporters, and later a detailed look at Intel. Yes, that is a 28% decline. About 15,000 jobs will go. Reduction in CapEx and OpEx. They basically have admitted that they were slow to respond to their reality, that their market's not going well from a top-line perspective. We are going to get deeply into Apple, which is kind of a bright spot. And let's turn to that stock now. We're seeing a return to revenue for the quarter, but Apple not offering much in terms of clues about an upgrade cycle when it comes to the iPhone 16. Bloomberg's Mark Gurman is standing by, and you and I manning the blog last night. A lot of emphasis on Apple Intelligence being a driver for iPhone 16 in the future. I think you and I had some doubts about that, right?
Apple knows that artificial intelligence, Apple Intelligence, as they call their suite of AI services, are the buzzwords that gets Wall Street going, right? For the past several quarters, Apple, even before announcing it, had been teasing its new AI features because it knew the market, it knew Wall Street analysts were wanting this. It knew some consumers were wanting this. And so they focused a great deal of the call yesterday, Tim Cook in particular, as well as basically every analyst who asked the question, talking about Apple Intelligence. In my view, I think that Apple Intelligence, at least this year, is still very nascent, and I don't believe it will, or quite frankly should, drive iPhone upgrades this September. I think that's more of a next September and iPhone 17 cycle thing once all of the features are available and we're a year out from that release when more people are looking to upgrade.
Greater China was a focus where there was a 6% decline in sales, but Apple told us about the impact of FX, and that on a constant currency basis, it would have been a 3% decline. See past that, Mark. What were the product stories for Apple in China?
Well, first of all, there was a time when Apple was growing at such a big rate that they didn't need to get into FX, currency headwinds, or anything like that. They didn't have to contextualize these numbers to explain that they're better than they actually look on paper. But that's one thing. But the other thing to note is that they're doing better in China in the second half of the year so far than they were doing in the first half of the year, according to them. So you're seeing a bit of an acceleration for them. And that is coming at a particularly good time, given that this iPhone upgrade cycle is approaching at the tail end of this quarter. So they're going into that with a bit of momentum. And that's certainly positive news for them. So it's not all bad. I mean, if you look at the quarter in general and you look at the stock market today, it's clear why Apple's in the green and almost everyone else in the NASDAQ 100 is in the red. They beat Wall Street expectations. They grew revenue 5%. They returned to revenue growth after declining last quarter. And they beat on analyst forecasts for each of their major product categories plus services. So overall, pretty good day for the company.
Bloomberg's Mark Gurman, Chief Correspondent. Thank you. Amazon has told investors that profits will need to take a back seat in favor of heavy spending on artificial intelligence. Here's CEO Andy Jassy on his bullish view for the new technology.
We remain very bullish on the medium to long-term impact of AI in every business we know and can imagine. The progress may not be one straight line for companies. Generative AI especially is quite iterative, and companies have built a muscle around the best way to solve actual customer problems.
But Wall Street did not like that.
shares down more than 11% in today's trading session, on track for the biggest drop since April of 2022, wiping out about $200 billion in market cap. Let's get analysis with Bloomberg Intelligence analyst Poonam Goyal. You and I were talking in real time after the numbers dropped, right? And I said, where's the CapEx number? We did get one. Your reaction to it?
Yeah, it's higher than we had expected. So they did $30.5 billion in the first half. They expect 2H to be higher. We didn't expect them to continue to invest more, so it is a bit of a shocker. But that said, if you think about Amazon for the longer term, the investments will pay off. The cloud business at $100 billion run rate, going to $200 billion by our estimates, it's going to need the investments. And also for Amazon to play catch up on generative AI, right? They're lagging some of the other peers, so you need to see them step up a little bit at least. We didn't expect it to be in 2H, but nonetheless, it's coming, and we do think it'll position it better for the longer term.
I still focus on the AWS top line number. 19% was better than expectations, and forget the financials. On this program, we hear a lot about how great Bedrock is, about the utilization of the platform for many different things in the world of LLMs and generative AI. Why was that not a convincing enough number?
Well, we had expected mid to high teens, so about 17% going into it. And while 19% was a good number, undoubtedly, the 35% plus profit margin was also great. I think the focus just shifted all on the guidance, and that's where the miss was. So I wouldn't discount that 2Q wasn't good. I think 2Q was very good on AWS especially.
My control room producers are showing index level. I point out that there is a lot of red in the markets, Poonam, and Amazon is a big factor in that. Bloomberg's Poonam Goyal, fantastic analysis. Let's keep the conversation going with Helena Wang, research analyst at Phillips Securities. And I think let's start with Amazon. There's a micro focus on AWS, how much money is being put into investment, and then how much money is coming out in the AI story. What did you make of it, Helena?
Well, I think the hot topic for the last few weeks has been the huge CapEx spend, whether it's justifiable. I mean, Amazon has guided exceptional increase in CapEx since the last quarter. In the first half of 2024, their CapEx was $30.5 billion. And they're guiding even higher amount for the second half of the year. Just to put in comparison, their CapEx for the entire year last year was only $40.8 billion. So that is definitely a very significant increase. So like all the other big tech companies, they're selling their story of strong AI growth, very confident in their AI game. They would like to have more capacity than they already have today. And they're claiming that they're seeing strong signals of high future demand. I guess also if you're in the AI race, it's almost impossible for you to stop investing in AI because in a short period, you will be obsolete with no means to catch up. But to investors, it really requires a lot of patience. Everyone is telling the same story of investing in AI, so it's hard to say whether in the short term, whose investment will pay off in the long run.
Helena, just focused on AWS, we've hardly discussed the retail business or even advertising. Did you see anything in those segments of the business that interested you?
For AWS, it has been accelerating nicely and 19% year on year. So what we especially like about AWS is their high operating margin compared to retails, because AWS operating margin is 36% compared to retails, which is only single digit. So AWS right now only contribute to 18% of the total revenue. So we do believe with AWS scaling up so fast, it is going to take up a bigger portion of the entire revenue. So we think the real kicker for Amazon in the future would be the margin expansion brought by AWS.
Let's talk about Apple. I look at the numbers. It was basically a beat across the board, apart from China. How much emphasis do you put on that China number?
Well, I would say Apple is saying they still see it already as an improvement compared to the first half of the year, but the numbers are definitely not great. Usually when a particular market is not doing well, Apple will specifically point out it's not really the iPhone, but actually the other product category that drag the sales. But they have not commented like that for this particular time. So we can take it that iPhone is actually part of the reason, or in fact, one major reason for the decline. So domestic competition from local brand is still playing a big part. Apple was giving out a huge discount in order to fight the competition. So that will also be one of the factors that hurts the revenue.
Tim Cook and Luca Maestri got a lot of questions about how Apple Intelligence will impact an upgrade cycle in October, probably, when the 16 generation comes. Have you done the math on that?
Yes, I did. So iPhone sales still remain pretty muted. They're down 1% year over year for this quarter. If we actually do the math, they're guiding for 5% growth rate in the next quarter. So factor in service sector, which is continually growing double digit, and iPad, which grew pretty well, also double digit in this quarter. So we're probably not going to give so much in the next quarter in terms of iPhone. It's probably going to remain flat or actually perform more poorly. So we're thinking that Apple Intelligence boost for the product cycle that everyone's been waiting for is probably unlikely to be seen in 2024. It's more of a 2025 story.
If the question is, if you have an iPhone 15 or 15 Pro or Pro Max now, do you get the iPhone 16? I think there's a lot more to discuss around that. Helena Wang, research analyst at Phillips Securities, thank you so much for your time. Now, coming up on the show, we're going to be joined by Bernstein research analyst Stacey Rasgon to break down Intel's earnings and Intel's story. That's next. This is Bloomberg Technology.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself. Yeah. Actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Intel shares suffering their biggest drop in more than 40 years. This after the company gave a grim growth forecast and laid out plans to slash around 15,000 jobs, signaling that the chip maker is ill-equipped to compete in the AI era. I want to bring in Stacey Rasgon, senior analyst at Bernstein Research, leading semiconductor coverage. I ask you where you'd like to start, Stacey. Which of the many things announced and the sort of guidance given is the most important factor here?
Yeah, so I mean, the quarter itself, revenues were actually not too bad. It was the gross margins that really killed them. And the guidance was clearly awful. Revenues were bad. I mean, they had a hockey stick in the back half from last quarter. Clearly, the back half is not playing out the way they thought. Gross margins are falling into the abyss as they get higher costs on their chips. Clearly they're in a tough spot. I mean, they announced a number of actions to try to salvage, to stop the ship from sinking. They're cutting CapEx. They're cutting OpEx. They actually finally suspended their dividend. They had cut that by 2/3 a year and a half ago, so they've finally suspended it. And they're doubling down on bringing in partners that will co-invest on manufacturing capacity. Recently they sold half their fab in Arizona that they're building to Brookfield, and they just sold half of their fab in Ireland, Fab 34, to Apollo for $11 billion, and they got that cash flow in on the quarter.
That's
but I mean, look, this was like, I've used the phrase worst earnings from Intel in my career a number of times over the last year and a half, 2 years, and this one probably takes.
Yeah, this time you mean
this
it.
is probably the worst I've seen. Yeah.
As you know, Stacey, I had the opportunity to speak to Intel's CFO, Dave Zinsner, when the numbers hit, and we got into missed opportunity, I guess. This is what he said about the data center business. And I'm trying to understand what he meant, but he basically is saying they were overexposed in CPU, and I guess therefore by extension underexposed in GPU. We all know the story. Anyone that lives or works in the world of technology knows that all of the investment is going to high performance GPU or AI accelerators. Intel has one, Gaudi. So explain what Dave meant there, please.
Yeah, you bet. So they have been clearly over-indexed, I mean, almost entirely indexed to CPUs. And there's a few things going, even within CPUs, by the way, they've been losing a tremendous amount of share to their smaller competitor. So that's not been good. And then over the last, as the AI boom has happened, we've had a share of a shift in the spending patterns away from CPUs toward GPUs and other types of accelerators. And by the way, there's a broader question there. You could argue, is that a cyclical trend or is that a structural trend? Like in 5 years, is the data center CPU TAM bigger or smaller than it is today? And like you could legitimately argue that it's smaller. So I mean that's the issue. And the problem with Intel on that front is they don't really have that much of an AI or an accelerator play. Like they have a product that's called Gaudi. They said that they're going to sell $500 million worth of what's called Gaudi 3 this year. I mean, it's effectively a rounding error, right? I mean, AMD said they're going to do $4.5 billion in data center revenues, and I think people think they're going to do more than that. And NVIDIA, data centers, they might be $100 billion this year, and the $500 million doesn't make up anywhere near, like the air pocket that's happened both as they've lost share in CPUs and as that spending has shifted. And so that's kind of the problem. And frankly, Gaudi at this point is baked. Like that product is shipping. Like it's very clear the general demand for it relative to everything else is very, very minimal. Like it's just not enough to close that gap. So they don't really have much of an AI story, unfortunately.
Stacey, just real quick, on cyclical end markets for them and non-cyclical, I mean, the way that the CFO put it to me is that they just hadn't responded to the realities of their revenue, hence the reduction in OPEX, CAPEX, and headcount. But there did seem to be some glimmers of hope that coming into the current period and the rest of this calendar year, there were improvements in those markets?
Yes and no. So I think PCs in general are better than they were. Remember, though, they don't sell PCs, they sell CPUs, right? And they talked about there's inventory that's digesting in the back half, which is helping to impairing some of the revenue. Now, this is something that I've been worried about. We track the CPU channel pretty religiously, and you get overshipment, you get undershipment, and I've been concerned that at least in Q4 and Q1, I think there was a fairly significant amount of overshipment of CPUs relative to PCs, and I think they're paying for that now. So you have some cyclical downside there. I think on the data center server side, there's been some green shoots that hopefully demand is getting better, again, off of some awful years. But again, people now having like recession worries and everything else, and again, they're still losing share. The data center Gaudi lift isn't really enough. And then some of their other businesses, they have an FPGA business called Altera. And all the FPGA companies, it's the same thing. They're working off a ton of inventory, and that's not really getting better yet. They still consolidate Mobileye. They own most of that company's own. Mobileye reported yesterday morning. We don't cover Mobileye, but just factually, they slashed their guidance for the rest of the year, and so a bunch of revenue had to come out from there. It's just not great, and part of it, I think, is their own doing. Last quarter, they had sort of suggested we'd be seeing above seasonal growth in the back half, and it's clearly not happening. The macro's getting worse. And then on the cost side, again, they've got some incremental cost headwinds that are pretty severe that are impacting gross margins and cash and earnings and everything else. So.
Stacey Rascon, Senior Analyst at Bernstein Research, whether or not that is and will be the worst Intel print of your career, I think you broke the numbers down. Okay, very quick. We have 10 seconds.
10 seconds. The silver lining, the cash that they're saving from the cost cuts and the dividend suspension and the capex cuts, and then all of the money they're bringing in, they'll live. I don't know what kind of a life it'll be. They'll live. That's probably $40 billion of incremental cash over the next couple of years. So they'll live. But what kind of a life it's going to be? I think that is the question that we're all wrestling with right now.
Stacey Rasgon, Bernstein Research. Terrific. Thank you very much. So coming up, we're going to be joined by Kazima Shipchandler, CEO of Twilio, to discuss the company's earnings, which were released after the closing bell on Thursday. Maybe that's a stock going in a different direction. This is Bloomberg Technology.
The more that you learn about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
There are some positive earnings prints to talk about. Cloud communications company Twilio reporting earnings after the closing bell Thursday. CEO Cosmo Shipchandler joins us for more from San Francisco.
JP Morgan now forecasts a half-point Fed rate cut in both September and November as well.
Evidence now, but this is the first time you and I have been able to speak since you've been CEO. So what have you done to change that growth trajectory?
Yeah, thanks for having me. I would say, we're just running the company with a lot more discipline, a lot more operating rigor. And as it relates to growth in particular, I think we've been very focused on some of the innovation bets that we've been making. And I think perhaps most encouragingly, we're starting to see some real signs that this combination of communications, which we're the leader in, contextual data, which we're also the leader in, plus AI, that combination to drive really personalized experiences for consumers vis-a-vis the customers we support is starting to get some traction.
There's been a lot of emphasis as well on sort of reorganization. What does the company Twilio look like now under the changes you've made, Cosima?
Look, I think the company organization is in pretty good shape, actually. About a year or so ago, we took steps to, kind of get our cost base in shape. But on the flip side, we also wanted to be really focused in the areas in which we wanted to grow. And so we have a communications business that we established at that time as kind of a proper business unit. We did the same thing with our segment business, establishing that with a proper business unit. They've got kind of an aligned set of metrics. And I think the benefit of that is that it also allows for a certain level of disclosure that investors were also asking for.
Cosima, it is important to note that where we are today is in part the result of activist investor interest in the company. You seem to have responded to that positively, taken action. Would you just update the audience that's familiar with Twilio where we stand, please?
Yeah, I just think fundamentally, like, we're trying to run the company well, right? I mean, I think that's something that every single one of our share owners want. It starts with financial discipline, you know, being smart about the bets that we're making, obviously re-accelerating top-line growth over time. We see positive signs about our ability to do that. We're more optimistic about that. I think operating rigor, just kind of the internal mechanics of the company, like doing that well, delivering on the things that we said we would do and actually, you know, going and doing those things. And then I think when it comes to innovation, just being really focused, you know, so we're taking a handful of bets. As I mentioned, one of those is really around this notion of contextual data, using that as a means to combine it with communications to drive interactions on the other side. Like, you know, we serve customers ultimately, and customers keep telling us that's what they want, and I think that's ultimately what's going to yield the success of the company, as well as for our share owners.
Well, contextual data, but when we talk about AI and Twilio, a lot of it plays on what you're good at, right? Voice intelligence, verify those products. Have you seen an AI-driven acceleration, or are you just saying, we've been doing this a while, guys?
I think it's kind of early days, to be honest with you, but you know, the nature of it is sort of in the product vernacular that you just referred to, right? So voice intelligence, right? I mean, it's a little bit different than from where we were, let's say, a few years ago. Like, actually what's taking place inside these calls now is the ability to harvest some of the data, always with consumer consent, I might add, but harvest the data inside those interactions to pick up keywords, feed that back into an AI engine such that that information can be used to both make that particular conversation more interesting, more engaging for one of the consumers that our customers are engaging with, as well as at the same time taking that data and feeding it back in so that over time that results in a more delightful customer engagement.
Kozema Shipchandler, CEO of Twilio, who stocks up 5% on a day when tech is down big. Coming up, our earnings coverage continues. Gene Munster of Deepwater Asset Management. That conversation, a big one, coming up next. This is Bloomberg Technology.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. How are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive. And that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but it's okay. Companies don't make them profitable and their credit quality is good.
Nobody covers business like Bloomberg.
Good
morning from our world headquarters in New York. I'm Manus Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
Welcome back to Bloomberg Technology. Ed Ludlow in New York City. Let's get a check-in on the markets. Big tech is under pressure yet again, with Intel and Amazon leading the way lower. Their disappointing results pushing the NASDAQ 100 into correction territory. That means falling more than 10% since hitting a record high just last month. But a different story for Apple this morning. It's in the green, despite some disappointing numbers, particularly out of China. Now, analysts and investors alike are applauding the company's return to revenue growth, emerging from a sales slump with 5% growth year over year. There are a lot of product stories within that. Joining us for more, Deepwater Asset Management Managing Partner, Gene Monster. And Gene, at the heart of your thesis is the debate around the Osborne effect. And any technology or consumer electronics fan will always think about Apple and the iPhone in that way, but why, and what is the conclusion you've drawn?
Well, Ed, maybe taking a step back, the Osborne effect is a phenomenon that I'm sure any Apple user and any tech user is familiar with, but they may not know that, but defined as such. And that's this concept of if there is a pending big product coming, it's likely that you hold off on buying the existing product. Now, every year there's a slight Osborne effect, but the more anticipation there is for a next version of an iPhone, the greater the Osborne effect. And so I, in my years of covering Apple, have seen quarters where they have guided down before a major product cycle. In the case of their guidance for September, they guided for similar revenue growth, 5% for the September quarter as they just reported in June. And so effectively, they are bucking the Osborne effect in front of what is a highly anticipated cycle. And why that's so important is that's a sign that consumers simply can't live without Apple devices. It's that they still, even though it makes sense for them to hold off for just another month or two, they can't do it because they need these phones to continue to basically live their lives. And so I think that this was, even though the guidance was effectively in line for September, I think it really sent a powerful message to investors, the strength of their product line. I think that's why the stock is up today.
Gene, the top thing here is Apple Intelligence and the impact it will or won't have. Several analysts had multiple stabs at getting Tim Cook and Luca Maestri, the CFO, to talk about the direct impact of Apple Intelligence on an upgrade cycle. I think Tim Cook went the furthest maybe in saying that there will be a meaningful cycle, but no sort of data. What did you make of that?
And he added that they just don't know until they know, and I think he was being reasonable. I think what I make of it is I think it's a kind of a responsible, judicious response from him. At the end of the day, it comes down to, I think, going forward here, you take his comments and you kind of set them aside and you have to ask yourself a very basic question. Do you think that these features, basically embedding generative AI throughout many, if not all features of the iPhone, do you think that they are going to get people excited enough that they upgrade more often and they kind of create this super cycle for the next couple of years? And while we don't have the confirmation from management on that, I think that is the central question. Just one other piece to add, Ed, that you alluded to is that there is these features are going to come out over the next year. And so it's not going to be this kind of aha moment on the end of September. It's going to be where people will get the new phones, they'll get a feature, they'll get another feature. And I think collectively in fiscal 25, we're going to see momentum around this cycle build, but it will not be a rocket ship type of a takeoff. It's going to be more of something that's going to build momentum over the next year.
In China, there has been much made, Gene, of the third-party data. If I've learned a lesson, it's probably be cautious about the third-party data because sometimes Apple executives then prove you wrong. But it has been hard to gauge the iPhone's performance against some of the domestic handset makers. Did you learn anything about that market from the call? And indeed, when we spoke to the CFO, Luca Maestri, on the phone, Bloomberg's Emily Chang did that one, he's saying that the underlying demand is better than it's previously been in China.
that Luca's comments, Tim's comments were that this is the most fierce competitive environment of anywhere in the world, and they're seeing a macro piece to it too. And so if I can interpret or translate Luca's comments kind of going forward here, is that essentially China's been tough. It's been down for 3 consecutive quarters, down 7%, last quarter down 8, down 13 in December. The good news is, and maybe this kind of gets to Luca's point, he's probably looking forward at these comps, and the comps start to get really easy in September and even easier in December, and so the probability that China returns to growth is high going forward. So I think that that is a little bit of a relief. We kind of got through what is the trough, I think, ultimately of China. And just to put some perspective of how much that can impact the business is if you would exclude China from the overall business, so just look at the other 82% of their business, it grew about 7% in the quarter. As you mentioned, their overall business grew at 5%. That was reported globally. And so China has a big weight on it. It has been a weight. I think that this will convert to a tailwind in the September or highly likely the December quarter.
How important were services, Gene, particularly to the bottom line, which is where I was looking?
You know, another nice surprise is that a few quarters ago, services growth dipped to just under 11%. It was 14% in the June quarter. They guided to just over 13% growth for the September quarter. And that's all in the face of what's gone on in terms of this talk of regulation. There has been some more substance to regulation in Europe, and they highlighted that the Europe App Store accounts for about 7% of total App Store revenue, which translates to about less than 1% of overall revenue. But the point is that despite these changes, these headwinds, this concern, this anxiety around investors over the past year, that somehow the services segment is going to slow, it just continues year in, year out. I think it's testimony to just the flywheel of their products, the ecosystem, them continuing to add. And that services number next year should get a nice boost with this OpenAI arrangement. They will likely charge for a premium version of ChatGPT next year, $20 a month. Apple's going to take their cut on that. I think that that is going to continue to put the services segment in kind of this mid-teens growth for through end of 25 or 26.
Deepwater Asset Management Managing Partner Gene Munster, the Osborne effect. That's what it's all about. Thank you very much. Another name that we're tracking is Snap. Snap shares falling today after revenue for the quarter missed estimates. And as the social media company's forecast disappointed amid weakness, particularly in brand spending. Joining us now is eMarketer Principal Analyst Jasmine Emberg. You just go back to the original business, the advertising-based business, and where they did well and where they didn't. What was your conclusion?
Well, it does feel like a big step back for Snap, given all of the work that it's been doing in overhauling its ad business. There were some positive signs. In the report, we saw growth in the number of active advertisers. We saw that it was successfully able to diversify its revenue streams with Snapchat Plus now bringing in over $100 million in revenue. And there were some improvements in its direct response advertising business, which is, of course, what it's been really focused on fixing and improving. The fact that brand advertising, though, is still so much of a headwind for Snap tells me that there is a lot more work to do within its direct response advertising business, both to get more advertisers on board and to get them to commit more budget to the app.
Just looking at the stock, down almost 25%, that does put it on track for its biggest drop since February, and a number of analysts cut their price targets on it. We have to kind of frame Snap in, I guess, the context of competition with Meta, Jasmine. Is that fair to do, and what would we learn if we did that?
Yeah, I mean, I was actually just having this conversation yesterday about whether it's still fair to compare Snap to Meta, because they really are playing in very different leagues. And one of the reasons we saw investors reward Meta, despite all of that AI spending and metaverse spending that it continues to push, is because it has this massive ad business and it was able to show a lot of improvement there. Snap is a much smaller ad player, and it has struggled to keep up, and it's still working to catch up with Meta, and so it really needs to be focusing on that. Now, it's not small by any means. We also heard that 850 million monthly active users was the number of users on the app now, so I think a lot of times it's framed as being the small player, but certainly isn't. But in terms of scale, definitely still smaller than Meta.
Jasmine Emberger, V-Marketer, great to have you back here on Bloomberg Technology. Thank you very much. Now, coming up, we continue earnings discussions. We're joined by Ravi Inakonda, CFO of DoorDash, to discuss his company's earnings, which were released after the bell Thursday as well. And again, a rare bright spot in what's a pretty big day of red on the screen for markets this Friday. That conversation's next. This is Bloomberg Technology.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend, only on Bloomberg.
Always on the heartbeat of the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Back to earnings, DoorDash, which reported Thursday after the closing bell. Strong outlook, particularly on the bottom line for the fiscal third. CFO Ravi Inakonda joins us now for more. I'm going to do something a bit different here, Ravi. We know the numbers. The outlook's good. I actually just want to talk a bit more about the platform and where this growth's going to come from, beyond restaurants, into new product categories, because I think that's a real point of emphasis for a lot of investors this morning. So give me the near and long-term future of how you're going to be driving that growth.
Absolutely, Ed. Yesterday, somebody on the media said, we are redefining convenience. That's truly what you are seeing on the platform. We went from being one product in one country to being multiple products. We're really excited that more than 20% of our users today look to DoorDash to order their groceries, convenience, retail products. And that was just up from 0% just a few years ago. And we are doing this successfully in over 30 countries where the demand has been overwhelmingly positive.
But Ravi, is it a specific category? You know, I think about the types of things you use an app-based service to get to you conveniently, right? Is it alcohol delivery? Is it cosmetics, beauty, fashion even? What are the areas where you think, okay, we're going to get big on this area?
Grocery has been a large component for us. We have more number of users today ordering grocery than ever before, and they're ordering more times than ever before. And the reason is we've increased the selection. On the East Coast, we've added major brands such as Ahold and Wakeford. The improvement in selection is what you're seeing driving the growth in grocery. At the same time, retail is an exciting part. Consumers are very excited about getting their products instantly when they order beauty products from Sephora or Ulta Beauty, which are other major brands that we've added. Number two, what we're seeing is the strength in new verticals, which is categories outside of restaurants, continues to be strong, not just in the US, but in many of our international markets as well. So you're seeing strength not just in grocery, you're seeing strength in retail, you're seeing strength in beauty, alcohol, many categories, outside of our core restaurants business, while the restaurants business continues to grow quite nicely as well.
I think back to the earlier days of covering Uber and this obsession with adjusted EBIT. There was trust me, there was an obsession. The question for DoorDash is on operational profitability. You've given a pledge before on timeline. What's the latest?
Our financial North Star is driving long-term free cash flow per share. You're seeing the business do really well and continuing to drive free cash flow higher. When I measure and monitor the business, to me, free cash flow is truly the health of the business. And when you look at adjusted EBITDA as well, that's at an all-time high.
Ravi, you and I have discussed the sort of technology side of the business as well. How do you scale by adding merchants, using incentives in a way that doesn't kind of impact maybe the more profitable side of the business on the back-end solution side of things?
The key for us, Ed, is scale is what drives profitability in the business. We have more than 37 million consumers that shop with us every single month. What we see is when we add new categories, the overall engagement on the platform goes up. We are making the app more personalized. When you search for something on DoorDash today, we remember your preferences, and the search results reflect what you preference on DoorDash. All of this ultimately is driving users to come back more often. They spend with us a lot more. We are driving value not just to consumers, but also to merchants. And you're seeing us driving growth for merchants as well. The combination of all this is what's driving ultimately the growth as well as the profitability in the business.
Ravi Anaconda, DoorDash CFO. It's great to catch up, have you back here on Bloomberg Technology. Thank you. There are other news stories. It's time for Talking Tech. And first up, Nintendo profits free fall, 71%. The gaming company posted just $365.1 million in profits in the 3 months through June. This as consumers hold off on purchases as they await a new flagship game console that replaces its now aging Switch in its 7th year. Plus, billionaire Jack Ma scores a win as his Ant Group-backed Mint hits a valuation of $5 billion. The fintech company raised new funds as its popular e-wallet service reaches more than 90 million users in the Philippines. That's according to Bloomberg calculations. And Ant Group will own 1/4 of the entity's shares, pricing the value of the stake at $1.2 billion. And embattled short seller Andrew Leff's deleted tweets are in the spotlight. The investors removed his research firm's entire tweet history last year in an effort to fend off what he called class action attorneys and trolls. Now the US Justice Department are digging through those messages, accusing Leff of manipulating the market to benefit his own trading and lying to investigators. Okay, Coinbase CFO Alicia Haas spoke with Bloomberg on Thursday to discuss her company's earnings, noting growth in subscription and services and driving developer creativity on the Base network. Listen to this.
We're really pleased with the growth of subscription and services this quarter, as you note. We grew in every category of subscription and services and reached $599 million, a new all-time high for us. One of our goals has been revenue diversification, and we're pleased to see that mix play out over time. We don't look at when it will cross, Shonali. We look at growth of each of our revenues, diversification of all of our revenue streams. And when I look at our transaction revenue, it does ebb and flow with volatility for spot trading. But what we're pleased to see is continued growth of that other transaction revenue. Base has become one of the biggest contributors to other transaction revenue, and the building blocks are just getting started for lower cost payments, USDC on base now is free. We're seeing $20 billion of transaction volume of USDC on base over the last 2 weeks. And so as we think these building blocks come together, we could see diversification of transaction revenue as well. But really pleased with our subscription services performance this quarter, as you
Alicia,
noted.
please double down on that. Base is a relatively new product here for Coinbase. How is that going to start contributing to a greater scale at the bottom line? What exactly are people using on Base that is creating more of a cash flow stream for you?
So just to remind everybody what Base is a layer 2 solution, which means that it sits on top of Ethereum and it's enabling faster, cheaper transactions. And so that has been our goal, driving faster and cheaper transactions to a mission that we have of 1 second and 1 cent. As I said, over the last 90 days, we saw it come down under a cent for each transaction. And what that led to is 300% transaction growth quarter over quarter. This is enabling developers to build new applications on top of Base that can benefit from embedded payments within that application. And we're seeing all sorts of creativity emerge in this space. We're seeing people build new social networks. We're seeing new types of games. Just creativity is blooming on the Base network. And that's what our focus is
So
right
in
now.
10 minutes time now at the top of the hour, due to hear comments from Fed Scoresby, who's interviewed on Bloomberg TV.
Transactions will turn into sequencer fees that will bring revenue to our P&L.
How long does it take for that to play out? What are you modeling right now, Alicia?
Well, it's early days, and so what we're pleased to see is that we become the #1 layer 2 in terms of contracts posted. So that focus on developer activity is where our energy is right now.
That was Alicia Haas, CFO of Coinbase. Now coming up, AI chipmaker Cerebras files confidentially for a US IPO, a story I broke with the deals team last night. Have more next. This is Bloomberg Technology.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war...
Treasury 30-year yields fall 15 basis points on the day to around 4.125%.
There are risks to Ukraine's independence. If there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Cerebras Systems, a startup making chips optimized for AI, has filed confidentially for an initial public offering. Sources say it's picked Citigroup as the lead bank on its IPO and that it's targeting a listing in the second half of this year. Bloomberg's Amy Orr here with me in New York City. You and I have been tracking this one for a little while with the team. It's interesting. Let's start with the basics of what we know. Timing, who's involved.
So the timing is going to be in early October. So that would kind of like be the group of IPOs that is going to list and go for an offering like after Labor Day. Because right now the IPO kind of window is kind of slightly shut after the July kind of slew of IPOs. And then the next window is going to be September, October, before everything is probably going to slow down because of the election kind of volatility.
Yeah, let's see. It's an interesting decision to make, isn't it? I mean, the reason that Cerebras is interesting as a startup, as a company, beyond the money it's raised and the people already on the cap table, is what it does. You know, it's very on brand for what's in vogue at the moment. What do you make of that? And I guess it's shoppability or saleability in this market.
I think a lot of people have been like talking about AI, especially with the sell down right now, is talking about whether AI actually does produce money, right? But because there's been quite a lot of like AI adjacent plays like Reddit, they were trying to tap into that market. But Cerebras actually is right smack in the middle of it. It produces chips. It makes the largest chip on the market. It's much bigger than the others. If you think about normal chips are the size of a postage stamp, this one is in the size of a dinner plate. So with more memory, with more
So in 5 minutes time now at the top of the hour, we expect comments from Chicago Fed President Goolsbee, who was interviewed on Bloomberg TV. The live video to which is available on his entry in the calendar for anybody interested.
Include military, government, and also like pharmaceutical companies in the drug discovery process. So that's like really at the heart, at the core of what people are looking for in terms of AI uses.
Bloomberg's Amy Orr breaking a lot of news recently, but this is one that's been interesting for me to be involved in as well. We have to go back to the markets. This is what it looks like this Friday. Remember, on aggregate, the NASDAQ 100 is headed for its 4th straight weekly decline, matching the run of drops we saw in April, and is technically in correction territory. The big drags, you see them on the screen. Amazon down 9%, Intel down 26%, on track for its biggest drop since 1982, and then bucking that trend is Apple, up 2 percentage points to the upside, where there was a return to growth. There are some big questions about how much money needs to be spent on the infrastructure side to get us to this world where AI is generating meaningfully on the top and bottom line. It's actually been a really wonderful week to be in New York City. That does it for this edition of Bloomberg Technology. Don't forget to recap all the conversations we've had today on the podcast. They were dynamic and there's a lot going on. You know where to find it, on the terminal, the Bloomberg platforms, as well as on Apple, Spotify, and iHeart. So right after the show, I'm jumping on a plane back to San Francisco. I'll see you next week. That does it for this edition of Bloomberg Technology. This is Bloomberg.
Names in tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software.
So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Nobody covers technology like Bloomberg. Context changes everything. Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
So 1 minute remaining to expecting comments from Fed Goolsby.
Businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
From New York City for our viewers worldwide, I'm Shonali Bassick, and Bloomberg Real Yield starts right now. Coming up, the latest payrolls report coming in weaker than expected, leading investors to question if the Fed is too slow to cut rates, and sends Treasury yields falling across the curve. And we caught up earlier today with Mohamed El-Arian following that jobs report.
Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action. I think the market now fully understands that the Fed may be late.
Taking a look here at world interest rate probabilities, WIRP Go on the terminal. Remember, economists at almost every major bank recalibrated their forecast for the year after that jobs data. Citigroup economists now expecting a half-point rate cut in September and November and another quarter point in December. JP Morgan believing a rate cut could come even sooner than that next September meeting. Flip up the board here, too, because in addition to the swaps markets, you have the spot market moving drastically. That two-year yield dropping more than 44 basis points this week and 20 today alone. Just a drastic move over the week that you haven't seen since the SVB collapse. And live now on Bloomberg Television and Radio, I am Shonali Bassick. Joining us now is Bloomberg's Michael McKee and Chicago Fed President Austin Goolsby. Mike, get us started.
Thank you, Shonali, and thank you to everybody who is watching us around the world, including Austin Goolsby joining us from Chicago. Thank you very much, Mr. President. Hiring dropped precipitously. The unemployment rate shoots up more than anticipated. Everyone wants to know, did the Fed make a mistake by not cutting rates on Wednesday?
Well, look, you know I'm not going to get myself in trouble and talk about what people's thinking are from the meeting. You're going to have to wait for the transcript to come out to see what was on people's mind. I've been saying to you, Mike, for a long time and publicly that we'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase.
Fed Goolsby says I've been saying for a long time that we'd never want to overreact to 1 month's data point.
And to move in a steady way. I've been warning that we are tight, we are restrictive. The real Fed funds rate is as high as it's been in decades. And as inflation falls, that gets tighter. If we stay restrictive for too long,
Goolsby as the job of the central bank is to move in a steady way.
The employment side of the mandate, and if you look here, if you take this summary,
Goolsby says we are tight and restrictive.
In the SEP, the neutral rate of inflation, the long-term rate of inflation and unemployment.
Says if we stay restrictive for too long, we have to think about the employment mandate.
So if unemployment is going to go up higher than the neutral rate, that is exactly the kind of pinching on the other side of the mandate that the law says the Fed has to think about and respond to.
Well, you've been talking about a rate cut, yet you voted to keep rates unchanged. Why did you do that? And now do you think maybe you are behind the curve?
Well, look, like I say, I'm not going to.
Goolsbee says if unemployment is going to go up higher than 4.1%, that's the kind of thing the Fed has to respond to.
I was a seat filler at the Oscars. That's really Cleveland's seat. I was there for one meeting. The committee acts on the through line of the data, and the through line of the data, you should not change what you think the through line is based on 1 month's number. But in the overall, you know that I believe that we are restrictive. I think that I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that
Goolsbee says the through line of the data doesn't change based on 1 month's number.
Thinking about the employment side of the mandate.
Well, you've heard what the banks, economists, and traders are saying today. Should the next move in September be a 50 basis
and
point
Goolsbee says
cut?
we have been seeing the improvement that we wanted on inflation.
Proposing from a risk management perspective, there's a strong case to act before September 18th.
Look, Paul Volcker, my old mentor and friend, used to always, our job is to act and their job is to react. And let's not get the order mixed up on that. I fully understand why markets want to jump. If they get one scrap of information or they see one thing, they want to conclude a trend out of one data point. And I would just caution us, if we had acted at the end of 2023 based on a couple of observations, then the same people would have said, but look, inflation went back up in the first quarter, so that was a mistake. I think the most important thing is to look at the through line. What will determine the action is we don't want to tie our hands now. We're going to get a lot of information between now and the next meeting. And what will determine
Goolsbee says I fully understand why markets want to conclude a trend.
At all will be the conditions. And that's the way it should be. That's, as I always say, the data dogs, there's a time for walking, there's a time for sniffing. The sniffing time is when there's a lot of uncertainty and you don't know what's what. Once you get the through line, that's the time for walking.
What exactly would it take to see a cut before that September meeting?
Goolsbee says what will determine the size of rate cut, if there is any action, will be the economic conditions.
The FOMC acts in
Goolsbee adding there's going to be a lot of information between now and the next meeting.
And debate, and we vote on things, and I hope, I try to bring the through line mentality of you don't take 1 month's number, look at what the trends are, and to me, the trends show inflation coming down across the board multiple months in a row. They show the labor market cooling. What we want is for the labor market to get into good balance, sort of the full employment natural rate. If we're not stopping at that, and we're not neutral.
Goolsbee says the trend shows inflation coming down across the board and the labor market cooling.
It's also about the path forward from here. For the people that think that you might get multiple half-point rate cuts through September, through November, through December, what do you tell them in terms of what to expect for the entirety of the path going into next year?
Goolsbee says we want the labour market going into better balance. A rate cut size again will be determined by the conditions.
So I certainly don't want to commit ourselves to what's going to be the rate path 5-7 meetings from now. With all of that said, just look at the statement of economic projections, and you can see that as a committee of the individuals have believed that the conditions will be appropriate to have multiple rate cuts with the unemployment getting into better balance and with inflation coming down to target, but even at a run rate that's a little higher than what we've seen in the last couple of months. So it's not any secret. The Fed's been pretty vocal about here's what the reaction function is and expecting, as is historically true, when conditions warrant a cut, they tend not to be one individual cut. The SEP shows that the median dot of the dot plot has multiple cuts over the next year.
How weak is the U.S. economy overall? I want to point out something that your governor, J.B. Pritzker, the governor of Illinois, said just 2 days ago. Interest rates are holding companies back from making the investments
Goolsbee says it's not a secret that Fed policymakers expect multiple cuts over the next year.
Generally upward trajectory over the last decade, but are having a hard time in the moment because of some of the challenges the Federal Reserve has brought.
I mean, in a way, that's a description of monetary policy. That sounds like he's saying policy is restrictive, and I agree with him. When the real federal funds rate, that is the Fed funds rate minus inflation.
Goolsbee says, however, when conditions warrant cuts, tends not to be just one.
Cycle as inflation comes down. We set that rate a year ago at a time when conditions were very different than they are now. And you should be tightening by choice, not by accident. You shouldn't back yourself into tightening. What we need to do is take the through line on inflation and unemployment, and that's what should determine our policy. I don't want to argue about the words, how good or how weak is the economy. Well, the numbers are the numbers. We've seen GDP growing around trend. We had one weaker than expected GDP growth number at the beginning of the year. Then we had a stronger than expected in the second quarter. And so we're growing, but it's slowing down. The strongest thing in the economy has been the job market. The weakest thing in the economy has been the inflation. Both of those are converging back to, let's call it normal or what it was pre-pandemic. And our absolute goal now is we want to settle at something like full employment, not blow through normal and deteriorate.
Well, I think the major thing that people want to know going forward is, now you mentioned all the data coming up. What are you going to be looking at? What are you going to base your interest rate decisions on?
I mean, for the dual mandate comes to us by law. The law says the primary things we got to look at are inflation and the job market, and are we maximizing employment? So those are going to be the big two kahunas as we go forward. But it is still an economy with cross currents, where you got some things that remain quite strong by historical terms and other things that have deteriorated. So if you look at credit card delinquencies or small business defaults, those have been rising, and they have moved into what I call warning sign stage. So
Goolsbee says the economy still has cross currents.
Powell calls the totality of the data, not just the monthly PCE inflation and jobs reports, but the PCE inflation and the jobs reports are the big two for sure by law.
We do have to leave it there. Wish we had more time, of course. That is Bloomberg's Michael McKee and Chicago Fed President Austin Goolsbee, off the heels of a very highly watched and surprising jobs report. We thank you both very much for your time.
Fed Goolsbee says small business defaults and delinquencies are rising in a warning sign stage.
Of JP Morgan and Steve Brown of Guggenheim to react to these market moves, very drastic, and of course Austin Goolsbee's comments. Stick with us. That's all up next. This is Bloomberg.
about this case, the more it reads like a Hollywood script. The nature of the killings, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant one bite at a time?
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
We'd never want to overreact to any 1 month's numbers. And if you back up to the last half of 2023, you know that the market said maybe there would be 7 cuts for the year. And then when a month would come in, then that 7 would drop to 3. Then there was a group saying maybe there will be an increase in rates. The job of the central bank is to figure out the through line and to move in a steady way.
I'm Shonali Bassick, and this is Bloomberg Real Yield. And that was Chicago Fed President Austin Goolsbee speaking with us just moments ago. And here with us now is Kay Herr of JP Morgan and Steve Brown of Guggenheim. And Kay, when you look over at JP Morgan right now, and it's aligned with Citigroup, this new call for that 50 basis point cut in September, another in November, maybe one even before September. How do you feel?
So hang on, I need to clarify. I'm from JP Morgan Asset Management, and so I think you're referring to Michael Feroli and our investment bank. A lot of respect for him, but that's actually not where we are. And I was struck by Austin Goolsbee's comments, because I never really thought about the similarities between Federal Reserve Governor and being a portfolio manager. So the sell side and the markets absolutely are going to react to what every single data point. But if you think about what Fed Chairman Powell said on Wednesday, or what Austin Goolsbee just said with you, they're looking at, I think he called it the through line, they're looking at the overall data, and we're doing the same thing. We're trying to manage portfolios and generate alpha for our clients and try to outperform our peers. We're not really trying to focus on what is today's action and what do we respond to that about.
Well, that's fascinating. Steve, how do you see the conundrum here? When you think about the moves in the market, not just today, frankly, this whole week, we'll talk about that more in a second, how do you think the market has reacted? Has it justified the moves that you're seeing?
Well, I think Kay brings up some great points. We like to take stock in the total picture, and as Mr. Goolsbee laid out, the Fed has been very data dependent and on a long-run trajectory for needing to validate certain data points for them to start to recalibrate policy, as they're calling it. So we've expected throughout the whole year that the Fed would be on hold, that eventually they would start easing, that there would be growing risks in the economy and the trajectory of economic growth. And so those risks are just becoming more to the forefront. And so now the two-sided nature of battling inflation and keeping the economy afloat are now skewed more towards downside risks in the economy, as we saw with the jobs report this morning. And so we think that brings the Fed closer to action. The most important point of the last week and a half, really, has been the pulling forward of interest rate cuts and then the deepening of the trough in the terminal rate. So seeing the terminal rate now closer to 3% is something we've been positioning for and something that we frankly think makes sense.
Put these moves into perspective, Kay, because you're looking at a 2-year yield alone that stood nearer to 4.40 at the beginning of the week. Now you're at 3.9%. Do these moves make sense?
So I think you need to take a step back and think about the market. And as I said, the market reacts to every single data point, whether it should or shouldn't. And I was struck by Mr. Goolsby's comments, and it's something that we've noted as well. In the last 6 months alone, the market has been everywhere from the Fed's going to actually hike one time because the economy and inflation are reaccelerating, to the Fed's going to need to cut 6 to 7 times. You know, a year ago, if we'd been on this program, we would have said, oh my goodness, recession's coming. But if I look at our JP Morgan asset management perspective,
As we're seeing some flow in Fed fund futures here as well, some buying after the JP Morgan seeing a case for Fed cuts before September. And so again, we're seeing some buying in August contracts for Fed funds futures, which is obviously expiring before the scheduled September 18th next Fed meeting. Therefore, buying at these levels for new risk would benefit from additional pricing of an emergency intra-meeting policy move by the Federal Reserve.
Yes, we still like duration. I think we like duration. We also have interest in curve steepeners. So yes, we still find those attractive. But when we think about investing, we're looking about the fundamental, the quantitative, and the technical. In terms of the fundamentals today, yes, we absolutely see signs that the U.S. economy, the labor market is weakening.
Some flow in Fed fund futures here as some traders betting that the Federal Reserve may make an emergency interest rate intra-meeting move before the next September meeting, joining calls by some in JP Morgan who are saying that this is a potential case.
And focusing instead on the labor market. So they noted moderation in the labor market. They thought about the labor market coming into balance. What the markets, I think for lack of a better expression, freaking out about today is that the labor market's not coming into balance, that the labor market is heading headfirst into a recession.
To that end, too, that data that we saw today, depending on how you round it, Steve, people are really worried about the triggering of the SOM rule, perhaps a greater play at a recession ahead. What is that risk in your view?
I mean, we've been flagging it as an above normal risk of a slowdown and potentially a recession, but it's not our base case, similar to Kay. Our base case is that we will continue to grow, potentially below trend of the last couple of years. But under the surface in the jobs report, as we've had a couple hours now, there's a little bit more mixed conclusions. It certainly was a weak report. And the greatest risk that we've been seeing has been the concentration in job gains to certain sectors over the last couple of months. So the broadening out of hiring has not been there. And so there's been a lot of focus on the SOM rule. I mean, in short, it really just says that when the unemployment rate rises by 0.5%, it tends to not stop there. So we're in danger zone, if you will, with employment. But as Mr. Goolsby laid out, next month's release could change that trajectory a bit. I think what's important to us is acknowledging our risks one-sided or kind of more equally distributed, and what does that mean for policy and for rates? And so the moving forward of cuts, the deepening of the totality of cuts, we think makes sense and aligns with how we're positioned.
I feel like we need to do the very annoying thing here and just talk about the risks still ahead for the next couple months. You have, for example, the election coming up. A lot of concerns about potential inflationary forces ahead under whatever president might take the office in November. How do you think about this drastic move and the risk that perhaps this market has gone a little too far?
So, Shonali, I mean, that's what we're dealing with every single day, basically, right? You talk about big, yes, this was absolutely a big economic debate, but you know what? Next week, we've got ISM services. We've got data every single week, and you're right. Increasingly, we are going to get more and more information about the election, and it seems unlikely that, or it seems likely that either candidate was successful may well be inflationary, but I think the more immediate concern is absolutely the risk to the downside in inflation. We continue to maintain that our base case is soft landing, though, and that is our position.
Only about 30 seconds left for each of you. Where do you think the 10-year ends next year?
So this year we kind of think 3.75 to 4.25. I think next year is really a function on whether the Fed gets ahead and is able to maintain a soft landing, or whether we do in fact slip in a recession, and I think the risk therefore would be skewed to the downside next year.
Steve, 10 seconds, 10-year at the end of 2025.
At the end of 25, in the mid to high threes, we expect an upward sloping yield curve and a normalization of yields going from, call it low threes, upwards to 4 as you go out the yield curve.
That curve steepening trade still in full play. That is Kay Her of JP Morgan and Steve Brown of Guggenheim. Thank you both for joining us, of course, on a very busy day of economic news. Happy Friday to both of you. Now, still ahead, the final spread, the week ahead, economic data and earnings season still in full swing. This is Real Yield on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth value is coming from the smallest of players. 3,184 hits, 431 home runs, and of course the most famous stat that everybody knows, 2,632 consecutive games played. Unmatched career. Why are you doing this?
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word, winning. You win on the court, you win off the court. And as you do that, you bring people along.
I'm Shonali Bassick, and this is Bloomberg Real Yield, and it's time now for the final spread, the week ahead. Coming up, we're going to hear on Monday from San Francisco Fed President Mary Daly, plus we'll get U.S. PMIs and ISM services. Tuesday, U.S. trade balance figures and earnings from Uber, Reddit, and Airbnb. Wednesday, more earnings from Disney and Lyft, plus U.S. consumer credit data. I'm looking forward to that. Finally, Friday, we'll get China and Europe CPI numbers. And for my final thought, I want to look at those wild market moves, because if you think the VIX is flying, so is the MOVE Index. We're taking a look here at just how much volatility is seeping right back into markets. And of course, on the MOVE, we are back above 100 handle, and on the VIX, well above that 25 handle. That sets up for a very interesting week ahead. From New York today, though, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.
Liquidity is the lifeblood of an airline. We make very conservative decision making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Welcome to Bloomberg Markets. I'm Shonali Basak. Stocks are sinking as a weak July jobs report is rattling Wall Street. We're going to check on these markets now because we're off the lows of the day for stocks, but still firmly in the red. The S&P 500 down more than 1.8%, almost 1.9%. NASDAQ 100 down 2.2% today still. The Russell 2000, remember, this is the trade that everyone was piling into for the last couple of weeks, now down almost 3.4%. That VIX just stunningly elevated, almost 10 notches higher than where we started the week, above 25. We're going to look a little closer at the NASDAQ 100, near correction territory from its peak on July 10th, down more than 9%, just a hair away from that 10% needed to be called a correction. But of course, after those big tech earnings, very ugly moves here on another very crowded trade. And some midday movers here on the equity side. Intel shares are plummeting. They are suffering their largest decline in over 40 years. This drop comes after the company announced a grim forecast and laid out plans to cut more than 15% of its workforce. It also is suspending dividend payments. It has paid a dividend since 1992. Meanwhile, Amazon shares are also sliding, its biggest intraday drop on more than a year. On an intraday basis, of course, the company told investors that it will prioritize heavy spending on AI over profits. Amazon projecting a range of operating income for the current quarter that falls short of analyst estimates, and you're looking at a more than 9% drop on Amazon throughout the day. When looking at this market volatility through the lens of credit, the North American Investment Grade Credit Index has spiked higher this week. The benchmark increases as credit risk rises, and it is now at the highest level since April. Credit investors are certainly keeping an eye on the Fed and these market moves. And Chicago Fed President Austin Goolsbee explained his perspective a little earlier in an exclusive interview.
I've been saying for months that what we wanted to see was improvement on inflation and especially improvement in the components like housing and services. And we've been seeing that. And that the longer we were restrictive, we're going to have to start thinking about the employment side of the mandate.
Now bringing in Danielle Pauly, Assistant Portfolio Manager with Oaktree's Global Credit Strategy, and James Athey, Marlboro Co-Manager of Global Bond and Bond Income Funds. And you take a look at the jobs data this morning, and two words permeated the market, didn't it? It was growth, scare. Danielle, when you're thinking about the riskier parts of the credit market here, do you get a little concerned?
Thanks, Shonali. Great to be here with you today. You know, we just recently published our second quarter performing credit outlook piece, and we titled it The Dual Economy, owing to these risks that we're seeing in a bifurcated economy. And I'll just try and explain it simply as a tale of two consumers. You have, on one hand, the wealthy that have seen their asset bases grow with the soaring stock prices that we had seen. Record number of billionaires. And what this does is it's driven up prices in all asset classes, and financial markets have been booming. But then on the other hand, you have lower and middle income consumers that are really hurting. They're facing pressures from higher interest rates and high prices. Their savings are depleted. We're starting to look at credit card delinquencies back up at 2011 levels. And so we are seeing signs that the economy is weakening, importantly, in companies having this impact on their earnings. So it is very important, as always, to be an active manager and really underwriting those companies that we're lending to for a weaker environment that we see going forward.
James, it's really funny because when you look at the bond market here, of course, you've seen these very tight spreads. People have not really been concerned about the bond market. You're seeing now a severe movement in the stock market. You can ask the question, what is riskier right now, high-yield bonds or the stock market that people have been following into for so long?
Yeah, I mean, notwithstanding what happened in Switzerland with the AT1 market, obviously, if you're an equity investor, you're at the bottom of the cap stack. I don't think many people are talking about the sort of large cap defaults that make you worried about that reality if you have been investing in Magnificent Seven or much of the large cap indices. But again, I think what's been forgotten in this whole conversation recently is just the risks that one is running and the compensation that one is receiving for those. So when you see a 10-year Treasury yield, which is higher than the earnings yield on the S&P 500, that's telling you that there is no equity risk premium and you are paying through the nose to invest in a riskier security, and that's not a bad thing if you're at a stage of the cycle where you can expect growth to remain robust or to accelerate. But all of the conditions that would describe the end of the cycle have been in place now for a number of months. Unemployment has been steadily rising. And investors, I think, have continued to choose to believe that a soft landing is the likely outcome, merely because it suits the positions that they're running, not really because there is solid evidence or solid historical analogues for that.
You know, it's interesting when you see the morning's jobs numbers come out and it become weaker than many economists had expected here. Danielle, you've been warning of kind of the bifurcation of the consumer, but how much worse do things get now that we're starting to see a more significant weakening of the labor market?
Yeah, look, the numbers were weaker today. We're not macro forecasters, but it wasn't particularly surprising to us, just given that we have seen divergences in the data from the establishment and household surveys. We've seen downward revisions to the establishment data before, and this is overall a trend that we've been, eyeing for some time. I agree with James. Equities need growth to work. And today in credit, you can get such a high income from high quality paper that you're being kind of paid to wait and be conservative. There could be more dislocation in the market ahead. It's a good idea in a portfolio to have some cash or some short duration investment grade paper that you can sell in a time of a dislocation. But generally, we're in an environment where we want to wait and see, and we want to prioritize credit selection and active management.
You know, it's interesting, James, to that end, how much cash would you hold at this moment? And is it for the purposes of waiting for some powder to stay dry for those dislocations to materialize, or because cash isn't that cheap right now?
No, I mean, that's true. Obviously, when you're a professional investor, generally you've got a mandate, and that doesn't always allow you to hold significant cash. I think as a person in the streets, investment cash has been a very attractive place to be invested because it's higher yielding than all of the government bond curve, and it obviously buys you optionality. But I actually think we've sort of passed the moment where cash is the favoured place to be. I think duration has increasingly looked attractive because it has been so cheap relative to equities and relative to corporate bonds. High yield spreads have been very tight, investment grade spreads have been very tight. And what we see in these sort of risk off or growth scare bond rallies is not that credit doesn't participate, it does to some degree, but those spreads move wider. And so the opportunity cost of holding riskier securities rather than government securities, or indeed the opportunity cost of holding cash, has been pretty large over the last month or so, just because yields in core government bond markets have moved down so quickly. So I liked duration. We continue to like duration. Maybe the market is a bit over its skis in the short term, but we'll certainly use backups to increase our duration position.
Danielle, what's a risk that's more worthwhile to you? Is it taking on more duration risk when you're picking out credits, or is it credit risk?
I think it's both. I think in this type of a market, it's been overly accommodative to borrowers where you just haven't seen the cracks emerge that we would have expected in this cycle. But with rates and restrictive policy and still high, some of those borrowers have unsustainable capital structures, and it's going to get worse, especially in more cyclical sectors. So take a buildings products company, for example, that's done quite well over the last few years coming out of COVID, as people were home and spending money on their homes to improve them. With rates so high, they're not moving and buying new homes. And so they're not going to be having that same type of discretionary spend. And so we see this type of discretionary spend eating into revenues, and we're asking ourselves, can some of these levered companies withstand a 10 to 30% hit to revenues? What does that cash flow look like? And as always, we think credit selection is going to drive returns because you're avoiding defaults to capture that higher income. But in the market today, where we do feel we're at peak rates and the next move is likely going to be down, not up, having duration in the portfolio is great. And we do that through having high yield bonds and some investment grade. When you have a multi-strategy portfolio, you have a lot of different levers that you can pull to keep the engine going in order to generate that high income for your investors.
Danielle, we thank you so much for your time. That is Danielle Pauly, Assistant Portfolio Manager with Oaktree's Global Credit Strategy, and James Appy, Marlborough Co-Manager of Global Bund and Bond Income Funds. Of course, credit markets going wild after that jobs data this morning. Getting a check on markets as well, because between the earnings story and the economic story, you are having quite the sell-off here in the equities market. The S&P 500 dropping 1.9% now, and the NASDAQ 100 still flirting with correction territory, down 2.3% on the day. That 2-year yield has just been stunning at 3.92%. Remember, we started the week closer to 4.4%. The 10-year yield still down almost 15 basis points. We're going to talk a lot more about it, but coming up, we're also going to talk more about earnings, because we have Booking President and CEO Glenn Fogel joining on the heels of a soft outlook for the travel company, a big look in how consumers are operating in an industry that people have been very excited about a rebound. We'll talk about that next. This is Bloomberg.
In global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US, or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive. And that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the company's still making profitable and the credit quality is good.
Nobody covers business like Bloomberg. Our money culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivian, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend, only on Bloomberg.
This is Bloomberg Markets, and I'm Shonali Bassick. It's time now for the stock of the hour. Like the overall market, booking shares are sliding, wiping out gains for the year. And this company comes after the company announced a lower than expected forecast for the next quarter. Booking, though, did report second quarter earnings that mostly beat analyst expectations. Joining us now is Booking CEO and President Glenn Fogel. And we were talking a little bit during the commercial break, near term versus long term, how you think about the volatility ahead. When you think about the current quarter here, what was it that really guided you to beat before we talk about the forward look?
Well, we were very happy, and thanks for having me. We were very happy with the second quarter results coming in above expectations on most of the major metrics. The one metric where we came in line with what we had told the street last quarter, we gave a projection that we pretty much hit the middle of it, was because the airline tickets were less than we thought they'd be. Air tickets, especially in the U.S., have dropped a bit. But for us, that's not a big deal because we don't make money based on the price of the tickets. So it really didn't affect any of the other metrics. It didn't affect revenue, doesn't affect EBITDA. We came in with very good EBITDA numbers, well above expectations. But sometimes the street, takes a look at that, but much more so looks forward, looks what we said about the third quarter. And they obviously said, not so sure about the future. I, of course, don't worry too much about the short run. I worry more about the long run. Long run, it's still well intact.
Well, let's talk about the medium run. You looked at the employment numbers this morning. You have a whole market that is pretty spooked by the slowdown that we're seeing. It all came in below expectations. And the real worry here is if you have wage growth moderating, if you have inflation moderating is a good thing, but you still have that pressure of higher interest rates for now. That could be an overhang here of anyone looking to perhaps buy a trip on a credit card. When you look at the employment numbers as a CEO here in an industry where people are looking to spend that extra dollar, do you worry that things are slowing down?
Well, there are a couple things to think about on that, especially about our company. We're extremely global. So it's interesting, people, when you have a discussion about unemployment, we're talking the U.S., we're not talking global. And yet, for our business, it's very global. So yes, the U.S. is a big market, but it's nowhere near what our full global business is. So it's one small part. And yes, people are talking about sort of a two-speed economy in the U.S., where people who are having a little harder time at the lower part of the economic spectrum. That's true. But again, for travel, a lot of those people weren't traveling to begin with, unfortunately. They weren't able to travel, so the fact that they still can't travel, not as big a deal. What we talked about in our call was that we had not seen, in terms of globally, any real reduction in star rating, nor have we seen a reduction globally in terms of length of stay. Those are two metrics we look at in terms of a canary in the coal mine to see if there's a pullback in travel. So overall, we did mention a little bit of a mild moderation in Europe, but again, not a big deal. But I think people, they jump on any sort of news, short-term traders jumping on it, moving quickly. For me, long-term is what matters.
What gives you the most confidence here that the consumer in the United States would stay strong enough to kind of keep the rest of the year going? At the end of the day, when we talk to a lot of travel companies, there's still a set of confidence here that people want to get out there. How do you balance the pressure that consumers are under and their inclination here to get on the road?
Yeah. So here's the important thing, the way we look at this as we try and manage this company for the long term. There's a couple of trends. One, travel over the long run's always increased more than GDP. So as long as we have a belief that in the long run, GDP is going to grow, travel is going to grow a little bit faster. Then a tailwind for us is that we are a digital player. So do you know it's still approximately half of the people do their travel offline? So that's a tailwind as those people come online, buy stuff digitally. Those are people who come and use us. Then you go into things when you look globally. There's a lot of people around the world who are just beginning to enter that economic level where you can travel. That for us is another positive. Then you throw on the great technological changes that are happening, AI, things like that. That's going to reduce our costs. And it's also going to make it a lot easier to do things like complicated travel, things that we would really be able to do much better, bring more people to us versus our competitors. Why? Because we have the experience in doing AI. We're the biggest travel company in the world. We have the scale. We have the AI resources. So again, another positive for us. So I know there are going to be ups and downs in terms of travel in the short term in different parts of the world, the U.S. Maybe there'll be a little slowdown. Maybe there won't be. Long run, it's not going to matter. It's all going to average out in terms of these little volatility pieces, and we'll still do very, very well.
Do you think that anything needs to change through the end of the year? If you think about pricing or if you think about incentives, is there anything we'd want to do to bring more people out?
Well, you know, one of the great things in our business is that we do provide different ways for our suppliers, airlines, hotels, car rentals, ways for them to get more demand when they need it. So it's a little counter-cyclical. So if the economy starts going down and if travel starts to pull back in an area, we have lots of ways for the different suppliers to use different ways to get business that they may not be able to get otherwise. One, for example, is a thing we call our Genius program. More companies will come into our Genius program, meaning they're going to give discounts to our Genius members. Another thing is special rates to buy on our mobile devices, or perhaps certain geographical special prices. Lots of different ways for companies who need to get more demand to use our services to get more for them. And that's really what we'll see. And I think maybe we saw a little of that in the airline tickets starting to drop because not as much demand as they thought there'd be.
Glenn, we have to leave it there. Glenn Flogel is the president and CEO of Booking. We thank you so very much for joining us on the heels of another earnings report. And coming up, we're going to talk about Elliott Management calling the AI hype a bubble. NVIDIA shares are under pressure. We're going to discuss how hedge funds are grappling with the tech sell-off. And let's look at that sell-off as we head to break as well, because we're watching the S&P 500 now down more than 2%. That NASDAQ 100 down 2.5%. That Russell 2000, remember, we were watching a market here that people really flooded into those small and mid caps, now down 3.3%. And the VIX at 25, just stunning. You have to understand that VIX that high could have some interesting implications if it holds steady into next week for capital markets activity that we have seen coming back. We will bring you more markets as they come. This is Bloomberg.
Earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
This is Bloomberg Markets, and I'm Sonali Basak. Elliott Management, that's Paul Singer's hedge fund firm, is reportedly telling clients that NVIDIA is in a, quote, bubble land, and it's skeptical of the AI hype. Take a look at NVIDIA trading volume today. The blue line on this chart shows that average volume throughout the day, and the white line is today. The Bloomberg estimates more than 500 million shares will be traded by 4 p.m. Bloomberg's Hema Parmar reported on all of this, too, and I want to kind of touch back at the note that Elliott was saying here. Elliott being kind of one to lean on the fear factor is not strange for Paul Singer and Elliott. How did you read this note reported by the Financial Times earlier today?
Yes, so the F2 report said that Elliott came out here really being, not unsurprisingly, bearish on NVIDIA, saying that he's very skeptical that companies are going to still be relying on the processing units. He says that AI is overhyped, that the applications aren't ready yet, that it's never really going to be cost-effective AI technologies. It's not going to work right. It's going to take up too much energy or be untrustworthy. So some really bold language here when we look at the bearishness on NVIDIA, very likely why that stock made up only a tiny portion of their portfolio as of March.
Right, so good point there. They were in it, but it's interesting to see if they, as an activist investor, will get into any of these stocks as well. I also want to talk a little bit broader about the hedge fund industry right now, because you had a great report about Coatue in the last 24 hours here. Big tech was pretty decent this year. How are we seeing companies starting to get burned?
Yes, so a lot of the hedge funds that we talk about, especially the stock pickers, are all invested in their biggest companies, in the tech companies, Meta, Amazon, Microsoft. So when we look at Coatue, they posted their worst monthly performance so far this year, last month, down nearly 4%. And what that means for their year-to-date returns is it brings it down from about 9 to about 5, excuse me. And their biggest stakes, Meta, Amazon, and Microsoft. And you see that now when we look at the other hedge funds too, Tiger, Lone Pine, Whale Rock, and Light Street, all in these big names in amongst their largest positions. So we can expect potentially more pain to come from such names as we wait for returns over the next couple of days.
Stan Druckenmiller looking pretty smart now for trimming that exposure a little earlier, even before that rally in the midterm. Bloomberg's Hema Parmar, we thank you so very much for your time. Of course, a lot of crowded names there, but we're going to look at some more crowded trades here. We want to pull up the board, pull up the bond market. That is where we're seeing a ton of moves here. The 2-year down closer to 390 on the day. Cross asset moves are kind of crazy. Brent crude down to the 76 handle, and the VIX even higher now to 26. That sell-off has been intensifying all day. We'll keep an eye on it through the close. Of course, these moves come on top of a tough day yesterday as well. Tough way to end the week, but of course another week ahead. Have a great weekend all. I'm Sonali Basak. That does it for Bloomberg Markets, and this is Bloomberg.
what's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning from our world headquarters in New York. I'm Manus Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
From the world of politics to the world of business, this is Balance of Power.
So shortly expecting the results of the Baker Hughes rig count data for the week. On release, I'll be leading with the oil rigs.
Jobs Day disappoints, markets see red, and the political implications could be huge. Welcome to the fastest show in politics. As today's jobs report points to weakness and gives new fuel to the hard landing crowd, I'm Joe Matthew alongside Kaylee Lines in Washington. That, Kaylee, would not be good news for the Kamala Harris campaign on a day we would otherwise be celebrating BAFO fundraising numbers for her.
Yeah, $310 million, no small figure, but you're exactly right, Joe. Not only is this bad news potentially for who is effectively the incumbent presidential candidate, but of course it's bad news for the equity market as well. We're looking at potentially the worst jobs day reaction the S&P 500 has seen in 2 years, but massive buying coming into the bond market. Yep. We're down 24 basis points on the 2-year yield on the day as people are now pricing in potentially more aggressive Fed rate cuts just around the corner.
Yeah, stocks are hurting too. You've got the S&P 500 down over 2%.
Baker Hughes total rigs 586, 586, waiting on oil rigs.
Democrats want to be talking about as they head for their convention this month in Chicago.
Indeed, it's just weeks away. We'll have much more on the political implications this hour. But first, let's get you a full update on this market action we're seeing on this jobs day. Charlie Pellet has that for us up in New York. Hey, Charlie.
Indeed. Right now, Kaylee Lines, we are looking at the worst jobs day for the S&P 500 index in almost 2 years. Indeed, Wall Street's fear gauge, the VIX, soaring towards its highest level since 2022.
Oil rigs 482, 482.
The S&P down 117, down 2.1%. Dow Industrials down 781, down 1.9%, while NASDAQ now down 453, a decline there of 2.6%. The 10-year at 3.81% with a 2-year 3.90%, and we have got gold, spot gold down 0.7%, 24.30 the ounce, while West Texas Intermediate crude oil right now down by 3.9%, 73.31 for a barrel of WTI. Our just meant we'll have a whole lot more on the markets coming up in just a moment. Not all about the jobs report. Indeed, a lot of reaction to earnings. Intel plunging 27.7% after last night's report. We've got Amazon trading lower now by 9.8%. Apple shares, though, after earnings, up by 2.7%. Again, recapping, we got the S&P on track for its worst day in reaction to jobs data in almost 2 years. S&P now down by 2.2%. I'm Charlie Pellet. Balance of Power continues now. Back we go to Washington. Joe Matthew and Kaylee Lines.
All right, Charlie Pellet in New York, thank you so much. I'm Kaylee Lines alongside Joe Matthew. Welcome to Balance of Power on this jobs day. We've been talking a lot, Joe, about how the economy was looking pretty good, and yet the incumbent administration wasn't getting credit for it.
That's right.
The question is, are they going to get the credit now that it does seem that things are turning south?
Well, that's true, certainly in terms of the markets and an economy that just seems to be slowing more quickly than anyone was talking about, even just a couple of weeks ago here. And a big question about whether the Fed has missed an opportunity. with now some folks calling for a rate cut before we even get to the meeting in September, and those looking to September are talking about 50, not 25 at this point. Austin Goolsbee spoke earlier to Michael McKee and Shonali Bosick as part of our coverage here on Bloomberg. He was really trying to tamp down the fear, a single data point does not make a trend and so forth. The Fed's got to be concerned about this too.
Yeah, of course they will, presuming that they decide not to make any decisions on rate cuts until their next meeting, get another jobs report before then. But of course, it wasn't just the figures today. You had weak manufacturing data yesterday. You had initial jobless claims at levels that we hadn't seen in some time. So it collectively is what is causing markets to see a bit more of a picture of things deteriorating and perhaps in a way that the Fed did not expect.
And it's one of those days where here on the political show, we're spending a lot of time talking about the markets with a lot of crossover. Kamala Harris may not be tweeting at Jay Powell the way Donald Trump used to, or crowing about highs in the stock market, but there are huge implications here. And we want to start with Michael McKee, who, as I mentioned, did talk to Austin Goolsbee a little bit earlier. Michael, this whole idea that the Fed missed the opportunity, what is the conversation at the FOMC today?
Well, the first thing they will tell you is what they always say: we don't look at one data point and make a decision or a conclusion based on that. And so Austin Goolsbee's reaction was this was not a great report, but it is not a terrible, terrible report. And overall, the economy still seems relatively strong. So let's see what we get going forward. And it is true that markets, their initial response to everything is basically to overreact as people pile in on a momentum trade. And then, people start to pull back and think about what they have actually seen. And so I think the Fed is expecting that as the weeks go on, we will see a little more calm, unless for some reason jobless claims explode, something like that. And then we'll get another payrolls report at the beginning of September before the next Fed meeting. So they'll have an opportunity to see if this is a one-off kind of situation or if this is a really bad trend.
Well, it's not just markets that are reacting, though, Mike. It's not just traders here. It's also economists across Wall Street banks that are essentially revising their forecasts for Fed cuts. You now have JP Morgan and Citi calling for not just a 50 basis point cut in September, but November too, and potentially cutting at every meeting after that. How high is the bar for the Fed not just to cut, but to cut by half a point?
Well, Fed officials would say it is quite a high bar. Jay Powell was asked about it at his news conference on Wednesday, and he said, we're not even thinking about that right now. I think you would need several other data points besides this one that told the Fed that the economy was really in trouble, and then they might do 50. The reaction was interesting because we had even JP Morgan suggesting that maybe the Fed wants to cut intermeeting. So we've gone from a fairly strong economy in Jay Powell's view on Wednesday to a crisis. And, the Fed's going to take a breather before it adopts any crisis fighting activities.
All right, Bloomberg's Michael McKee, our international economics and policy correspondent. Thank you so much for walking us through how the Fed is likely viewing this, as it is abundantly clear how the market is viewing this today. Although it's not just about jobs day. We also had some pretty disappointing earnings from the likes of Intel. That stock right now down 27% on the day. For more, let's bring in Jess Menton, who covers equities for us, where she is a senior reporter here at Bloomberg. So Jess, obviously it's hard to kind of separate what's happening in tech with what's happening in the wider market. To what extent do we attribute this to micro and to macro?
Well, that's a great point, Kaylee, because obviously what we were just talking about here with Mike McKee, and especially the trend when it comes to data points like this, that's what traders always want to say. And actually going into the Fed decision from Fed Chair Jerome Powell and what he was going to signal on Wednesday, a lot of them were expecting a potentially sell the news type moment. We did get a huge rally that afternoon, but since then, of course, a lot of people want to point to some of these data points like the manufacturing data yesterday, and of course the jobs report this morning. But when you had a huge run in really really speculative corners of the market, like the Russell 2000, where everybody's been talking about, especially the last year, wanting to see this rally broaden out. But if you look at the Russell in particular, of course, it's been cheap, especially on the valuation side for that. But because of the massive rally and the historic outperformance it had relative to large caps last month, it's not quite as cheap as it had been. So that was more of a trade than a longer term investment, just because the earnings outlook still remains elusive. So now a lot of traders are turning more toward dividend type paying corners of the market that obviously will benefit more toward rate cuts. So even though some of the gains here for some of those dividend payers gave up some steam this morning, if you look at the flows on a weekly basis, especially when it comes to utilities as well as real estate, they've been on a tear and they are going to benefit. And of course, utilities, obviously there's an AI play element to that, but even beyond some of the power and sort of renewable side of that, if you think of gas utilities, water utilities, those are ones that are doing very well right now, and that's where a lot of the money is flowing.
You know, I'm really glad that you brought up the IWM in this case, Jess. There have been so many people talking about a rotation over the past couple of weeks, and the Tom Lees of the world have been piling money into small caps, waiting for the moment that the Fed starts to cut. It's down 3.5% again today on top of recent losses, knowing that something like half the components of the index don't make money. Is that trade actually over?
That's right, because a lot of that comes down to the amount of zombie companies that are in the Russell 2000. It's a little bit different if you look at the S&P 600 that obviously holds small cap companies. Those tend to generate better earnings growth. But our own GMA, Gina Martin Adams, follows, as well as Mike Casper, obviously the small cap story very closely here. And a lot of that has to do with the revenue outlook moving forward, and especially not just large cap in the midst of earnings season, but also small caps as well. But the issue there is when you have companies like Super Micro that were formerly small cap stocks that get very big, as well as MicroStrategy, and they graduate from that index and move over to other indexes like in the Russell 1000, that makes it harder for the earnings outlook overall for that particular index to improve there. So that's where the side of the equation, because it's gotten more expensive now. So really it's down to whether or not they deliver on the profit as well as the revenue outlook.
We'll keep eyes on it with your help, Jess Menton. We do appreciate it. Bloomberg senior equities reporter with us on a tough day here on Wall Street, this jobs day that we'll keep talking about throughout the hour here, along with politics. A big crossover here, Kaylee Lyons, when we consider the future prospects of Democrats, namely Kamala Harris right now trying to gin up a campaign with a huge influx of cash, but a messaging problem when it comes to the biggest story, the biggest issue on the campaign trail, that's inflation and the economy. Now the question, did the Fed miss the mark?
Yeah, absolutely. And of course, we're likely to hear a lot about this from the Trump campaign in regard to not just the economy, but the way in which he would like to address it. What we've heard consistently from the former president is this idea that deregulation is going to be one of the ways that he tries to bring prices down and help bolster the economy. And it's regulators that we know have gotten a lot of scrutiny from Republicans in general under this administration.
When we consider the eye on the consumer, we turn to the director of the Consumer Financial Protection Bureau in a conversation that we've been looking forward to bringing you here on Bloomberg. Rohit Chopra is with us from World Headquarters in New York. Director Chopra, it's great to see you. Welcome back to Bloomberg TV and Radio. You've been an awfully busy man recently, putting forth new rules that apply regulations to credit card late fees, buy now, pay later, getting an advance on your paycheck, even large asset managers. What's your priority this summer?
Well, one of the things that we're always going to be focused on is trying to lower some of the prices, including corporate gouging by some of these companies. We're seeing how firms, including big credit card companies, exploiting old regulatory loopholes, even dating back decades. And we're putting a stop to a lot of it. It's going to save households a lot of money. We hear all the time from special interests that there's going to be consequences that are harmful. It's not going to bear out, because this is really about making sure the law is being followed and consumers are being treated fairly.
Well, of course, it doesn't really stop there. When we look at your agenda and the rules you've been passing recently, you also made some proposed tweaks to the Change in Bank Control Act. Could you just clarify, as you're looking at these larger asset managers, what this change actually is going to mean in reality for the likes of BlackRock or other giants out there?
Well, there's been a real rethinking when it comes to mergers and merger review. I used to serve as a commissioner on the FTC, and the status quo 5 years ago was just to be a rubber stamp. But we're now seeing much more rigorous merger review across sectors. And when it comes to banks, that's no different. We're looking much harder at all sorts of bank acquisitions to make sure that it's not reducing competition, that consumers can get good rates no matter where they go. Now, you asked specifically about BlackRock and other big asset managers. We're really starting to scrutinize whether these companies are truly being passive. Part of the way they have avoided scrutiny of their acquisitions is they say, we're not doing this to take control like a normal merger or normal acquisition. We're just a passive investor. But we want to make sure that they're truly being passive and not the ones calling the shots.
I want to ask you about buy now, pay later, which has been such a massive trend, and companies like Affirm have been rewarded for it on Wall Street. Your new rules are somewhat interpretive here, and some consumer groups, even some banks, have asked you to strengthen these rules, to go a bit further, to mandate a borrower's ability to repay, for instance, and even bring firms like the one I mentioned under your direct supervision. Is that something that should happen?
Well, buy now, pay later got big during the pandemic. It grew about tenfold from 2019 to 2021. And we're seeing it as an option in almost every single online checkout. But you know, buy now, pay later has to be treating people fairly. They have to be upfront with all the key terms. So we're making it very clear that no matter what you call yourself, you have to make sure you follow the laws that apply to credit. We think there are tens of billions of dollars of transactions that buy now, pay later consumers are really on the hook for. So I do think we're going to have to keep scrutinizing these firms, but at the end of the day, we want it to be an option for people that they can compare side by side, and we want these companies to compete on service and price and not exploit regulatory loopholes.
Well, sir, of course, when we consider buy now, pay later, it plays into this entire notion of the fact that consumers are piling up on debt more now that all those pandemic-era savings have been depleted, and especially in light of data that we're seeing, including what we got, a softer jobs report today. Are you worried from your perch looking at consumers and their financial health that real cracks are starting to emerge, that we could start to see more delinquencies? Now, what are you bracing for?
It's really interesting. 2 years ago, we really
shortly expecting results from the Fed reverse repo facility
much more quickly. And in fact, we have returned to normal. In some places, I do see some worrisome signs in subprime auto, in parts of the credit card market. But we're going to be fixated to look at where that debt is and how it's performing. I do worry that some of the credit card interest rates that people are paying are just so much higher than they were paying before. And that's not just due to changes in monetary policy. Credit card issuers have pumped up the margins that they've been charging now, and Americans are paying about
63 counterparties take $338.473 billion at the Fed reverse repo operation.
Can really put them on a treadmill. So we are looking hard at credit cards, at auto loans, and of course mortgages. So far, we see a little bit of stress, and we want to make sure we're taking the right steps that it doesn't spread. And I will just share, there's just no question that the higher rate environment has really hit American households on all types of things. Of course, mortgages being the biggest, but credit cards and auto loans really hitting people's pockets.
I want to ask you in our remaining moment or so, Rohit, about funding. Now that the Supreme Court has validated the Bureau's funding structure, I wonder if you feel more confident moving forward with rulemaking, and what would happen if Donald Trump was elected president?
Well, you know, we did prevail in the Supreme Court in a decision authored by Clarence Thomas that made totally clear that our funding is legal. I really think the banking industry has benefited from the CFPB. We really have taken out a lot of scammers and fraudsters and really focused on some of the pain points for consumers that they're facing. So, I don't like to predict about what will happen in the future, but here's what I will say. The work that we've been doing to take on some of these junk fee abuses, to let people switch their banking products and credit cards more easily, to embrace how new technology can open up new opportunities, that's only controversial in Washington. Everywhere else, that's what they want to see their government do, is look to the future and help people protect their finances so that they can build their future.
All right, Director Chopra, we appreciate you joining us here on Balance of Power. Thank you so much for your time, sir. That, of course, was Rohit Chopra, Director of the Consumer Financial Protection Bureau, joining us today.
So according to the Democratic National Committee Chairman, Kamala Harris crosses the delegate threshold needed to become the Democratic presidential nominee officially now.
Our signature political panel, Rick and Jeannie, are next on Bloomberg TV and radio.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs.
Take a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
Always on the heartbeat of the tech
spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure. Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Our money culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
Inspired by the fusion of East and West.
I'm the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. We begin with a developing story and a headline off the Bloomberg Professional Service. Dun & Bradstreet said to be exploring a sale amid takeover interest. That from Reuters. Right now, we've got Dun & Bradstreet shares surging by 20.1%. All of this on a down day for the U.S. stock market. S&P 500 index on track for its worst jobs day in 2 years. S&P right now down 120 points, a decline of 2.2%. Dow Industrials down 844, down 2%. NASDAQ lower by 454 points, a decline of 2.6%. The 10-year at 3.81%, with a 2-year this jobs Friday, 3.90%. Spot gold down 0.8%, 24.27 the ounce. West Texas Intermediate crude oil down 3.7%, 73.47 for a barrel of WTI. Bitcoin right now is trading lower. We got Bitcoin down by 2.4%, 63,159. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Today, Chevron shares, they're lower now by 3.5% after earnings. ExxonMobil down 0.6%. Again, recapping steep losses for the U.S. stock market, with the S&P down 120, a drop now of 2.2%. Balance of Power continues the Friday edition. Lots going on. Back we go to Washington, and once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie Pellet, we thank you as always for keeping tabs on the markets, even if it's tough news today. Welcome to the fastest show in politics. I'm Joe Matthew, alongside Kaylee Lyons in Washington, where we turn our attention back to the campaign trail. All this economic news and the direction of the markets resonating, along with the idea of a debate. We still don't even have a running mate here. And the back and forth between the Kamala Harris campaign and the Donald Trump campaign has been pretty rich. We just got a statement, in fact, from the Harris for President camp from co-chair Cedric Richmond. Donald Trump needs to man up, he writes. Since he talks the talk, he should walk the walk. And as Vice President Harris said earlier this week, say it to her face, September 10th, she'll be there waiting to see if he'll show up. Injecting now the prospect of an empty chair debate. This statement follows something Donald Trump said this morning to Maria Bartiromo on Fox Business. Let's listen.
Are you going to debate her?
Well, I want to. We're leading in the polls, it seems, by quite a bit still. She's better than he is, but I think ultimately she'll be worse than him. She's more radical than him.
All right, so let's get into this now with our signature political panel on this Friday. Joe, Jeannie Shanzano, Senior Democracy Fellow with the Center of the Study of the Presidency and Congress, and Rick Davis, Stone Court Capital Partner. Always great to see you two on a Friday as we look ahead to September 10th and wonder if we're going to see anything at all that night. Jeannie, do you really think this depends on the polls?
It should depend on the polls. And if you're looking at the polls, they are neck and neck, whether they are national or in the swing states. We've seen, and even in the Bloomberg poll, where the trajectory is much more positive for Kamala Harris than it was for Joe Biden. So if you're going to go by what Donald Trump said, he should be out there to debate her on September 10th, and I hope he is. I think the fact is that his campaign advisors are telling him he only is going to lose by debating her, so he's trying to come up with some excuse to avoid that. But in the end, Kaylee, I hope we see it because it's going to be must-watch TV.
Well, that's for sure, Rick. What's your take on this? Because I know that you wouldn't put Donald Trump in the ring with Kamala Harris. But if he's not leading on the polls, won't he have to?
Yeah, just to take a step back, I think every presidential candidate, the nominee of the two major parties, has an obligation to the public to debate, right? This is not just about who's ahead and who's behind. I mean, those are technical consequences of saying yes or no to a debate request. But there's an overriding public interest here. The public should be able to see Donald Trump in action and Kamala Harris in action and make judgments based on that. And they should be after they've been nominees, not before. And it should be a part of the fall election. That is our tradition as a democracy. And so that's saying I don't think there's going to be a debate because I don't think it's in Donald Trump's interest. I think he probably is concerned with his ability to debate head-to-head Kamala Harris. And I'm pretty confident that he's not going to believe that that debate's going to result in an uplift in the polls. If anything, maybe downdraft. And why take the risk in September, October? Look, remember, he's going to say he won no matter what the outcome is. So why do anything that gets in the way of, his narrative about he's already won this election?
Does what applies to Donald Trump, Rick, also apply to his vice presidential nominee, J.D. Vance? Do you expect we'll see Vance on a stage with whoever Kamala Harris decides is going to be her running mate in the next few days?
I doubt it. I think that what's good for the goose is good for the gander. And in this case, my guess is that because we don't have a commission on debate sponsoring these debates, they've already rejected their participation, then it would be up to the two campaigns to formulate a strategy around trying to put a debate together. And in this case, I can't imagine Donald Trump wouldn't understand that if the VPs debate, there's going to be immense pressure on him to do the same. And so he'd only be hurting his own prospects if he's trying to avoid a debate by letting Vance debate.
The debate is not all Donald Trump has been talking about in the last 24 hours. Yesterday, we were describing him doubling down on his questioning of Kamala Harris's racial identity. Today, he is tripling down, I guess is the only way to put it, posting a photo on Truth Social of Kamala Harris dressed in a sari with a caption saying, "Your warmth, friendship, and love of your Indian heritage are very much appreciated," unquote. Also reposting stuff from Laura Loomer with copies of Kamala Harris's birth certificate. This is starting to sound familiar. Spreading accusations as well that Kamala Harris lied about her race. We were all commenting on a ex-post from Simone Biles. You probably saw Jeannie after winning her 9th Olympic medal, quote, "I love my black job," with a black heart. Where is this whole thing going? How do you go beyond the tripling down on this strategy for Donald Trump?
First of all, what a night for Simone Biles. That was just amazing to watch. So proud of her. It was. I loved it. So the reality is we are back to the future with Donald Trump. And it's unfortunate for Republicans because if you're looking at a strategy to take on Kamala Harris in a serious way, this repeat of birtherism dressed as something else is not the way to do it. What is Bloomberg talking about today? They are talking about these numbers and the impact on the market. You've seen people like Jason Smith. You've seen people like Rick Scott try to tie this to Kamala Harris. I don't happen to agree, but wouldn't those kinds of policy approaches be much more effective for Donald Trump? And instead, he goes back to his, quite frankly, racist tropes and who, seems to be frightened of taking on a woman on the debate stage again. And so here we go again. And so I think it's unfortunate for Republicans, quite frankly, who are going to have to go through this. But we have to face it. He's what he set out to do, which is to gain a lot of free media attention on the back of this.
Well, certainly attention is being paid. Now, speaking of media attention, some media breaking news for you. Headlines just crossing the Bloomberg terminal that Kamala Harris has enough delegates to win the Democratic nomination. This, of course, as the DNC had their virtual roll call underway. They will close voting on her nomination on Monday. The DNC chair, Jamie Harrison, saying he's proud to confirm that Harris earned more than a majority of votes from all convention delegates and will be the nominee following that close of voting. Now, of course, we're looking to Monday to figure out when she may make a vice presidential pick, Jeannie, but there's also things swirling about a potential cabinet, including a Washington Post op-ed today in which Jamie Dimon, the CEO of JP Morgan Chase, makes the case for someone from the private sector getting a cabinet seat. He writes in part, quote, "The private sector has huge wells of expertise and produces 85% of our nation's jobs. It should have a seat at the table." What do you think about that, Jeannie?
I'm so glad he wrote this piece. I think the idea that we need to restore faith in America is something we can all get behind. I think there's a lot of questions about how best to do that. I think it is really important to consider having representation from the private sector in the government and in the cabinet. So I think that makes good sense. I, of course, have my own view of what we need to do, which I'm happy to talk to Mr. Diamond about, which is restructuring. But I do think diversity in the cabinet by way of background and talent is critically important. I don't think we can forget we've had that in the recent past, and we've had that historically. I don't know if it's enough, but it may be a good first step.
Presidents may invite executives over to the White House for counsel, Rick, but they're not going to allow private sector at the table in the cabinet, are they?
Sure. Yeah, there's a strong tradition of private sector individuals serving in cabinets, high-level posts throughout any administration. And I think
how about representing the private sector?
You know, it would be an interesting twist. It is basically what the Secretary of Commerce is charged to do, right? Is to promote and represent the business interests, both domestically and abroad. So there are a lot of components to that, right? Obviously, our trade negotiators do the same thing on trade issues. So there is already a pretty significant focus by the federal government in the private sector lives of business community. But at the end of the day, the real question, I think, is not whether or not their views are held or whether or not the approach to government is going to be heavy regulation or lighter regulation. That is one of the fundamental differences between potentially a President Harris and a President Trump. And I think, if we could get back to talking about the issues in this campaign, those would be the kinds of things I think that could draw a lot of voters to one side or the other.
Rick Davis and Jeannie Shanzano will be back with us in the late edition of Balance of Power that starts at 5 p.m. Washington time. Many thanks to both of you. Great analysis, as always, from Rick and Jeannie. As we turn our attention to the latest world and national news, Nancy Lyons joins from the Bloomberg 99.1 newsroom in Washington. Hi, Nancy.
Thanks, Joe. Vice President Kamala Harris has secured enough votes from Democratic delegates to officially be the party's nominee for president. That's the word from the chair of the party, Jamie Harrison. The online voting process will continue until it wraps up on Monday. This is what Harris had to say when she spoke with the delegates today.
I am honored to be the presumptive Democratic nominee for President of the United States, and I will tell you the tireless work of our delegates, our state leaders, and staff has been pivotal in making this moment possible.
The voting was moved online to meet an August 7th deadline for endorsed candidates to make the Ohio ballot. She says she's honored to be the presumptive Democratic nominee. Harris's campaign says it raised $310 million in July. That far outpaces former President Trump's contributions of nearly $139 million. Two-thirds of the donors to Harris's race were first-time donors. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg.
In tech are on Bloomberg.
I don't like anthropomorphizing AI. I sort of believe it's a tool. It is got intelligence, if you want to give it that as, moniker, but it's not the same intelligence that I have.
I especially am afraid of whenever it's some kind of AI is speaking for me. I want to be myself, and I want to be the one speaking. I have AI myself, actual intelligence.
This industry of producing intelligence is one of the greatest opportunities I've ever seen. Instead of instruction-driven computing, it's now intention-driven computing.
There's been a lot of us who've been working in AI for a long time. It's great now to see other people using it and seeing what some of the challenges are.
To stay ahead in tech, it has to be much more than just software. So you need long-term investments in science and research.
You have an ecosystem of companies coming together. It's causing a new industrial revolution.
Fed Scoresby says job data follows a trend of cooling in the labour market.
I decided to acquire Indeed 12 years ago. When I was 36, I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company, but I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the praise to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
A lot's happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insight.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Fed Scoresby said we had multiple good months of inflation and broad-based.
Data set signals, and I think that's a lot of times where the opportunity is.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index set for its worst jobs day in 2 years. Right to the numbers, with the S&P now trading at 53.18. It is down 128 points, a decline right now of 2.4%. Dow Industrials down 855, a drop of 2.1%, while the NASDAQ Composite Index is down 492 points for NASDAQ, a drop now of 2.9%. The Russell 2000 Index of small cap shares now down 3.7%. We've got the 10-year at 3.81%, the 2-year 3.90%, and spot gold down $16 the ounce, down 0.7%. West Texas Intermediate crude down 4%, now 73.24 a barrel. Intel is suffering its biggest decline in over 40 years after the chipmaker gave a grim growth forecast and laid out plans to slash 15,000 jobs. Intel now lower by 27%. Amazon after earnings down 10.1%, and Apple, which also reported last night, Apple shares are higher, holding on to a gain now of 2.8%. Again, recapping, stocks lower across the board, steep losses in fact, with the S&P now down by 2.4%. Balance of Power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
Goolsbee says if inflation in the jobs market continue to cool, the Fed should cut.
On this jobs day, that reaction, of course, in the equity markets plunging to the downside. But we are trying to see some positive spin on this coming from the Biden administration, at least from the acting Secretary of Labor, Julie Su, who was here on Bloomberg TV and radio earlier today and had this to say about the softer print.
We continue, know that there's continued work left to do to make sure that we maintain a strong economy. But we're still at a 3-month average of above the number that President Biden said a year ago we need to be to have a sustainable, strong labor market in a strong economy.
Let's get the word from Bloomberg Economics, where Anna Wong is the chief U.S. economist. Anna, it's good to see you on this jobs day. I've been asking you indicator after indicator after data point, is this the soft landing? I have to ask you now, is this the hard landing?
I think it's looking like that way. So you have seen the narratives of soft landing completely appended by all the data this week. And a lot of people, a lot of economists who had previously thought that soft landing was a shoo-in is now sounding quite panicky. So I think this is our view is that the SOM rule, or whatever recession rules, had long, other recession rules have long been triggered. I think the nonlinear point in the labor market, in the unemployment, where things should go sharply deteriorate thereafter, that point has already passed. The Fed has an opportunity to cut in July, but they didn't take it. And even doing so, they probably were late. But now they're definitely late. And this is the reason why market pricings are for dramatic 50 bips rate cut in September. And there's even some options now pricing for an intermediate period cut before the September meeting.
Yeah, well, that's something that Democratic Senator Elizabeth Warren is pushing for. She posted on X today that the Powell made a serious mistake not cutting interest rates. He'd been warned over and over that waiting too long risks driving the economy into the ditch. The jobs data is flashing red. She goes on to say, Anna, Powell needs to cancel his summer vacation and cut rates now, not wait 6 weeks. What's more likely in your mind, that the Fed would move ahead with an intermediate cut, or that they would cut 50 full basis points at the next one?
I think both are not our baseline. So there are two things to think about. One is what the Fed should do versus what the Fed will do. In terms of should do, yes, the Fed should be cutting 50 bips to catch up for the missed cuts that they should have done. But in terms of what they will do, we have heard from Powell, and from his body language and from his words, he was very clear that he and the other committee members are very far away from thinking about the 50 bips cut. It is a possibility, though. So in this case, I think the market is ahead of itself, and definitely the chance for an intermediate cut is even slimmer. Note that we still have 2 more inflation report and another jobs report. I think that while the increase in unemployment rate today to 4.3%, a lot of it is real, reflecting underlying weakness in the labor market. A little bit of that is due to the Hurricane Beryl, which could revert in the next meeting. But I think all in all, I think the trend is still for the unemployment rate to reach 4.5% by the end of this year, compared to the Fed forecast of 4.0% back in June.
Well, how quickly things can change. Anna Wong of Bloomberg Economics, our chief U.S. economist, thank you so much for joining us on this jobs day. And of course, we've been speaking so much, Joe, before today even, about the notion that if the Fed were even to cut 25 basis points in September, given the proximity to the election, that it could be seen as political. How political would a 50 basis point rate cut be seen as?
Or one that doesn't even happen in a meeting.
Well, there's that.
It's been a long time since we've had one of those, and imagine what headlines could be about on a day when that happens. It's going to get more precarious as we draw our way closer here, but we'll obviously be covering this very closely in Washington at the same time as we cover this campaign. And we had breaking news a short time ago, Kamala Harris gathering the delegates needed in a virtual roll call to actually secure the Democratic nomination, which makes us ask, of course, what's Chicago all about anyway? Kristen Hahn is with us, I'm glad to say, partner at Rock Solutions, one of the most connected Democratic operatives in Washington who we've stayed in touch with closely since this turnabout at the top of the Democratic ticket. And Kristen, I wonder your thoughts now that Kamala Harris technically has it in the bag. She's got $300 million from the last month, and she's now challenging Donald Trump to a debate. But headlines like we have today on the job market, concerns about interest rates, the potential for a recession to coincide with this election leaves us with a fraught landscape, doesn't it?
I mean, I think, and jobs and the economy are always going to be central to any candidate, any election, any presidential election.
Goolsbee says we need to balance policy with the economy in short order.
She's a very strong candidate. Democrats are united behind her. There was no question that she was going to be the nominee going into this process today through the weekend. But, you know, at the end of the day, and she has, and she will, and if you see stuff coming out of the campaign, you need to talk about, you know, kitchen table issues, which are, you know, are people able to survive in this economy? Are they able to put food on the table? And that will be central to any, you know, the campaign going forward.
Well, so when we consider that she effectively is the incumbent here, since Biden is not running, to what extent will she face the same amount of blame that Joe Biden was getting for the economy from serving as his vice president? Are voters likely to see any real difference between them on this issue?
I think that they will. I mean, I think that she certainly won't get the same, you know, criticisms that Biden will. She's in a lot of ways, when we go to Chicago, introducing herself to the American people and has the opportunity to talk about what she might do going forward, might do differently. I don't think there's the same amount of baggage there, but there's some to overcome for sure.
Talk to us about the debate. We had a conversation with Rick and Jeannie about this earlier this hour. Donald Trump's telling Fox Business News today that why should he debate? He's up in the polls. They already know who we are. Of course, he could have said the same thing with more credibility, actually, when it came to himself and Joe Biden. She's goading him. The campaign's out with a statement essentially calling him a scaredy cat. What triggers Donald Trump to the stage?
I mean, I think, you know, calling him a scaredy cat triggers him to the stage, but I think he never likes to look weak. And when she is looking straight to camera like she did in her rally and said, if you want to say something to me, say it to my face. I think in this circumstance, him not debating her makes him look weak, and he doesn't like to look weak. I also like her chances going into this debate of looking very strong coming out of that, and that's something that will be, you know, very different than what we saw in the last debate. I think you see President Trump talking a lot about, you know, he keeps wanting to reference Biden. And it's like, you're not running against Biden anymore. You're running against Kamala Harris. So, you know, I think there's a reason why they don't want to do it. And he might actually have to prep for this one.
Well, and it's not just a question of whether we're going to see the presidential candidates debate, but vice presidential as well. We don't know if we'll see Senator J.D. Vance on the stage with ... whoever she picks by next Tuesday, we expect. What are you hearing on that front, Kristen?
I think she's having these conversations. We have just so many great, you know, people out there that can fill this role, and it's all about who she feels comfortable with, who makes the ticket stronger. You know, it's not necessarily, are you a governor, are you a senator? It's, you know, what maybe can that person do to fill up some of the gaps and she believes makes the ticket stronger. And I would take any of these people that we're discussing up against J.D. Vance like all day long, every day.
I mentioned the nominating contest. Do you worry about the impression that makes? Why not wait to Chicago and actually have a real roll call after what happened? These are extraordinary circumstances for Democrats this time.
They are. I don't think it's going to make that much of a difference, honestly.
It doesn't smack of backroom deals.
It doesn't. And honestly, I know this is getting into the nitty-gritty of it, but, you know, if you look at Ohio, there was a chance that, you know, if we didn't do this, and then if people don't remember, we had to delay the Democratic convention because of the Olympics. So this is way later than it normally would have happened. So the decision was made back in the spring, to go to do this early just in case. Now, Ohio, the state legislature fixed the problem, but, you know, I'm a Democrat. I don't want to rely on Republican state legislatures who might go back on their word and go ahead and get this done, and then we can have the celebration and the introduction and education to the American people of who she is in Chicago.
So if we consider that the Vice President of the United States still needs to be introduced to the American people to a large extent after being a breath away from the presidency for 3.5 years, how hard is it going to be to introduce any of these vice presidential candidates to the American people in such a short span of time for them to actually make a difference, to contribute to the ticket as you described?
I think it makes a difference in the states where it will matter. So this is not, that part isn't abnormal. I mean, picking your running mate and who that is. Clearly, you're voting for the presidential candidate, but if you're looking at states like Pennsylvania or Arizona, they're going to know who these people are. So yes, it's an uphill climb to educate the American public on who the vice presidential candidate is, but I think that that's the campaign's job over the next couple of weeks.
So we've heard a lot about a sugar high and a honeymoon and all of that, and I suppose you could qualify this entire period of time we're in straight through the convention, straight through Chicago. Then we get out on the road. The real sprint begins. Give us a sense of what kind of planning this campaign is going to be focused on coming out of August into September. Kids go back to school, people back from vacation, they're paying attention now.
I think you'll see a lot of focus, like you will just starting next week, on the blue wall states, quote unquote blue wall states. That's the easiest path to victory for the Democrats if you're looking at Pennsylvania and Michigan, Wisconsin, those type states. But I think you're also going to see a focus on North Carolina, Georgia, Arizona, those type of states where you've got strong down ballot candidates as well, strong governors who are going to be, I mean, you see the surrogates and how strong these surrogates are. So anybody who's in the race and the running to be the VP pick and is going to be a strong surrogate for her in those states. So I think you'll see a lot of focus on where the campaign needs to be focused in order to get to that number in order to win the presidency.
Well, and of course that could be physical visits like what we're going to see next week. It also could be just buying up time on the airwaves. She's going to have a lot of resources to do that. The campaign says it raised $310 million in July. What is the responsible way to spend that money, knowing that kind of fundraising burst isn't necessarily sustainable?
Right. So I think a number of things. You have to be up on air. You have to be up on television. So that's a given. And then you've seen the incredible success of the online forums, that she's had with surrogates.
Right.
You've said like
Zoom calls.
Like, yes, the white men for Kamala, the women for Kamala.
Yeah, they broke Zoom.
Right. But I think equally, if not more important, is the infrastructure that's already on the ground, the unprecedented infrastructure on the ground. I mean, the number of the folks that are walking around, the volunteers, the campaign staff in these battleground states, that's a responsible way to spend money.
Is it right to stash Joe Biden on a Monday night? He couldn't introduce Kamala Harris on Thursday?
I mean,
Am I looking at it the wrong way? You're going to say, hey, he's in prime time. That's a great slot, right?
That's exactly what I'm going to say. Prime time, great slot.
Gotcha. Kristen Hahn, it's always great to have Kristen with us. Partner at Rock Solutions and a frequent panelist here on Balance of Power. Of course, we like to tap her expertise whenever we have the opportunity with so many questions. Kaylee, on this Democratic ticket, the next couple of days are going to be awfully important.
Indeed, in the next couple of months leading up to the election, especially as we consider what the Fed may do between now and then after what was a soft jobs report today, you certainly are seeing a robust reaction, shall we say, in the equity markets. The S&P on track for its worst jobs day reaction in 2 years. The NASDAQ 100 down 2.9% as we speak. Of course, in part, that's due to tech earnings with Intel down by 27%. On the day. That's a real number. And of course, you're seeing that filtering through the bond market as well as we reprice Fed expectations. Down 16 basis points on the 10-year to 381. Down 24 basis points at the front end. The 2-year yield right now at 3.9%.
Yeah, it's not getting a lot better here. We could close near our lows of the day. And of course, Charlie Pellet will keep you posted on that as we make our way through Bloomberg Business Week, which incidentally is next. Kaylee, I'll meet you at 5 o'clock on the late edition of Balance of Power.
Sounds good. We'll see you then on Bloomberg TV and radio.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's facing a new phase of raising capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs. Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under
Brent crude futures fall by more than $3 a barrel now to a session low, lowest since January of this year now.
An instant analysis.
Continuing coverage on Bloomberg. Context changes everything. Is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Tim Stenevec on Bloomberg Radio.
And a very good afternoon, everybody, live on radio, TV, YouTube, and Bloomberg Originals. This is Bloomberg Business Week on this Friday, August 2nd. It is definitely a Jobs Friday, and I feel like we have one main story, maybe two, because it is about this morning's jobs report, but it's also what we continue to see when it comes to the Treasury trade in the United States and really Fed expectations, Tim.
Not just the Treasury trade, but also, of course, what's going on in the equity market. Bad news now, bad news for stocks. The S&P 500 on track for its worst jobs day in 2 years. The NASDAQ 100 down 11% from the July high at its lows today.
Correction, anyone?
Yeah, correction. That's where we are. Meantime, the bond rally continues. As you mentioned, Carol, it's all about those morning's monthly jobs report showed that U.S. hiring slowed markedly. The big question, is it an abrupt downshift in the U.S. economy?
Which is why we are talking about the U.S. labor report. We're going to talk about the trend line, the SOM rule, and yes, the continuation of the reset in U.S. rates and expectations for Fed moves. Also on jobs, Alan Guarino. He's vice chairman over at Korn Ferry on the jobs that are actually in demand right now. So we'll get some insight from him.
Plus, have you seen shares of Intel today? They are just cratering. It's on the outs, dropping the most ever on a grim forecast and big job cuts. We give you the latest from Intel.
It's a big Friday, folks. Let's get you going with a check on the overall trade. For that, we turn things over to Charlie Pellet.
All right, I think very much going to be very interesting to see how things close. We are very close to the worst level of the day right now. The Dow, the S&P, NASDAQ 100 index, Russell 2000, deeply in the red, right to the numbers now. S&P 500 index down 131, 53.15 on the S&P 500 index where we stand right now, a drop of 2.4%. The Dow down 911 points, down 2.3%, and NASDAQ right now down 492 points, a decline of just about 2.9%. Russell 2000 index down 3.9%, 10-year at 3.81%, the 2-year 3.90%. Gold is down $18 the ounce, down 0.8%. And West Texas Intermediate crude down 4.3%, 73.04 a barrel on crude. Intel shares plunging after earnings. We got Intel now lower by 26.9%. Also keeping an eye on shares of Amazon after earnings. Amazon down 10.3%. Jeff Bezos' wealth slumping by more than $21 billion and moving higher after earnings. Apple, we've got Apple shares holding on to a gain today on a down day for the rest of the market. Apple right now up by 2.6%. So again, recapping here, steep losses for stocks. S&P down 2.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as you know, the jobs report this morning, we got it at 8:30 a.m. Wall Street time. U.S. hiring slowed markedly in the month of July. The unemployment rate rising to the highest level in nearly 3 years. It does suggest a faster deterioration in the U.S. labor market than previously thought and puts the Fed solidly on a path to cutting rates in September. Now, the rise in the jobless rate triggering a famous recession indicator. It's known as the SOM rule, which has a perfect track record over the past half century. The mastermind behind the gauge, former Fed economist Claudia Sahm, who said on Bloomberg Radio with Surveillance's Tom Keene right after the report that while the U.S. isn't in a recession, we're not headed in a good direction.
Claudia Sahm, I've got to ask the media question. Is the SOM rule in force at this moment?
It triggered. Yeah.
Wow.
Yeah, so that puts it up over its 0.5 percentage point threshold, noting that comes off of historical experience. That doesn't necessarily tell us where, we are right at this moment, saying a recession. We've seen way too much momentum in the unemployment rate in recent months. 4.3%. Right? This is not. So whether we are at that moment of a recession or not, this is your build into substantial weakening in the labor market.
All right, that's Claudia Sahm with Bloomberg's Tom Keene earlier on Bloomberg Surveillance. I believe Damian Sassower also there. Meantime, the report further escalated. The bond market rally drove futures traders to price in expectations that the central bank will cut its benchmark rate by a full percentage point by the end of the year. There are other folks on Wall Street talking about several cuts, bigger cuts. So let's get to it and our deep dive on the jobs report and the move in U.S. Treasuries. With us, Bloomberg News International Economics and Policy Correspondent Michael McKee right here in studio. Ira Jersey, Bloomberg Intelligence Chief U.S. Rate Strategist out there in BI headquarters in Princeton, New Jersey. And Anna Wong, Bloomberg Economics Chief U.S. Economist in Washington, D.C. Mike, I want to start with you. Lay it out for us how this morning's report compares to the data that we've been getting on the labor market. And I'm curious, as an economist, how you factor in the SOM rule.
Well, let's start with the data. It's basically a continuation of what we've been seeing, a slowing economy and a slowing labor market, except that it went much farther, much faster in 1 month than perhaps the Fed was anticipating. If you ratchet it down to 114,000 over the last couple of months, Fed would have been perfectly happy with that. It's kind of a neutral level. 4.3% is still a low, historically low unemployment rate. And we also saw average hourly earnings ease up a little bit, taking some of the inflation pressure out of the numbers. So under other circumstances, the Fed might have said this is okay. And obviously, we talked to Austin Goolsbee, the Chicago Fed president, earlier, who said we're not going to panic over one number. We're going to take a look at what else is happening in the economy. And that's going to be the question from here is, what else is happening in the economy? What other numbers and how do they show up during the month ahead?
Shoulda, woulda, coulda. Mike, I'm wondering if Jay Powell would have had access to these figures. The Federal Reserve Board had a time machine and knew what was coming in the July payrolls report starting on Tuesday. Would they have made a different decision at their meeting, do you think?
Possibly. It's hard to know. It's really one of those situations where you can't know the counterfactual. I did talk to a number of open market committee members since the meeting, and they all acknowledged that Friday was going to be a risk-on event for them, and the risk came true. Now, does it mean the economy is falling off a cliff or going into recession, or does it just mean that we hit an air pocket? That's the part that they're not going to know, and that's where the Fed is going to fall back, what the Fed's going to fall back on and say, we can't just cut rates 50 basis points or intermeeting based on this one data point. And the SOM rule, if you take it out to 3 decimal places, the unemployment rate, we didn't quite get there, but it's angels dancing on the head of a pin. If the market thinks you're there, you're there. The only question is, where are you? As Claudia was saying to Tom Keene this morning, we're not in a good place, but it doesn't necessarily mean we're in recession.
Jay Powell reminded us on the press conference a lot of data points before we get to September. Anna, come on in. I want to bring in Anna and Ira. Anna, you first. Is this a report a game changer in any way to you, and factor into your outlook on the U.S. economy, be it better or worse?
Yeah, so we have been forecasting that the unemployment rate should rise to 4.5% by the end of this year for a long time now. And I think this report just is just right on schedule according to our forecast. And the reason why we think it will be rising to that level, which is higher than most Wall Street forecasts, is that we have seen a cooling in the labor market that had been pretty meaningful since the middle of last year. So while the rise in unemployment rate in recent months may have caught the Fed, who had been actually forecasting for the unemployment rate to decline in the second half of this year, while they might be surprised, I think that if one believes that this cooling had actually begun in the middle of last year, then you would think, well, it's already been cooling for a year. In fact, it just has reached that nonlinear point where the Fed can't stop it anymore. So I think the Fed is behind the curve.
All right. Well, then let's get to you, Ira, and forgive us, Mike and Anna, because I feel like we're burying the lead a little bit. The rally in what we've been seeing in the U.S. Treasury trade, getting another boost today. Ira, today's trade, walk us through it. That 10-year, going to 3.78 or so?
Really bounced right off a very important technical level, right at that number, I would mind you, something that we highlighted about a month ago.
So what do we do? I mean, we talked with you yesterday. You anticipate that the 10-year could go even lower. So what is the trade telling us today? Is it just a continuation of your think or something more?
Well, I'm thinking about taking vacation the rest of the year. We put out this morning a 382 forecast on the 10-year, so we're right there. So I'm done. I think the market's probably got a little overvalued here. And if you look at some of the technical indicators, at least in the short term, we'll probably get momentum in this kind of trade won't continue at this pace going forward. But I think the important thing
TD Securities now see 75 basis points of easing this year, with 25 basis points seen in each of the coming meetings this year.
Beach this weekend, and you look at the steepening of the yield curve, and that's completely expected in a situation where the Federal Reserve is going to cut interest rates, maybe not more than they anticipated, than the market had been anticipating, but certainly faster. And I think that's where we're going. Now you have banks coming out, and even the market pricing for a high probability of a 50 basis point cut in September. I'd be curious to hear Anna's view on that, because Anna and I talked yesterday on a podcast, and things have changed now since then, so I'm curious if we hear that. But that's why you have this big rally in the front end. I do think that we'll continue to see bull steepening of the yield curve. 2-year notes will be down, under 4% in a hurry. I mean, they're very close to that, and I think that we keep going down to 3.5 on 2-year note. 10 years probably lag that, and that's where you get that steepening.
All right, so Anna, give us 30 seconds in response to what we just got from Ira, because we have Claudia Sahm here too, and we want to bring her in.
Yeah, so I think that Powell said very clearly that 50 bips is not on the table. But however, given today's data, I think they will indeed talk about it. It's still not the baseline as the market has priced in.
All right, Claudia, come on in. Claudia Sahm is with us. She's had a busy day. I'm sure a lot of people reaching out. Chief economist at New Century Advisors, founder of Sahm Consulting. We played a little snippet of your interview on surveillance with Tom Keene this morning, where he said, is this some rule in force at this moment? And you said it triggered. Yeah. Tell us your reaction to the jobs data and what it tells us right now.
This was a disappointing report. It may not be as bad as it looks, or maybe as the reaction is to it, but we have continued to see some slowing, now weakening in the labor market. We're still in a good place. It's just the direction we are pointed in, the direction of travel has been not in a good, we're not pointed in the right direction. So as I said with Tom Keene this morning, my read of the economy, looking broadly way beyond just the Somme rule, is that the U.S. economy is not in a recession right now. We still see an expansion of economic activity, jobs created, some special factors going on right now relative to prior recession periods. And yet, the risk that we are pointed towards a recession, or we're in that kind of pre-recessionary weakening, those are really going up. And that's what we should, policymakers like the Fed should be stepping in and really thinking hard about. How can they short circuit those dynamics, which in the past do not end up in a good place?
Claudia, this is Mike. I got two quick questions. One on the Somme rule, just so we can sort this out. Do you use 2 decimal places or 3 in doing the math?
Never in a million years did I dream others would be creating and writing. This was a very specific tool in a proposal to do stimulus if there's a recession. No, I look at the published unemployment rate, so just as it is, the 4.3%, and take a 3-month average of that, because I want to smooth out bumps and wiggles, but I don't get fancy and, like do the calculation, 3 decimal places, all that. I take the 3-month moving average and then take that series and look in the prior 12 months, so not including the current month, the prior 12 months, and find the low point, compare it if it's a 0.5 percentage point or more. In the past, in U.S. history, that has occurred early in recessions. This isn't a forecast. On average, it's about 3 months into a recession is when the Somme rule triggers. There's nothing magical about the formula or the cutoff. It was me looking at the historical record saying, when could we say with a very high degree of certainty, not perfect, but a high degree of certainty, that, hey, we're in the early stages of recession. It's time to get, say, fiscal relief out. That's, it was all with that purpose and not thinking about, today per se. And it's not a way to call a recession.
Ira,
right?
you want to...
Oh, go ahead. Sorry.
Come on in, Ira. So I have a question. So you said about a fiscal response to a weakening economy. Given that deficits are still going to be running close to $2 trillion, how concerned are you that there might not be a fiscal response going forward if the economy does get meaningfully weaker? Obviously, the Federal Reserve can use monetary policy, but fiscal policy might be more difficult to get in the next downturn.
Right. So in the context of where the Somme rule and the proposal came from, it was from early 2019. So I have certainly learned a lot as a policy advisor through the COVID pandemic. And the big thing the Somme rule falls down on is the taking into account changes in supply. And in this case, specifically labor supply, the labor force. And to your question about a fiscal response right now, because we are still in the last stages of fighting inflation, I would not endorse my 2019 proposal of broadly sending out stimulus checks. Even if I thought right now we were in that recession, it'd be more targeted, it'd be really, thinking about the inflation environment as well. So there is a cautionary aspect of thinking about the policy, but it does put the conversation out there. And to your point about fiscal space, though, if we were to get to a recession, if we were to get to a serious place, we have the fiscal space to respond. Whether we have the political will and kind of get it all together to respond, that might be a different question. And yet, really, the whole thing about this proposal, the stabilizers, is to let's have conversations outside of time of crisis about how to do fiscal policy as well as possible, knowing that we'll need it.
Anna Wong, I want to bring you back in here and talk a little bit about what Claudia said regarding labor supply, because I'm curious about, based on the numbers that we got this morning, how your view on the job market's ability to absorb more labor has changed in just a few months.
Yeah, one of Claudia's view is that, we're not sure whether this time what happened to the unemployment rate after the Somme rules trigger will happen again, which is that it should continuously rise for another 1.9 to 2 percentage point. So Claudia, this is as much as a question to Claudia herself. We have been looking at immigration and the absorption rate of these immigrants into the labor market, and we did note from the micro data from CPS that the unemployment rate for new immigrants are rising very fast. They're currently at 11%. And so I guess I'm wondering if the economy does lose this ability to quickly absorb these immigrants, would you still think that the SOM rule would be consistent with the historical pattern where it would continuously rise for another 1.9 to 2%?
So the labor supply, both the immigration that we have now that's pushing up the labor supply and at least temporarily or at this time pushing up the unemployment rate, that is causing the unemployment rate to be higher. I think the labor shortages previously had pushed down the unemployment rate. Notably, right, not sustainably. So, the SOM rule again is all about these changes. So I think there's my take of where it's at with the increased unemployment rate is it's probably overstating the recessionary dynamics. So we've got these supply dynamics that are very, like, it's a whole other topic. And yet under the hood, there still is a weakening in the labor force, a weakening for demand for workers, right? And to your point, that's the piece that if it gets momentum and it keeps going, that's the recessionary dynamic. Is absolutely, if it's really just a matter of we had a bunch of workers come in, the immigrants come in a big group and it takes time to absorb them. As long as you have a strong labor market, they do get they get jobs, unemployment rate trends back down. But that does require the labor market to be in a good place. So I think that's the question we don't know yet. Has that, how bad is that negative momentum? And that's why I said today's report was not encouraging. That it's not, I don't think you see a lot of improvement.
Let me put a question to Ira and Claudia, if you want to jump in on it as well. As I was saying at the top of the show, if we had ratcheted down to 114,000 jobs and slowly gone up to 4.3%, the Fed probably would be happy. So is it, what's causing the market panic, Ira? The fact that we move so quickly or the levels that we're at? Because it doesn't seem the levels that we're at are, as we've been saying, recessionary or terrible.
Yeah, if it was 2016 and we had 114,000 jobs, you'd be like, okay, yeah, that's fine. But I do think it is the momentum and pace, and also this repricing of the risk, right? Because there are a lot of market participants who are worried that,
according to Israel's PM Netanyahu's office, Israel is to send the Gaza ceasefire and hostage deal negotiators to Cairo on Saturday or Sunday.
If that occur and we wind up with higher inflation, that maybe the Fed won't be able to cut as much. And I think basically that upward tail risk on inflation is coming off because of some of the data you have. Because remember, we're focused on this 114. The household data was actually a little bit better today than it had been, say, on a 6-month basis. But we had the labor force participation went up. We also had wages were disappointed to the downside too. And I think that those wage numbers, when you look at aggregate income, that is slowing pretty significantly. And I think that there's a lot of people who are looking at those type of data. You look at the market move today, you look at not only is our rates rallying and real rates rallying a little bit on the idea that the Fed's going to cut, but you also have break even. So inflation expectations have come down. You look at inflation expectations haven't been at 2% for 5-year inflation break evens in forever, it seems, right? Now, it wasn't forever, but it's been years since we've been at these kind of levels. And so I think that that's pretty telling too, just the market saying, okay, inflationary risk probably off the table for now.
Claudia, I mean, if you look at the market reaction and you look at the inflation expectations, et cetera, is there any reason for Wall Street to be calling for 2 50 basis point cuts in a row or an intermediate cut?
So the market reaction today, this is a big reaction. So my read of where the economy is, how to interpret, the guts of this report, I don't see it as that negative. I have a hard time with the break evens, the inflation expectations. Those are really big moves for again, it was a disappointing release. There have been a string. I think it absolutely is the direction. It's the momentum, right? What stops this train? Right, and it could still be in a good place if we stop kind of close to here. But that's just, I mean, this has been a very difficult cycle. There's been a lot of uncertainty. I mean, this comes not 2 days after we have Jay Powell and the Fed tell us we don't want to see any more weakening in the labor market.
Yeah,
we're not seeing it. and then we get it. I think it's just been a lot to process. So I don't think this is where, I think this is one day. This has been a really wild ride. I'm not updating my expectations on what the Fed does off of just today, and I think we can all just take a deep breath.
We are running out of time, but I do want to get final thoughts from everybody in our roundtable. Anna Wong, I want to start with you and just give us very briefly your thoughts on the implications of this weaker than expected data.
Yeah, so I think
The Fed's barking on the wires now. In a New York Times interview, says 114,000 jobs, not as good, but a reasonable number.
Has been happening for a while. I think that looking at 12-month unemployment flows, today's figure suggests 21% increase relative to 12 months ago. That's really sharp deterioration. So I think that the Fed is behind the curve.
Behind the curve. Elizabeth Warren agrees with you. She says, Jay Powell, get off your vacation, basically. Cancel it. Ira, Jersey, 30 seconds for you.
Yeah, we're focused next week on more like supply, and I do think that this is probably a little overdone, so we'll give back some of this rally in treasuries, I think, over the next couple of days, and everyone will reevaluate after we get the CPI report and retail sales.
Mike?
We look through to all these other data points, and I thank the Fed and the economy for once again driving up the ratings for us when we go to Jackson Hole. And Jay Powell speaks.
Thank you, thank you. Claudia, 20 seconds for you. Any final thoughts?
Yeah, I think we're going to get past today. We're going to learn a lot more next week about the economy. I think this will underscore it's been a bumpy ride. We are still, all is not lost here, right? Like, I think there's still a path to the soft landing, and we are on it. It's just adjustments need to be made. The Fed needs to make some adjustments.
All right. Unbelievable. You guys, thank you so much. Anna Wong, Chief U.S. Economist at Bloomberg Economics out there in D.C. Michael McKee right here in studio, our Bloomberg News International Economics and Policy Correspondent, and Ira Jersey, our Bloomberg Intelligence Chief U.S. Rate Strategist out there at BI headquarters in Princeton, New Jersey, and Claudia Sahm, of course, joining us as well. Read more, too, about her Sahm rule and how we're looking at it when it comes to today's jobs report. You can find it at Bloomberg.com.
All right, much more coming up in just a few minutes. First up, though, we'll check on the day's trade and top business stories. Here's an update from Charlie Powell.
All right, I thank you very much, Tim and Carol. We've got just about an hour, 35 minutes to go ahead of the closing bell. The Dow, the S&P, NASDAQ right now, they are all deeply in the red. That has been the case since we opened trading this morning. S&P right now down 123 points at 53.23. For the S&P, that is a drop right now of 2.3%. Dow Industrials down 811 points now, lower by 2%. The NASDAQ Composite Index down 471, a decline of 2.7%. We've got the 10-year yielding 3.81%, 3.81 on the 10-year. The 2-year right now at 3.90%. Gold is down 0.6%, 24.32 the ounce, while West Texas Intermediate crude oil down 3.6%, 73.60 for a barrel of WTI. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime is making it a tough place to do business. Chevron lower now by 3%. ExxonMobil also lower today. Exxon, after earnings this morning, down now by about 0.7%. So again, recapping here, steep losses for the U.S. equity market. Jobs Friday, S&P down 2.3%, 10-year yield 3.81%, the 2-year right now 3.90%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. If you missed any of that conversation, be sure to download our podcast feed a little bit later on. We're going to stay with the jobs report, as we should on this Friday. As you know, just quick rehash, Charlie mentioning unemployment rate rose to its highest level in nearly 3 years. It does suggest a faster deterioration in the labor market than previously thought. Although, as our roundtable confirmed, Tim, it's not like the world is falling apart.
No, I mean, if you look at certain parts of the market, it might look like it a little bit, but we're only back to June levels on the S&P 500, which is important to keep in mind. Still up more than 11% for the year on the S&P. Let's do some of the numbers here. Non-farm payrolls rose by 114,000. It was one of the weakest prints since the pandemic. Job growth revised lower in the 2 prior months. The unemployment rate did unexpectedly climb for a 4th month to 4.3%. It triggered that closely watched recession indicator, and it has been hammering stocks. So let's get to the interview.
Let's do it. Alan Guarino is with us, Vice Chairman at the Global Organizational Consulting Firm. We are talking about Korn Ferry, and he joins us here in studio. How are you?
Carol, I'm well. Thanks for having me.
It's really
good to see you.
It's great to have you here. And, Today's slowdown in the job market, we're talking obviously a lot about it. Does it surprise you?
Not at all.
Why?
Yesterday I said 100,000. So we're better than I thought. Obviously, everyone has the same lens, right? We've seen the direction of travel. You had a massive shock to the system called COVID. That resulted in decimation of jobs. Okay, so now we had this reaction to that, which was the Great Resignation, massive hiring, a recovery, right? So now we're reverting back to the mean. I'm not surprised at all. And there are a lot of forces here that could actually be very beneficial to companies.
Talk about that a little bit. How is that beneficial to companies? If the labor market weakens, the salary pressure won't be there, the wage pressure won't necessarily be there. But talk a little bit about that. What you're hearing from
Not great for workers, though.
Yeah. Maybe for both. Maybe for both. So the best time to buy is in a buyer's market. So if I'm an employer, I'm a buyer. This is a buyer's market. People want to move. All of our research says that. We just did Korn Ferry Workforce 2024. People want to make changes. Guess what? Not a lot of demand for them to make changes. So guess what? That's the time, if you're an employer, to be smart, because employment and building a team is a long-term game. Mm-hmm. So people wanting to move, lower demand. If you're in the market as a buyer and you're smart, you're going to be gathering this great talent right now when you have less competition.
If you're in the market as a buyer, that's a very important word to use, because what if you're concerned about your business not growing at the same rate that it grew over the last 3 or 4 years? You're worried about weakening labor force, meaning a consumer is not as strong, and therefore your revenues are going down. Are you actually looking to hire people in an environment like that?
Great question. Building companies is a long-term business. So I'm absolutely going to get that talent today, and it will pay me massively in 12, 24, 36 months. That's what CEOs get paid to do. Make those bets, take the risk. And by the way, many won't. If you do, you're going to win.
This is one perspective to the story. If I'm a worker, and once again, I'm not going to necessarily, I'm going to get pushback on higher wages, which we finally have seen some progress in. If I am, I don't know, that I feel like then the worker loses some ground, or that companies are going to be very careful in terms of efficiencies and costs, which they have been for a long time. Does the worker get hurt, which makes me concerned about consumer spending and what it means for the economy, which ultimately will roll back into whether it's publicly held companies or the economy overall?
Great question. We have a range of workforces in the country, right? But if we look at professional level employment, then again, careers are a long-term game as well. While we don't have the same percentage increase in compensation when people are moving today, they still are increasing compensation. And remember, that compensation increase over the last 4 years has been dramatic. So if I'm already making really good money and I only get another 3% when I move, that's still a lot more than the 3% you would have gotten before COVID, because it's off a higher notional number. So don't let the percentages fool you. People are making more money when they move, maybe not as dramatically on a percentage basis as before, but they're getting great compensation.
Who are these people that are moving? The only reason I bring it up, we have a great story on the Bloomberg this past week about Walmart workers. Right. And apparently a lot of angst over a relocation plan. Basically, the retailer is saying, we don't want you working from home. We don't want you working from other places. We want you all back to Bentonville, Arkansas.
Right.
And the workers are not so happy about it.
No, and that's a whole other topic, workforce deployment. I was talking about this certainly during COVID and after COVID. I think the new world of work at this point has clarified itself. It's a barbell. You're going to have a percentage of companies that are basically office-centric, and that's probably 20%, pick a number. You're going to have companies that are fully remote, same 20%, probably on the other end of the barbell, right? And in the middle is the hybrid model, right? How many days a week are you going to be in an office versus working virtual? That's a strategic decision, again, for a smart leadership team to decide on. And it really is a trade-off between what do employees want and what are employers willing to give. Ultimately, the employee votes with their feet. You can't make them work for you. So you have to create a work environment they want. Workforce 2024 at Korn Ferry will tell you that people put compensation and workplace flexibility as the number one and number two thing they're looking for, and a great boss is right up there with 2.5. So you get those right as an employer, you're going to do fine.
Across industries, across
pretty much across industries, yeah, for the professional levels.
Okay.
You said earlier that today's weaker than expected payrolls report was not at all surprising to you. You thought it was actually going to be weaker than it was. Do you see a recession coming?
Boy, not a macroeconomist, and I think
NYMEX diesel September futures settle at $2.31 a gallon. NYMEX gasoline September futures settle at $2.31 a gallon as well. NYMEX natural gas September futures settle at $1.96.
Pace of growth over the next 12 months. Again, if they're smart, you take advantage of that as an opportunity to get positioned to grow. Really great companies actually come out of real recessions, right? You've seen tremendous performance post a recession because...
And NYMEX WTI crude September futures settle at $73.52 a barrel. That's down $2.79 or 3.66%.
We're not going there. This is a typical cycle. We haven't seen one in a long time. I don't know if we have recession or not.
So I think about lots of things that I'm sure come up in your world and with your clients, Alan. And I think about the external forces, whether it's AI, whether it's U.S. politics, whether it's geopolitics, whether it's climate change. I do wonder, what are they thinking about? What occupies their minds so much? Obviously, getting the workers they need. But when it comes to strategies going forward?
Well, what occupies their mind, I think, is the workplace dynamic of today's business playing field. Pace, complexity, globalization. Since 2007, and certainly since the last decade, that has really driven what happens in the workplace compared to a decade, 2 decades ago. So what do I mean by that? I mean, a decade ago, certainly 2 decades ago, work and business was a Division II sport.
Yeah.
Today, because of pace, complexity, and globalization, it's a pro sport, which basically means that you need great talent in order to do well or really outperform. Good talent isn't going to cut it. And by the way, in a professional playing field, there are less people who can perform great. So that to me is what's happening today, what's evolved over the last decade because of those 3 things, and is going to simply continue to accelerate. That's why at the end of the day, great talent makes the difference. Doesn't sound brilliant, it's not, but it's also hard to get.
No, I think about all the CEOs that come in and they talk about the importance of talent. We got to run. Thank you so much. Have a great weekend. So much fun.
Great to be here.
Alan Guarino, Vice Chairman over at Korn Ferry, everybody.
Still to come, Intel plunging the most ever. What's next for the once almighty chip maker? Before that, though, a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. The virtual roll call vote by Democratic delegates to pick a presidential candidate is not slated to end until Monday, but the Democratic National Committee says Vice President Kamala Harris has secured enough delegates to win the nomination. She says she's honored to be the presumptive nominee and will accept the nomination officially next week. Former President Trump says there is no reason to participate in a presidential debate against Vice President Kamala Harris. He says everybody already knows both of them.
Fitzbarkin says big rate cuts are more typical if the economy is rapidly weakening.
How can you be enthusiastic? How can you be enthusiastic about Joe Biden? Okay, I mean, how do you be? But I think she's actually worse. I think she's a horrible candidate because she wants open borders. She was a border czar. She tries to, deny that now, which is not working.
The Harris campaign is launching a new strategy and running ads in papers in the cities where Trump plans to hold rallies, saying he's afraid to debate after saying he would debate anytime, anywhere. FTC Chair Lina Khan says her agency is taking a look at grocery prices and why profits for grocery chains remain so high, even though costs appear to have come down. She says no American should be paying inflated prices due to illegal business practices. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons.
you learn about this case, the more it reads like a Hollywood script. The nature of the killing, the execution, the just brutality of it.
It wasn't in the psyche of people that they could be looted because they are considered so sacred.
And we did it the way you do every single investigation. How do you eat an elephant? One bite at a time.
It jumped off the page at me that you could see that there was a Ponzi scheme taking place.
I started hearing mafia, mafia, mafia.
Il sistema è perfetto. Sono gli uomini che spesso non lo sono.
These are the holders of truth and justice. They cannot be possibly be doing this. But then they are. They are. And the evidence is there. It's overwhelming.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
In recent years, you created an institute, the Jane Goodall Institute, and what is that designed to do?
Well, that was started in 1977, when by then I had a little research station, and 4 of my students were kidnapped, and everything shut down. And so some friends of mine said, well, let's start an institute so that this research can carry on. Bless them. So that was 1977, and it was set up to study, conserve chimpanzees and other animals and educate. And it's developed since then. So it's, you know, we've got 27 Jane Goodall Institutes around the world. And then I realized at some point that the African people living in and around chimpanzee habitats right across Africa were struggling to survive. There was crippling poverty, lack of health and education, moving deeper into the forest, being exposed to diseases like Ebola and HIV from the chimpanzees and vice versa. It hit me. If we don't help these people to find ways of making a living without destroying their environment, conservation won't work.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Earnings season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs. Take a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything.
It's 2:40 on Wall Street. We do check markets all day long here at Bloomberg. Stocks lower across the board. The S&P 500 index poised for its worst reaction to jobs data in almost 2 years. Right now, we have got the S&P down 115 points, a drop of 2.1%. The S&P at 5330. Dow Industrials lower by 780 points, down 1.9%. The Dow right now 39,564. NASDAQ lower by 2.6%, down 440 points, while the Russell 2000 index of small cap shares down now by 3.7%. 10-year 3.80%, the 2-year 3.89%. Spot gold down $17 the ounce to $24.29, a drop of 0.7%, and West Texas Intermediate crude down 3.4%, $73.74 a barrel. Also weighing on sentiment today, tech earnings. Intel shares suffering their largest decline ever. We have got Intel now lower by 26.7%. Amazon after earnings down 8.9%. Apple, though, holding on to a gain after earnings. Apple shares right now up by 2.4%. So again, recapping here, steep losses for the U.S. stock market. Jobs Friday, the S&P now down by 2.2%. 10-year worth repeating 3.80%. That 2-year 3.89%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Something Charlie's been covering, we all have, since those earnings broke yesterday after the closing bell. We're talking about Intel. Shares plunging nearly 30% at their lows today after the company gave the growth forecast, a really grim one, if you will, and also laid out those plans to slash 15,000 jobs, signaling that the chip maker is ill-equipped to compete in the artificial intelligence era. The stock down the most ever.
Yeah, for more on a company, what it was and what it is and what it's going to be, with us is Bloomberg Intelligence senior semiconductor analyst Kunjan Subani, joins us from San Francisco. Kunjan, you write in a note out just in the last half hour that it's hard to find a ray of hope in Intel's earnings. Is there any hope?
Not near term in terms of a fast structural turnaround. I mean, look, the revenue were a miss, which to an extent you can explain because the end market dynamics are getting worse. A lot of other semi peers also highlighted macro weakness in certain areas that Intel is also exposed to. But the weakness in the PC and data center was surprising to us, given that their peers have actually given guidance of strong growth in those areas.
Yeah, surprising is one way to put it. You say that the $10 billion OPEX and CAPEX cuts and dividend suspension seem like a Hail Mary pass to stabilize liquidity and offset slower near-term growth. What's going on?
Yeah, I mean, look, that is not going to structurally change the turnaround. That is not going to likely aid in a faster growth, which is what you really want. But to give them credit, look, that does sort of help stop the bleeding or reduce the pace of the bleeding, right, in the near term. It does give them some cushion and a lower bar and a lower base to begin with now. And even if, let's say, what the implied would be that the revenue growth is not coming very fast, very soon, gives them some liquidity to continue investing towards the goal, getting to the Intel A, bringing back the chips that they have outsourced, which have caused a large portion of the gross margin miss that we saw.
You know, you mentioned the liquidity, and that part in the press release jumped out for me. Concerns about liquidity, cash flow they highlighted, and as part of the reason for suspending that dividend. Walk us through their cash position, their liquidity, maybe concerns, maybe their credit picture. Do investors need to be worried? I mean, the stock is now down on the equity side of things almost 60%, 60% this year.
I mean, the OPEX and the CAPEX cuts, as well as their smart capital program and the two deals that they have done recently for their Ireland fab and the fab in the US, brings in a pretty good cushion of cash inflow. So I think that on that part, they should be okay now after they implement this. Also, they brought down their CAPEX targets significantly, especially their net CAPEX targets, almost less than half than what they were before. So look, that should give them enough cushion to continue investing, rather at a lower pace, but still continue investing, even while, let's say, gross margin and revenue takes some time to come back.
Does the world still need an Intel? Does the semiconductor space still need an Intel, Kunjan?
I mean, given the CHIPS Act and the geopolitical landscape that we have seen over the last 12 to 18 months, right, sort of Intel has positioned themselves to be the North Star of onshore leading edge manufacturing. I mean, they are still these dividend cuts and these liquidity programs will help them to continue that investment path and not sort of hold on or suspend them. So that is still critical if you think a hedge away from Asian manufacturing, especially the China risk and the US-China tensions.
Kunjan, biggest customers of Intel include Dell. 19% of Intel's revenue comes from Dell, according to Bloomberg analysis. Lenovo, HP, Alphabet's up there as well. What do you think customers are thinking about buying from Intel in the future after seeing a report like this?
I mean, I would not think anything should change there. I mean, look, what's really happening, the two biggest segments, which the names you mentioned are the customers, is the PCs and the data server, right? What's really happening in data server is they just missed the AI train. Most of the spending right now is going towards AI accelerators, and you see their peers, NVIDIA and AMD, cashing in on it. Doesn't mean Dell and their customers are going to stop buying and selling Intel CPU-based servers, because they still have the majority share in the market. It's just when you think about share loss and you think about incremental share gains or growth, that's just slowing.
I think about the bigger, broader space, Kunjan, and I think Apple, Dell, Meta, others that have had tough times in their kind of corporate life and corporate history. Having said that, when you think about Intel historically, which was the semiconductor company, right, that everybody kind of, measured themselves against, certainly the US companies, how do you think about Intel's next historical chapter and where it will be or where it needs to be? And can it get there?
I mean, look, the near term seems to be that likely will be a struggle and uphill climb. I think a couple of significant tectonic shifts need to happen in the market if Intel wants to get back to that milestone, right? One is, right now the trend seems to be moving all to GPUs. And again, they're like at least a year or more behind in that area. We did not see an upside to their Gaudi accelerator guide for the full year, which would have been at least a good sentiment if they gave an upside. So, I mean, if the landscape, there's a theory that as things move to inference, landscape moves back to CPUs away from GPU. I mean, look, if that were to happen, then that could be a big win and a big tailwind for them. And the other big inflection or sort of an option play would be this AI PCs. Look, if AI PCs do drive the significant refresh and upgrade cycles and the new wave in a PC, overall PC growth market, that could again aid them to get back to that position quicker.
I'm curious about the 15% of the workforce that is going to be cut by the end of the year. Kunjan, what do we know about that part of the workforce, what they work on, and the types of jobs they could go to?
So far, we have not received any incremental commentary or information from the company. It seems to me it is going to be in a wider area rather than just one division. It seems from when we talk to the management, they are trying to increase the efficiency, change the structure of how the manufacturing unit works as an independent manufacturer and the fabless, the product unit should work. So it looks, if I had to guess, it would be more broader across the board.
All right, we're going to leave it on that note. Kunjan, thank you so much. So appreciate you weighing in on what's a really important story for us, certainly on this Friday. Kunjan Subani, he's senior semiconductor analyst with our Bloomberg Intelligence team, joining us there from San Francisco. Tim, I was just looking at the stocks. It's down about 10% for the week overall. That compares with about a 3% decline in the NASDAQ 100. It was something we were, been talking about with our team about kind of where we are in this cycle, because we've seen kind of a big rally, a big decline, and it's kind of interesting whether or not we're starting to see a little bit of a retrenchment and maybe what it tells us more broadly about kind of the world overall, especially if we start to see a pullback. It's not just Intel, which is a special story, but maybe
we're seeing a pullback everywhere. I mean, the Russell down 3.6% today, and the major indices down more than 2%.
All right, coming up, everybody, straight ahead, we're going to check in on some of the highlights of the Green Festival.
Brent crude futures settle at $76.81 a barrel, which is down $2.71 or 3.41% on the session.
Liquidity is the lifeblood of an airline. We make very conservative decision-making about when we raise funding and how we raise funding. We try to diversify our sources, and we're always very focused on the actual rates. And we like to build in flexibility in these financing structures so that we have an opportunity to prepay debt when appropriate, so that we can continue to optimize the overarching rates that we're paying.
What have you learned with the dynamic move of the interest rates that we've seen from Chairman Powell? I mean, do you go fixed structure or floating structure, much more like what they do in Europe?
Yes and yes. We have a mix currently. It's a little bit of a different model than what I was used to in the public company space. Say in some ways we provide ourselves with a natural hedge, leaving some of our debt floating and some fixed.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, but we also have to be nimble around that as well because things change by the day. I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. They may not be a buyer at this point, but I do want to spend a lot of time in front of that other set that is a buyer at this point. They're interested. They want to be an early adopter of the stock. They're interested in the story.
Good morning from our world headquarters in New York. I'm Menace Credit.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg. Now, your company news headlines on Bloomberg Radio.
From Bloomberg World Headquarters, I'm Charlie Pellet. Chevron is relocating its headquarters to Houston from California after repeatedly warning that the Golden State's regulatory regime was making it a tough place to do business. The move will end the company's more than 140 years of being based in the largest U.S. state and comes amid a shakeup in senior leadership ranks, apparently aimed at improving results. We've got Chevron shares today trading lower by 2.7%, along with the price of oil. Crude today, West Texas Intermediate slumping by 3.4%. ExxonMobil, meanwhile, exceeded profit expectations after the $63 billion acquisition of Pioneer Natural Resources pushed oil and natural gas output to a record. Exxon's results provide assurance to investors that the oil giant is well placed to execute a 15% ramp-up in share buybacks to $20 billion a year, even despite bearish crude market signals. ExxonMobil shares, they're a little change now, down by just under 0.3%. Tesla increased shipments from its Shanghai factory by about 15% in July, snapping a streak of monthly declines in output from its most productive plant globally. Tesla shares lower today by 4.3%. Warner Brothers Discovery says it signed up more streaming customers during 4 days of the Paris Games than the entire Tokyo Games. Warner Brothers Discovery shares today, they are trading lower by just about 2.9%. It is a down day for Wall Street. The Dow, the S&P, NASDAQ, all very much in the red today. Jobs Friday, the S&P down 2.1%, 10-year, 3.79%. Those are our top company stories, and this is Bloomberg.
You're listening to Bloomberg Business Week with Carol Messer and Tim Stenevec on Bloomberg Radio and Television.
It is Bloomberg Business Week on this Jobs Friday. Let's get a check on the latest world and national news. We got Nancy Lyons in the Bloomberg 99.1 newsroom in D.C. Hey, Nance.
Thanks, Tim. The U.S. Secret Service just gave an investigation update. It is admitting to shortcomings in security at Donald Trump's rally in Butler, Pennsylvania, where a gunman fired at the former president. Ronald Rowe is acting director of the Secret Service.
The Secret Service takes full responsibility for the tragic events of July 13th. This was a mission failure.
Rowe says if Secret Service personnel committed policy violations, they will be held accountable. Kamala Harris has secured enough delegate votes to become the Democratic nominee for president. The vice president crossed the threshold of delegate votes during a virtual roll call today, and Harris will officially accept the nomination next week. Do not expect to see a debate anytime soon between Donald Trump and Kamala Harris. Trump, appearing on Fox Business's Mornings with Maria, says he does not need to debate the vice president.
If I didn't do the debate, they'd say, oh, Trump's, not doing the debate. That's the same thing they'll say now. I mean, right now I say, why should I do a debate? I'm leading in the polls. And everybody knows her. Everybody knows me.
Harris has been pressing Trump to follow through with a scheduled debate on September 10th that was to be hosted by ABC News. As for the polls, a Bloomberg News Morning Consult survey conducted from July 24th to the 28th found Harris erasing Trump's lead among voters in 7 battleground states likely to determine the election. Harris is backed by 48% of voters to 47% for Trump. Global news 24 hours a day and whenever you want it with Bloomberg News Now. I'm Nancy Lyons. This is Bloomberg. Now back to you, Carol and Tim.
All right, Nancy, thank you so much. You are listening and watching Bloomberg Business Week. Well, in June, we just wanted to mention something that we did. Actually, Bloomberg did. It was the Bloomberg Green Festival, and it was held in June. It was out in Seattle.
Was it in June? It feels like it was just a few weeks ago.
It was actually not such a long time ago, but it does feel like, considering the news flow. Anyway, it was an incredible gathering, investors, business people. It was folks who make policy. They were talking about opportunities, Tim, and solutions to the climate crisis.
Yeah, one of the folks who was there was Sally Jewell, a former Interior Secretary under President Obama, also CEO of REI, the outdoor retailer. She shared her experience negotiating with oil and gas companies and how they view government regulation, that they just want to know the rules of the road.
Businesses don't hate regulations. They hate uncertainty. That is the killer of business. If I'm making an investment that is going to last for 50 years or 30 years, I want to make sure that I'm going to be able to get a return on that investment and the rules aren't going to change.
Well, there you have it. Sally Jewell, former Interior Secretary under President Obama, also CEO of the outdoor retailer REI.
And it actually wasn't so long ago. It was July.
Was it July?
That's how the news flow has been.
Yeah.
A little crazy, guys, as you all well know. She is one of the voices, though, in a special. We're going to also hear from actor and environmental activist Adrian Grenier, the governor of Washington, Jay Inslee, Stacey Abrams, who you, of course, know from all of her work when it comes to voting rights. She's also talking about the work she's doing on rewiring America, getting electricity and updated systems like air conditioning to people in the rural South, which is something we all know is super important considering how warm everything is right now, really across the country.
Catch the Bloomberg Green Festival. It's tonight at 8 p.m. New York time, replaying this weekend on Bloomberg Television. And you get a little double dose of Carol Masser in there, too. So that's another reason, too.
It's a fun, I also had a fun conversation with Kara Hertz over at Amazon and Sue Bird, and just talking about using their platforms when it comes to activism and the climate specifically.
I will also say it was just a great event. If you weren't out there this year, I don't know what the plan is for next year, when it is. Go next year. It was an awesome, awesome event.
And we were there on a day where it hit a high in the temperature that hadn't been seen in many, many years. All right, folks, for those watching on TV, the close is up next. Tim and I continuing on Bloomberg Business Week.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Live from Studio 2 at Bloomberg headquarters in New York, I'm Scarlett Fu.
And I'm Alex Steele. What a day, what a week.
And the closing bell is about an hour away. Ding, 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 ding.
Ding, ding, big ding, because we are looking at a big rush to safety. We were running for cover all across the board in all the asset classes. You have the S&P down over 2 percentage points, tech getting wiped out as well. You have the VIX jumping, the VIX curve really distorted over in the last couple of days. The 2-year yield down 28 basis points. We haven't seen this move since the SVB crisis back in 2022. A huge move into safety, and that's permeating throughout all asset classes, Scarlett.
And what's driving it? A big miss. U.S. payrolls coming in below estimates of all but one economist that we surveyed here at Bloomberg. So now the debate is this a growth scare or something more? Either way, the Fed is getting blamed for not seeing this coming, which is why Wall Street is signaling to the Fed it is time to act with urgency. Economists at Bank of America, Citigroup, Goldman, and JP Morgan all revamped their forecasts, calling for earlier, bigger, or more interest rate cuts, maybe even before September. And Intel hits the reset button. The chipmaker gives a grim outlook, a sign of its struggle to compete in the age of AI. Intel must now slash jobs and suspend its dividend, leading investors to flee the stock and triggering another wave of the tech rout. Here's Bernstein analyst Stacey Raskin weighing in on the chipmaker's future.
Well, they'll live, but what kind of a life it's going to be? I think that is the question that we're all wrestling with right now.
It's a different Intel entirely now, Alex.
A different Intel and a different market and a different economy right now than it was just 72 hours ago. And here's one big reason why. The white line here is what WIRP expects the rate to be from the Fed in December of 2024. So it basically takes into account how many cuts we're going to see through the end of the year. The blue line is the 2-year yield. They very much track each other. And now, as you look here, you can look at the bond yield just plummeting down to 3.87%. Again, we haven't seen that kind of chunky move in about a year and a half, or almost actually 2 years at this point. And the white line here then is where we're expecting rates to be. We're now pricing in about 111 basis points of cuts, give or take. And now the question becomes sort of how we wind up getting those cuts. Do we get a couple 50 basis point cuts? Do we get them as you pointed out, Scarlett, before the September meeting? But this is the story. This is the story. Bad news is bad news. Weak economy is here. That means lower yields and more Fed cuts.
All right, we'll put that all together right now and kick things off with Jeremy Siegel. He is Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania. Professor Siegel, it is always a pleasure to have you on the program. Clearly a very, very big week in terms of news. You had the Fed, you had big tech earnings, and you had the big jobs report. We're seeing stocks fall for a third day this week, with today's sell-off being the largest. Is this response an overreaction, do you think?
Not really. I think that Jay Powell wished his meeting was next week rather than this week. He certainly missed really bad data both on Thursday and on Friday. And I agree, he should have cut last time. And I do think that 4 cuts by the end of the year would be necessary, and maybe even more depending on certainly the evolution of data. The honeymoon is over. Let's put it that way. Jay Powell and Fed enjoyed this idea that we can bring inflation down, no real consequences. We can wait and wait and wait. Well, I think he waited too long.
But to put in perspective, Professor, I mean, it's not like we're bleeding jobs. The unemployment rate isn't near 5%.
Yeah.
Does that really mean we need to see 27 basis point move on the 2-year or 3% drawdown in tech stocks?
Well, that's a recession fear, and certainly the tech stocks have very healthy PE ratios, as you know. Listen, Jay Powell had 75 basis point hikes. How many? 4 or 5 times. So, why should we be surprised at maybe a 50 basis point drop that he has? I mean, the Fed funds rate is 5.3%. The Fed thinks that the long-term normal rate is 2.8. It's nearly half of that. And we've come so far towards our target. I think that while the Fed hasn't moved a nickel towards its target, I think we see a mismatch there.
So what does that mean for stocks, Professor? Because we talk about the market pricing in at least 100 basis points of rate cuts for this year. But since that is already priced in, you'll need strong enough economic data and earnings to keep stocks rising. What is the likelihood of that happening given what you've seen in earnings so far?
Well, I think it's going to be a choppy second half. I mean, first of all, we have election uncertainty. A month ago we thought, a Trump victory, a layup. It ain't a layup. And There's a lot of uncertainty, coming into November, and then there's going to be earnings uncertainty. We heard some negative things on these calls. So, we had a huge gain at the beginning of the year, and I said, we should be happy with another 5-8% gain, and all of a sudden it went to 15, 20, and then, people think it's the new norm. I get, 10% every 6 months. We have to realize long term that's way above normal. So, we shouldn't be surprised to have maybe a rocky period ahead, and maybe at the end of this period, some good values for 2025.
And that is a great point about sort of sentiment and sort of selling but getting more selling, whether you're looking at the systemic funds that sort of have to sell as the tide really turns, like CTAs or vol funds, and just general sentiment. Like, this is the day that my husband texts me and says, oh my gosh, what's happening to the economy? It's that kind of day. How long do those kind of days last?
Well, this just felt different than what we've seen, because really, here's a day where, before we thought cooling off a good thing, it would encourage the Fed to go down. So when we got some cool data in the past, we didn't have the effect on stocks. This was the first one where people looked at, and I've been looking at, jobless claims. They've been creeping up. Actually, if you make a correction for seasonality that brought them up last year, this, I think, is the highest that we've had since the pandemic. There's a lot of talk about the SOM rule, 0.5 percentage point rise in unemployment rate. So, this feels, now I'm not calling a recession, but this is the most real slowdown signals that we've had since the pandemic of 2020.
Okay, the most real signal of a slowdown we've had since the pandemic. Critical moment then here, Professor. I want to just mention as well the decline in bond yields that we're seeing. The 10-year yield falling below 4% yesterday. Today, it is down to 3.80%. If bond yields do keep falling, how much could that boost the stock market, given, again, what you've heard from companies so far in terms of what they anticipate their earnings to look like?
Well, this might be the final time of a good signal for those dividend-paying stocks. We know they've lagged dramatically over the last, several years. But now, if we're going to be looking at long-term interest rates 4, and who knows, it could go down to 3, then a 3-4% dividend from stocks looks pretty good. And so that might be the defensive play for the coming months, is to go to sound dividend-paying stocks with good coverage that could withstand an economic slowdown without lowering their dividend. It's been a long time since those stocks have, matched the S&P, but they very well could outperform in the next 6 months.
All right, that is definitely something to watch for then if we continue to see the yields falling. Jeremy Siegel, Professor Emeritus of Finance at the Wharton School at the University of Pennsylvania, thank you so much. He's just getting us started because the NASDAQ has entered a correction. It's sinking 10% from its peak. So we're going to continue the conversation with tech valuation expert Aswath Damodaran of NYU for his take on where we stand with the big tech stocks.
All right, plus a deeper look at the dismal earnings report out of Intel. Sell-side analyst Matt Bryson over at Wedbush will join us in today's top calls.
And one of the weakest payrolls prints since the pandemic, Julia Pollack joins us to discuss the job numbers fueling growth fears in today's market. All that and more coming up. This is The Close.
the tech sector.
Spread across global markets.
The real-time data aspect is going to be important.
We're going to bring you expert analysis on that. Sure.
Don't miss Bloomberg's interview with the
The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Growth scare, policy mistake. That is what I'm hearing. That is what you're seeing from the price action.
I think there's a bit of an overreaction here. 114 is still a really strong number. I think we were used to these outsized numbers when we were recovering from the pandemic.
This is the first time that I have a growth scare. In the past, I kept on saying there's no reason for the U.S. to fall into recession.
I think the price for interest rates is wrong today. I mean, should they have moved? I don't know that they were set up to move. Given what they had told the market prior to this.
I do think that we are seeing some of that nervousness around the economy playing through right now, and that might make the first Fed rate cut less extreme.
I think the market now fully understands that the Fed may be late.
Those were some of the voices earlier on Bloomberg Television reacting to the jobs numbers. So let's get more from Julia Pollack, ZipRecruiter chief economist. Julia, I understand the disappointment. The market's clearly in reaction mode. How do you categorize, though, the actual numbers that you see on a daily basis?
So the issue here is not that 114,000 is a good number. It's that the context has changed. So why is that a bad number? It's a bad number because unemployment is rising rapidly. This is not the labor market coming into balance and settling at this new normal. It's a labor market where the slowdown is broadening and accelerating. And that is what people are nervous about today.
And it seems to have caught a lot of people by surprise as well. We noted how the job growth number, the payrolls number, missed the estimates of 73 out of 74 economists who took part in a Bloomberg survey. There's also a downward revision to the June number, excuse me. Julia, are economists getting it wrong, or is the data just not clean? There's a lot of guesswork involved in the BLS's model that just gets revised later.
So I think that many labor market indicators have actually been weakening and deteriorating for quite a long time. Online job postings are already well below the pre-pandemic level. Many of the indicators inside this report have also become worse than in 2019. The hires rate is all the way back to where it was in 2014. I think there have been many reasons to say, wait a second, on the inflation front, if we counted housing inflation the way almost every other country does, we would have declared victory long ago. The New York Fed's measure of underlying inflation, its multivariate core trend inflation, that's 2.06%. It's bang on target. The Fed told us months ago that they'd be happy to cut before we got to 2%. Well, we're already at 2%, and the labor market is deteriorating materially. So why wait?
Can you give me some more color as to where we are seeing from your surveys that you guys do the most deterioration and how that evolves maybe over the next 6 months, kind of your window into that?
Sure. So, over the last year, we've actually had different industries trading spots. We had information do very poorly in 2023, but actually it looked like it was creeping back in the first half of this year. Transportation and warehousing also lost jobs in 23, but was gaining jobs slowly, much more slowly than before the pandemic, definitely more slowly than in 2021 and 2022. But that sector looked like it was moving from rolling recession into rolling recovery. Now, even those sectors that were looking promising at the start of the year also looked kind of weak in this report. The number I've been focused on is the private sector payroll gains outside of healthcare. That number fell to 33,000. Its average over the last 3 months was 75,000. Before the pandemic, it was 137,000 each month on average between 2015 and 2019. So this is really a labor market where the core pieces, the core parts of the economy, the private sector outside of healthcare, has been weak and deteriorating rapidly.
Also, when you look at wages, noticeably the average hourly earnings and on a month-to-month, month-over-month, and on a year-over-year basis have slowed down and came in lighter than anticipated. What are you seeing in your surveys that matches or perhaps challenges that set of numbers?
So that's very consistent with what we're seeing. In our Job Seeker Confidence Index, we got the lowest readings since early 2022. In our new hires survey, we saw large decreases in the shares of workers who got signing bonuses, who got recruited, who got pay raises when they switched jobs. So clearly workers are losing bargaining power and leverage. It's not just the top level sort of payroll numbers that show deterioration. Households, workers, they're feeling it, and it's knocking their confidence. We saw a big decline in the share of workers who negotiated their offers, and among those who did negotiate, we saw a decline in the share who were successful.
All right, Julia, really appreciate your giving us some context to those numbers. Julia Pollack is ZipRecruiter chief economist, and of course on this jobs day, critical to put all the moves that we're seeing in context, including the fact that even though the S&P 500 is down by a lot, there's still 100 names that are gaining, and the ones that are gaining, notably, are all safe sectors. Consumer staples, for instance, you've got Clorox gaining ground, Mondelez, the cookie maker, up 3 1/3%. Kraft Heinz. Catch up anyone? 2 1/4% gain.
And they have the dividends, right? It's not huge dividend, but you get anywhere between solid 2 to 4% with some of those names, and there you go as yields continue to come down. So some winners there, but it is a winner to safety. It is not a winner to something super cool.
Right, and these are the names that have been ignored for pretty much during the tech run-up.
Yeah, what's not ignored is Intel having a terrible day. We're going to break that down coming up next. This is The Close on Bloomberg.
Jason Kelly, and this season on Power Players, we're taking you behind the scenes to see how the business of sports has gone global.
I want sports to grow. I want sports to be bigger because we have talent.
And how mammoth
Seeing Barclays now expect the Fed funds target to be 4.5 to 4.75% by the end of this year and 3.75 to 4% by the end of next year. As Barclays now expecting the FOMC to cut rates 25 basis points 3 times this year, September, November and December, as well as 3 times next year.
What we have achieved in the NWSL from an investor perspective over 2 years is the equivalent of what it took other leagues 25 to 30 years to achieve.
You've got to have a business that's sustainable. The only way it's sustainable is got to make money.
There's only one word: winning. You win on the court, you win off the court. And as you do that, you bring people along.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia trade.
You're watching The Close.
Welcome to Balance of Power.
This is Bloomberg.
Time now for top calls. A look at some of the big movers on the back of analyst recommendations. Let's start with Morgan Stanley, the Wall Street lender getting its sole sell rating from Wells Fargo after analyst Mike Mayo cut the stock to underweight from equal weight. Mayo saying Morgan Stanley has the highest forward price to earnings valuation of any large cap bank, despite negative trends like slowing wealth flows and pressure on net interest income. Those shares getting hurt by about 6%. And Crocs is next in line. You got Raymond James stepping away from its strong buy rating, cutting the footwear company to outperform. Price target is now set at $164. Analysts telling investors to err on the side of caution for what he felt was a conservative second half outlook from a strong performing brand. Shares are down 6%. And let's end things with Intel. You got a slew of downgrades and price target cuts for the chip maker after last night's second quarter report and outlook completely missed the mark. Bank of America, one of them, cutting Intel to underperform and warning investors that there's no quick or easy fix in sight to address profitability. Those shares falling the most on record. Scarlett?
All right, Intel stock, as we mentioned, posting its worst day on record. In addition to giving weak guidance for this quarter, Intel is also slashing 15,000 jobs and suspending its dividend, really underscoring how it's trying to conserve cash right now. The CFO, David Zinsser, saying, quote, "We're putting reduction in place in terms of operating expense, resizing the capital investment to reflect where we are in terms of revenue. I think we now have that into a much better place." So joining us now to tell us what Intel needs to do to get to that better place, Matt Bryson, Senior Vice President of Equity Research at Wedbush. He cut his price target to $25 from $30 to $50, and he has a neutral rating. Matt, first up, let me just understand correctly. I read a lot of notes, and they all use the word reset when it comes to Intel. What is being reset here when it comes to Intel today?
I think largely they're taking down expectations for 2024, 2025, and then also some of the expenses that they planned. So some of their fab build-outs, for instance, are being reset, if you will.
Intel also mentioned liquidity. When you have a tech company talking about liquidity that's not a startup, Matt, is that surprising?
I think that they also talked about being cash flow neutral once you take into account the investment they're getting from third parties and government subsidies. I think it's a little bit concerning that liquidity comes up. At the same time, I think what you're seeing in terms of a reaction today is less about liquidity concerns and more about Intel's been telling us that they have a 5, 6, 7 year plan, and to trust the plan. It becomes hard to trust the plan when they have a difficult time meeting expectations over the next 3, 6, 9 months.
Absolutely. So is this a management problem? Is this a Pat Gelsinger problem, Matt?
I don't think it's necessarily a Pat Gelsinger problem. I certainly think that they should have had a better handle on what exactly PC demand looked like, what exactly server demand looked like, where their share was going to be. They could have given the street better expectations. They certainly could have updated us intra-quarter. But in terms of what their strategy's got to be, if they're going to be a manufacturing company and they're going to compete with TSM, which is a perfectly legitimate strategy, then you've got to invest, and that's what they've been doing. It's simply catching up takes time.
So this is just, they're in an investment phase. They got to go through that. At the same time, any sort of hardware growth in terms of PCs that use AI, that hasn't really kicked in yet. When does that part kick in and wind up helping Intel?
Yeah, so, they told us that part of the problem is actually tied to the fact that they're seeing more demand for AI PCs than they thought, and they just hadn't set up their manufacturing properly to deal with that. So they're taking a hit this quarter, next quarter, because ramps cost more money. They take a hit next year because the platform that they designed for AI is mostly built by TSM, and that costs more. And so they clearly, 2 years ago, 3 years ago, when they were laying out these product sets, they could have made some different decisions that they didn't. But I think things are getting better. It's just a question of can Intel execute?
Yeah.
And if they do, is it the right strategy?
Very quickly, Matt, I just want to get your take on when or what would prompt you to actually cut this stock to the equivalent of a sell. What do you need to see?
Yeah, I mean, I think at this point the problem is they have a ton of fab assets, right? So it's not so much that Intel is losing money or that their outlook's getting worse. It's at some point you value them on their assets.
Got it.
And when they get down to values like this, that they're trading below their asset values.
Okay, Matt, really appreciate it. Matt Bryson over at Wedbush. He's got a neutral rating on Intel. And of course, Intel not the only one. You look at the Philadelphia Semiconductor Index, off 5.5%. There's only one gainer out of 30. You can see some of the big losses there, whether it's Applied Materials, which is a chip equipment maker, or whether it's an actual chip company like NVIDIA.
Yeah, interesting though, Amelius Research coming out and saying that, look, Intel's woes is great news for AMD. So one woes in Intel is going to be upside for others. But let's stay in tech because obviously big tech selling off hard today. We're going to hear from Aswath Damodaran, professor of finance at the Leonard Stern School of Business. He is the valuation expert. If AI wasn't a bubble, has it now burst? And where do we go when the NASDAQ has now hit its correction territory? We're going to break that down. Looking at an S&P here, off by over 2%. This is Bloomberg.
I decided to acquire Indeed 12 years ago when I was 36. I couldn't speak English, but I decided to move to the US with my family. Okay, let's study English. Let's, manage this big American company. But I could do it. Ages are just numbers. If you stay being very curious to run new things, you can keep doing that. So what we're trying to adjust is our company should be the place to maximize people's ability, people's talent, and people's passion, right? Our employees' passion. So we believe that if we can have the work or the vision, people can be passionate, and which is aligned with all what employee wants to do, that's the best way to maximize the people's ability.
Follow your passion.
That's right.
So whether you're 14 or 40 years old.
I think so. Because, what's the difference? I don't know. We might be totally wrong. That's how we have been running this company for 60 years.
Power, money, culture. As Linda Aman tells the story of Asia's rise through the people who are helping to shape it. On this episode,
Asia's here. Asia is here.
Inspired by the fusion of East and West,
I'm like the ambassador of the two worlds.
Hong Kong designer Vivienne Tam explores a future where fashion and technology meet.
When a lot of time when people say, Vivienne, it's not possible, I say, try it. It's possible.
Latitude. Encore presentation this weekend. Only on Bloomberg.
We are about 30 minutes away from the closing bell. It is a brutal day out there. Yes, we're off the lows, but particularly in tech, still getting hit. You have Amazon, Intel, NVIDIA. You have Microsoft all getting hit pretty hard. You have the NASDAQ 100 off by over 2% now, 443 points, and a big chunk of that is Intel.
And it's down 10% from its peak, so it's entered a correction. And what's notable of those four names that you mentioned, one still hasn't even reported earnings yet. That's coming up at the end of this month.
Oh my God, that's right, NVIDIA. Yeah, which is interesting because Cameron Christ wrote a piece today. Did you see that? That was like basically the market is going to be Princess Leia. Like, help me, Obi-Wan, you're my only hope. In that, who's going to come in and help the market? Is it going to be Powell or is it actually going to be NVIDIA?
So NVIDIA looks like Princess Leia right now with the
buns?
Yeah.
Yes, exactly. Okay. All right, well, anyway, in a note that's seen by the Financial Times, this is a note to investors by the Financial Times. Elliott Management calls AI overhyped and says its supposed users are never going to be cost efficient and never going to actually work right. It will take up too much energy or will prove to be untrustworthy. Now, Elliott declined to comment to the FT. Joining us now with his insights is Aswath Damodaran, professor of finance at the Leonard Stern School of Business, also the expert on valuation. So if AI is overhyped, has that AI bubble now burst, Aswath?
I think this is a bubble that's going to burst, build up again, burst again. I mean, it is a revolutionary change. I think Elliott's going a little bit over the line in terms of talking about it not having an effect. But like all revolutionary changes, it's going to have a few winners, lots of losers. The net effect is going to be surprisingly small. It's not like companies are going to become more profitable because they've replaced people with AI. And if everybody has it, nobody has it. If you cut costs and you can't pass them through, essentially you're stuck with the same or lower margins than you were historically. So I've always been a little skeptical about AI being the change that will make markets more valuable. And I think we're coming to that recognition a little slowly. But the Microsoft and NVIDIA price action today is a coming back to earth of those AI dreams.
That's really interesting what you said about how if everyone has AI, no one can really profit off of it. And perhaps we're starting to get some recognition of that. At what point, what would it take for the broader market to start to really absorb that and accept that?
I think reality takes multiple steps. When you're talking about something that can take the next decade to unfold, I think the first effects are going to show up in the companies that are actually making money on AI. The NVIDIAs that provide the architecture for AI, and the big tech companies which have the cloud, they essentially use the cloud to make money on AI. You're going to see numbers come in that are below what people thought they could deliver. The next phase is going to be these AI companies that go public with the biggest dreams, and many of them are never able to monetize those dreams. So like every other change, it takes a little while to play out, but you're going to see it play out maybe over a year, 2 years. It's not going to be overnight.
So Aswath, how do we then value those kind of companies?
I think we have to step back and remember the laws of economics don't get suspended because you're talking about a great buzzword. There's demand and supply. AI, if it's going to be in the form of products, somebody's got to pay for those products, and it's a cost to those companies. So when people talk about AI being a $3 trillion or $4 trillion market, the question is who's paying? Where is that money coming from? And how can we afford that money if we can't pass it through as higher prices? So I think there's a lot of hype here, and I think you got to step back and say, what can really be accomplished with AI? And what are the companies that are best positioned to make money on AI?
I'm looking at the NASDAQ 100 and how much it's fallen for this week. And what's notable here is that this is the biggest one-week drop. Let's see if we can pull this up. You know what? I'm having trouble pulling this up at the moment. But it is the biggest one-week drop since July 19th, 2024. So maybe I'm not doing that right. But let me go back to
No, but I think you are. But I think that's the point. Because it's after CPI and we had that rotation.
Yes,
but that's the point. Like, we've seen this movie before.
We've seen this movie before, Aswath. And I guess what I want to come to you is you had said that it's not going to be overnight. How do you reconcile that with the violent moves that we've seen, not just this week, but in the last 2 weeks then for the NASDAQ 100? Is this move reflective of people accepting something, or is there actual panic taking place?
No, I think in a sense we've ridden the big tech companies for much of this market. And I think they've taken on a role that I think you cannot keep delivering on. So I think part of the reason the rotation is so violent is because we've become so dependent on these top 10, 15, 20 companies, most of them are tech, for our market to be be healthy, and that's not a good place for a market to be. It's always true that the biggest winners carry a market, but it's never been true that the biggest winners keep repeating year after year, which is what we've had for the last few years. So I think that's part of it, is that correction of something that cannot be sustained.
So how much more do you think this route has to go in tech?
I think that, you're going to probably see it, and it's not going to be across all tech. I think that if NVIDIA comes in with good earnings, they might be able to sustain themselves. But I think when momentum shifts, it's often decisive. And what was good news 3 months ago will become bad news. It's amazing. The same news story can become bad news, and the momentum has shifted, at least for the moment.
That's a really good point. You mentioned NVIDIA and it reporting decent earnings. What's interesting about that Elliott letter was that Elliott had said that on what may trigger an actual market bubble bursting is if NVIDIA reports poor numbers and breaks the spell. Do you see enough skepticism on a company like NVIDIA?
I don't think so. I think that people are, at least for the last year and a half, have been giving NVIDIA every benefit of the doubt. And they remind me of a friend of mine who's a Dodger fan. At the start of the season, he expected the Dodgers to win 125 games this season. And I said, look, that's the most games that any baseball team has ever won in a season. If that's what you're expecting, all you're going to get are negative surprises. In many ways, NVIDIA's pricing reflects that. People are expecting things that no company in history has ever been able to deliver. No company. And I think that's a lot to ask for a company. And the only thing you can get is negative surprises when you do that.
That, again, a really good point, just sort of the confirmation bias and the contrary bias on that point. Before we let you go, Aswath, as we're sort of re-rating here, do you think that that money goes elsewhere, or does it go on the sidelines? When the sentiment shifts, what can it pull into its vortex?
It disappears. That's the problem with markets, right? It's not as if people cashed out $2.9 trillion today. It just disappeared into thin air. That's a scary thing about markets, is the value can disappear into thin air. It's not like people have cash in their pockets, because by the time they cash out, they've already lost value. So in a sense, it's money draining out of the system that's gone. And I think that's the plus and minus of markets. Markets can create trillions out of nothing, and they can take trillions away.
Aswath, that was a great ending. We appreciate you very much. Thanks for coming on. Aswath Damodaran, finance professor at the Leonard Stern School of Business, which funnily enough, then, Scarlett, that's going to feed into tighter U.S. financial conditions, which has the adverse effect of what the Fed may want to see. And then that narrative of like, oh, all those people who were sitting in treasuries at 5% and made all that money in the stock market, that's not there anymore.
So we go back to blaming the Fed for not moving quickly enough, for not seeing around the corner, for not knowing that this was coming.
Yeah. And also, funnily enough, so Scarlett went down the rabbit hole. Did you not? About NVIDIA and the sell earnings, which to the point of like, if you expect awesomeness, but we've never seen this awesomeness before, how do you actually judge it?
Yeah, I was looking to see if any analysts had cut their estimates for NVIDIA EPS for later this year or for the full year. I found 2 analysts for the full year. They're both in Asia, so we can't get a hold of them right now. It's 3 in the morning there, but we will.
We will. We definitely will, because we want to get that into earnings. Will NVIDIA save the market, or does it have to be Powell? All right, coming up, we're going to talk about shares of Chevron. They are in the red. The company calls it quits on California headquarters. I spoke to the CEO and Chairman Mike Wirth earlier in the day. That's coming up, stock of the hour. We're coming up next. We're about 20 minutes away from the closing bell. The S&P off 2%. This is Bloomberg.
Bloomberg loves earnings.
news. I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday at 9 a.m. only on Bloomberg.
Lots happening on Wall Street.
I couldn't have been more wrong.
It's going to stay volatile for a while longer.
It's a bifurcated market.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
Year over year, you could start to see some cracks.
It might be overhyped short term, but it's underhyped long term.
From businesses most influential and instrumental.
A lot of the doom and gloom has been somewhat overblown.
If you're not living near the edge, you're taking up too much space.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio. Billionaire Gautam Adani founded one of India's biggest and most controversial business groups. After being rocked by accusations from short seller Hindenburg Research last year, Adani is now preparing for the company's future in a real-life succession story. Meet the family members he's handpicked to take over the business as we deep dive into the facts and rumors surrounding the Adani Group. Inside Adani, a Bloomberg exclusive, premieres August 9th, only on Bloomberg.
Time now for today's stock of the hour. And watching shares of Chevron, they're down by about 2.4%. Yes, it's a tough tape, but they were down yesterday as well. They reported a profit miss early in the morning. They also announced a surprise plan to move their California headquarters to Texas. Plus, their arbitration with Exxon to acquire Hess has now been pushed back to May of 2025, robbing Chevron the chance to get involved in Guyana, a prolific area off the coast of South America. I sat down with CEO Mike Wirth, and he shared his outlook on the global oil market, which has been very weak of late.
It's a market that I think has the prospect of being very well supplied. It's pretty balanced right now. Obviously, there are geopolitical tensions in different parts of the world that can put supply at risk. So it's a little tough for the market to weigh all of that. But at a fundamental level, I think the supply side is strong enough that people are keeping a close eye on that.
Which is really interesting, Scarlett, because oil in itself has been down like 11% in just the last month alone. So that's clearly the theory was that what's up with China?
Yeah.
Is it a weak demand story, et cetera? But it was interesting to hear from Mike that he really thinks it's a supply issue.
And you look at oil today, and it's down again, I think the lowest in almost 7 months on that twin concern, not just China, but now you have U.S. added to it as well, given the weak jobs number.
Yeah, that growth scare, which good jobs number. So we were talking as the jobs number came out, and I said, hey, look, this jobs number is really terrible, Mike. Like from where you sit as an oil CEO, do you see weakness in the U.S. economy? And here's part of what he had to say.
The U.S. economy to us still feels like it's moving along, and the prospects of a recession, which a year and a half ago people were very concerned about, have diminished. We'll certainly still see a business cycle. There's no doubt, but we don't see any warning signs that are alarming in U.S. economic data right now.
I thought that was kind of interesting because he didn't see it. He didn't see that kind of weakness.
And even with all the hand-wringing over today's jobs number, no one's talking about recession just yet. They're just talking about how quickly the conditions have changed in the labor market from what we had before to what we have now. And perhaps maybe not entirely trusting what the BLS is telling us month in, month out.
Yeah, and it also goes to just in terms of what we're seeing in the actual market, too. Like, a correction was kind of expected at some point, right? Ira Jersey's been talking about a rally in the front end of the bond market for quite a long time. Just no one expected it to happen in one day.
Yeah.
So going to where we are with the 2-year might not be crazy, but maybe in one day it's a question mark.
This unwinding of all these risky trades of the big AI trade, Aswath Damodaran of NYU Stern School of Business was just saying that it's kind of painful that it's happening so quickly, but maybe it's less painful that it happens this quickly as opposed to being drawn out. Yeah, over time.
Funnily enough, we go back to commodities, drip, drip, feed, crude down by about 3%.
Yeah.
Crude has been getting hit consistently, and that is really a China part story, which is then funny because copper is trading flat. So it's not trading necessarily on those growth concerns. Yeah, which I think is also quite interesting as well.
Gold is also not getting the boost you might expect on a day in which there's a flight to safety. Gold currently down 0.4%. I would have thought it would have gotten a little bit of a lift the way treasuries have gotten a lift.
No, because you get a cut, and then you kind of sell gold when you need it, when other assets are getting hit hard. Anyway, we're going to continue to count you down to those closing bells. Adam Turnquist, Chief Technical Strategist over at LPL Financial, will be joining us. A lot of technical damage could have been done today. We're going to dig through what's left. This is The Close on Bloomberg.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
What we try to do is combine some of our insights from the fundamental business with external and data set signals. And I think that's a lot of times where the opportunity is.
Arch has laid plenty of groundwork for future revenue, but for now, Mark Messler's most pressing challenge as CFO is conserving capital.
You have to have the short-term discipline to sort of circle the wagons around cash. I mean, cash is oxygen. I know where every ounce of cash is going, and but we also have to be nimble around that as well because things change by the day.
Archer went public in 2021 in a reverse merger with a SPAC, Ken Moelis's Atlas Crest Investments. Through August 2023, the company raised over $1 billion from investors including Stellantis, Boeing, United Airlines, and Cathie Wood's ARK Investment Management.
Does that ARK investment open doors for you to bring in different kinds of institutional money going forward?
It does. I mean, I think there's a lot of credibility that comes in with an investor like ARK. As I think about, my top targeted list of investors over the next 2 to 3 years, an investment like that gives us some credibility and gives us a little bit of staying power as I go in and talk to other investors.
With the SPAC pipe now closed, Archer's
So 1 minute now until the market on close
raising
imbalance.
capital.
I know the folks who aren't willing to invest right now may have large pockets of investment in the future. So I want to be in front of them. I'm wanting to show them progress. I want to create credibility with them that we are marching towards our goals of commercialization.
Season is here.
You're seeing back-to-back billion-dollar-plus quarters.
The forward indicators were so positive.
Bloomberg is first to break the numbers.
Texas Instruments out, folks.
Goldman Sachs. Taking a look at Mattel.
There is something for everybody.
With the smartest insights.
People are whitewashing AI.
Wallets are under pressure.
We are committed to EVs. They're going to happen.
Earnings season in full swing.
We will have full and instant analysis.
Continuing coverage on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg.
So we're looking now to the market on close imbalance. The S&P 500, 190 million to the buy side. NASDAQ 100, 765 million to the sell side. Dow 30 stocks, 200 million to the buy side, while Mag 7 stocks are seeing 245 million to the sell side.
The honeymoon is over. Let's put it that way. Jay Powell and Fed enjoyed this idea that, we can bring inflation down, no real consequences. We can wait and wait and wait. Well, I think he waited too long.
That was the one and only Jeremy Siegel, Professor Emeritus of Finance at the Wharton School, kicking off the show. And notable when you have a perennial optimist like Jeremy Siegel saying the honeymoon is over based on what we're seeing today and the results that we've been getting.
He said the most real slowdown signal that we've seen since 2020.
Yeah, based on the jobs number. And, Jay Powell is probably maybe feeling a little bit of regret that he didn't get all this before the FOMC decision.
Non-buyer's remorse. And you can see it across the board in the equity market, running for cover, right? Sell equities across the board. Sell the NASDAQ 100. Intel having a terrible day. That is idiosyncratic to Intel, but you can see it bleeding into all the other areas of the market. And the Russell 2000 underperforming. Yeah. And the question, to me, the question is so that rotation's done? Do you buy the dip in the Russell? Do we still like that? If the Fed's going to have to cut 100 basis points this year or not?
It's definitely on pause for now, and we'll sift through and see what happens. But you mentioned Intel being idiosyncratic, but most companies are not totally prepared for this AI age. I mean, Intel's a lot farther behind because it's in the exact industry that NVIDIA and AMD are in, but there are a lot of companies are scrambling to play catch up, and they might not be able to get there.
That's really good point.
And even as they spend more and more.
And that re-rating going to be very severe, apparently, when you have to.
Yeah. So if you look at what's going on in the markets right now in terms of what's actually rising, the ones that are gaining ground is notable, right? You've got a bunch of consumer staples names. They kind of hold on to their customers no matter what. All right, so let's broaden this conversation out and bring in Adam Turnquist. He is Chief Technical Strategist over at LPL Financial, the perfect guy to speak with on a day like today when you've got big declines in equity markets. Adam, first off, do you see anything disorderly today or this week?
I'm going to go with Jeremy Siegel's "the honeymoon is over" line. I'm going to steal that from him and talk about that in volatility, because I think the period of volatility of that low vol regime we witnessed in the first half may be over as we go into the second half. And you can see that playing out as we roll into August, historically a weak month, followed by a weaker month in September. But in terms of major disruptions, I think you have to frame it up in two ways. On the shorter term, we're seeing a lot of technical damage in the market, but longer term, and I think this is important for investors, the bull market is still alive. We're still trending higher above a 200-day moving average. And some of the breadth metrics that we look at, including how many stocks are above their 200-day moving average, that's holding up well, but that doesn't mean we're not subjective to some further downside here for the S&P 500.
So I made a very dramatic statement, sort of, the technical nightmare that we've seen unfold today. Was there a technical nightmare? Have we hit some severe levels where selling begets selling and then it just becomes a self-fulfilling prophecy here?
In the tech sector and the semiconductor space, I would call it some pretty important levels were violated. We're taking out the March highs. I think both of those, the sector and the sub-industry group, could be subject to downside closer to their 200-day moving average, even the April lows. And you have to ask yourself, if semiconductors and the tech sector have further downside to go, how's the rest of the market not going to follow, especially considering semiconductors have been a consistent leader of the bull market, lead on the way up, lead on the way down. So I do think we could see some further downside. On the S&P, though, keep an eye on the March highs right around 53.21 if we start breaking that level. I think maybe worst case, we get down to those April lows and 200-day moving average, call it 49.50 to 5,000 for those levels.
What about small caps, Adam? I'm looking at the Russell 2000, and it's holding right above its 50-day moving average. It's got a little ways to go before it hits that 100-day moving average. But in terms of where it is versus where it was before that very cool June CPI report, it's only up about 2.7%. Technically, how distressed or how fragile does the Russell 2000 look?
Right now, with small caps, this is probably the number one question I'm getting. Is this rally real? Of course, we had a significant pullback as we witnessed the labor market cool off here, especially some further evidence of that today. And small caps right now, when you look at it, it's on a relative game versus large cap, and they're still underperforming. That's the longer-term trend. There's still some resistance to go through to get to new highs on either the S&P 600 or the Russell 2000. very broad-based rally coming out of their range that they've been stuck in for most of the year. But I think there's more work to do there, not just on an absolute basis, but on a relative basis, because that longer-term downtrend of underperformance is still in play.
So to that point, if I just look at a chart with its moving averages, we had a really big gap up after we got that CPI report in mid-July. Is this downturn, though, for the small caps just filling that gap? And if we hold the moving averages of 50 and the 100-day, are we going to be okay here? Or if we break that, what happens?
I think that could be the case where we're just filling the gap. I think it's going to really depend on the data coming out. Small caps much more economically sensitive, and that recession risk, if that does continue to rise, it's not going to look good for small caps on an absolute or relative basis. So I think the play here for investors is lean a little bit more toward large over small until we get some clarity on where the labor market is really going.
I got to ask you about seasonality because a lot of times nothing much happens in August. September tends to, be when people come back into the market again. But we've got an election year as well to consider. So how are you thinking about what we should pay attention to based on historical patterns, given what is going to take place this November?
Volatility tends to ramp up as we get closer to Election Day, whether that's the VIX, if you look at the implied volatility, tends to peak right around Election Day. And the one big stat that we're watching closely, especially it starts on Monday, we're going to be 3 months from Election Day. How the market performs in that 3-month window has been a really good indicator for the election outcome, meaning if the market, the S&P 500 that is higher during that 3-month window, the incumbent president or party tends to win the White House, and vice versa. The market's lower, it tends to get a flip in the White House. That's happened at 20 of the last 24 elections.
All right, great to keep in mind. Adam, really appreciate your joining us today. Adam Turnquist is Chief Technical Strategist over at LPL Financial. I think the quote of the day right now, based on what Jeremy Siegel was saying, what Adam Turnquist just told us is the honeymoon is over. Yeah, honeymoon is over, and it's definitely over for certain areas of tech as well. Just take a look at some of the losers here. We're about 4 minutes away from the closing bell. You have Intel holding firm down about 26%. This is within the NASDAQ, the losers within the NASDAQ 100. Also, Amazon off after earnings yesterday, which we haven't even talked about, down by 8%. You also have Micron is down with the chip sector like Intel, and you Applied Materials also. All of that really weighing on the NASDAQ 100. But you mentioned earnings. Apple reported earnings, and it's kind of been forgotten in all this. Yes, because it came out with numbers, and the focus really is on what Tim Cook is going to say about the refresh cycle for the iPhone 16. Right now, still holding on to a gain. It's pared some of its advance, but still holding on to a gain. DoorDash, a big gainer too, up more than 8%. That's such a good point. And then on the flip side, you have like Clorox, you have Mondelez also doing well. That's going to be like a safety play. But the fact that Apple's holding its own when the NASDAQ 100 is getting really pummeled, I also think is quite interesting, and particularly when you're seeing a lot of volatility pick up. It didn't benefit as much from the whole AI play heading up into its results as much as the other companies did, right? Because it's still all based on a refresh cycle. Yeah. We're moving closer to the closing bell. We've got full market coverage right here on Bloomberg Television and Bloomberg Radio. Keep it right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
We're about 2 minutes away from the end of the trading day. Scarlett Fu and Alex Steele here to take you through the closing bell. It's a global simulcast, which means that we have now brought in Carol Massar and Tim Stanovic to help make sense and really show you the numbers here and show you the context of what's going on in the equity markets. Welcome to our Bloomberg Television, radio, and YouTube audiences worldwide. Carol Massar, I think we all knew when the opening bell was about to ring that this was going to be a brutal day given the jobs report we got.
Interesting day, but what I find fascinating is that we're not seeing, at least right at this moment, some selling into the close, that we are off our worst levels of the session. Yes, a technical correction, 10% on the NASDAQ 100 from that July peak. But having said that, I don't know. I feel like we've had a lot of guests who said, let's take a breather. It's one report. We know there's a trend. We're concerned about a weakness, but the world isn't falling apart.
Yeah, that's exactly what Torsten Slok told us from Apollo. He joined us at the top of our hour, and he said, look, I changed my view after we heard from the Fed yesterday, and I changed change my view after seeing the data today. We do think the Fed will cut in September, but he said this is just one data point, and he still pointed to a lot of alternative data that showed that what he believes is a very strong U.S. consumer and a very strong economy.
Well, what's come up in the last hour for us is that the narrative has changed. Like the story has changed. You can parse through the data in a different way, but overall, that's kind of what we're dealing with. And you can definitely see that if you just look at the VIX, not only the jump, but the VIX curve and how quickly we've re-rated. Even the volatility of the VIX has been impacted significantly, and holding that volatility regime higher would also be another shift for the markets. All right, those are your closing bells. Whew, we made it there. Volume quite elevated. We're still settling out here, but it looks like we got the Dow Jones Industrial Average off by 1.5%, S&P off by a little less than 2%, the NASDAQ off by 2.4%, and as Carol, you were saying, it could have been worse just even a few hours ago.
Yeah, absolutely. All right, folks, so staying with the big cap names here, the S&P 500, 372 names to the downside, 131 gaining ground. But I just want to point out, guys, you want to guess what the worst performing name in the S&P 500 is this week?
Not Intel?
It is Intel.
Oh, okay.
Over to you, Scarlett.
Hey, Scarlett, good guess.
Well done, well done.
I pass. Okay, let's take a look at how the sector performances shape up. You see a lot of red there, and that is mainly because of weakness across 8 of the 11 sectors. Consumer discretionary losing 4.5%. Financials down 2.4%. Energy losing 2.25%. Tech, by the way, is only off by 2%. I mean, there's 4 sectors that have fallen more than tech. What's notable, of course, is those that have bucked the decline. You've got consumer staples, utility, and REITs. Definitely a play for defensive sectors, for sectors that pay out consistent dividends and that are supposed to do well in tough times.
All right, guys, let's get to some of the individual gainers. And we talk about, sometimes market rotation. We'll get to that, and I'll show you why I say that. First of all, though, Apple did eke out a gain at its highs, up 3.3% in the trade, finishing the day with a gain of about 0.7%. So it was one of the top gainers throughout the day on the NASDAQ 100. Analysts optimistic about the company's iPhone 16 launch and AI rollout plans. Apple did predict that its new AI features will spur iPhone upgrades in coming months, helping the company reemerge from a sales slowdown that has hit as China businesses especially hard. So upbeat third quarter results, mostly we know, we broke it down last night, but those sluggish sales in China. So here's what I talk about market rotation a little bit. Clorox is your number one gainer in the S&P 500 today. Shares jumping up 7.5% here at the close. Company reported fiscal fourth quarter adjusted EPS that topped the average analyst estimate, issued a better than expected profit outlook for the year. And on to DoorDash we go. This one finishing just off its highs, up more than 8% today. Number 2 gainer in the NASDAQ 100. The company's third quarter adjusted EBITDA forecast coming ahead of consensus estimates. It also showed delivery order growth, so few gainers in that Friday trade.
Yeah, just a few. There were a lot of decliners, though, that I could choose from. And in fact, every single decliner on my list today fell at least double digits. I got to start with Intel. It's down 57% so far this year, guys, after today's drop of 26%. It's the biggest single-day drop. It's going all the way back to the early 1980s when Bloomberg started keeping track, perhaps going all the way back to its IPO. Right now, trading at levels last seen since 2015. It shed more than a quarter of its value today. The company gave that grim forecast. It laid out plans to slash 15,000 jobs. It signaled that they're ill-equipped to compete in the artificial intelligence era. Also suspending dividend payments to shareholders starting in the fourth quarter. And it's going to continue that until, quote, cash flows improve to sustainably higher levels. The company has paid a dividend going back to 1992. Shares of Amazon falling by 8.8%, closing by 8.8%. At one point, it was down 10%. Shares falling the most in more than 2 years. Shares fell after the company told investors that profits for now will take a backseat to heavy spending on AI. Amazon said that operating income for the current quarter that ends next month will be $11.5 billion to $15 billion. Analysts were looking for $15.7 billion. And then check out what shares of Snap did today. They fell 27%, which for You know, a lot of other companies, that would be a superlative going back the most since, you know, in many years or the most ever. Well, it's just the worst day for Snap since going back to February when it fell 35% in a single day. So it just shows the volatility and the big one-day moves that this company makes. The company did report disappointing second quarter sales. It gave a lower than expected outlook for earnings in the current period. Actually did see stronger user growth, marking a step back in the company's years-long quest to rebuild its core advertising business, but still, second quarter sales and lower than expected outlook disappointed investors. Shares of Snap finishing the day down by 27%, down 45% so far this year.
Yeah, it's also because Meta did well on ads, so I wonder if there was
good point.
also a tough comp on that one. All right, guys, bond market super active today, buying across the curve, but the buying in the front end was very dramatic. You're looking at 2-year yields on the day down 26 basis points, but on the week, the 2-year yield is down 50 basis points. That's the kind of move that we saw back in March of 2023 when the SVB crisis bubbled up into view. And just to point this out, the 210 curve steepened the most since 2022. I mean, these are really deep superlatives in a bond market that has been very whippy and moved a lot very, very fast.
All right, so you might, as an investor, think you've had a rough week. But if you are an investor who also rides New Jersey Transit, you've really had a rough week. I don't know if you guys saw this story. It's among the most read. It just starts with this. One passenger suffered repeated panic attacks. Another held hands to try and comfort each other. Firefighters attended to at least 2 people with medical issues. Business workers shed layer after layer of clothes drenched in sweat because a New Jersey Transit train last night got stuck underground and then the air conditioning didn't work.
Wednesday evening.
Wednesday evening.
Oh
Yeah.
my
I'm
God.
sorry, Wednesday evening.
By the way, the context here is there's a bit of a heat wave in the Northeast. I mean, the humidity is out of control. Every day it's like 89, 90 degrees,
like a
but it
sauna
feels like
This is
95
disgusting.
degrees.
Yeah.
This is the stuff of true nightmares. Like, this is the stuff that, you know, you never want to have happen to you and that you get, maybe it's just me, guys, I don't know.
No.
I
This
do
is
not
like
want to be
you
stuck
can get heat stroke and stuff.
under
like,
a
this
body
is not,
of water in a train with no power, no air conditioning, and no idea when this thing is going to start moving. Apparently, only Verizon service worked on the phone, so passengers were giving each other their phones so they could make calls and make adjustments. They ultimately got towed back to Penn Station. Some people
Where they
spent the
started
night.
from, by the way.
They had to get a diesel engine from Amtrak to tow them back to Penn Station.
Did they get like, I don't know, Krispy Kreme cards or something?
I don't know.
Yeah, McDonald's.
Infrastructure.
So
Can you imagine getting back on a train after that?
You can't blame anyone for wanting to leave the tri-state area and going maybe down south to Florida, right? The problem there, though, is that you have impossible traffic because so many people have the same idea. They're all moving to Florida, and now you're stuck in gridlock all the time. The cities in Florida don't necessarily have the infrastructure to deal with this influx of people who have come in and have stayed since the pandemic.
Wait, so that's seriously a thing? So now we're looking at like crazy kind of traffic, but now in Miami because all the New Yorkers left and went there?
It's costing commuters an average of 70 hours each year, and that adds up to, according to one estimate, $3.1 billion in losses.
What are you going to throw
Is it
out there?
public transit, infrastructure?
That's a big problem,
investment there? Would that sort of alleviate some of the pain that we're talking about?
But do they have public transit in the same way that we're used to? No, right? I mean, they have some.
What I'm saying is it could alleviate some of that pain.
Right? 8 out of 10 have driver's license. So there is no like mass transportation.
How do you do that? Do you raise taxes in order to pay for that? Or
no, you can't do that. It's Florida, right?
Well, then what do you do?
You got to hit the road.
Oh, wait.
That's what you do.
Ken Griffin, wait, you came down. Like maybe you can help us solve this problem?
Maybe it's a private, maybe it's a private thing.
There are private solutions, but they cost. Yeah, they cost money.
Got to call Elon to build the boring company tunnel there, right?
I love those tunnels.
Yeah.
I think it's a great idea.
No, if it's actually implemented.
All right, you guys, stay cool. Hopefully it's going to ease a little bit. Maybe
I hope you don't take New Jersey Transit
I was like,
home,
good luck
by the
getting
way.
home, Carol.
I'm getting into a tunnel very soon, guys. All right, have a great weekend, you guys. That's a wrap. Our cross-platform coverage, radio, TV, YouTube, Bloomberg Originals, folks. We will see you again, same time. Some of us, I think Tim's going on vacation.
That's okay. I'll see you guys soon.
Yeah, but we'll see you guys on Monday.
Safe travels, Tim.
Thank you.
All right, coming up on the close, Citi is now forecasting 2 supersized Fed cuts this year. We're going to speak to the economist behind that call, Veronica Clark, up next. This is the close on Bloomberg.
names in global leadership are on Bloomberg.
We are 40 millions. We're a big country, and we really depend on the aid from the world. And we depend on the aid and the position and the stance of the US. So I would like to understand, what would it mean to finish war fast? If Trump knows how to end this war, he should tell us today. Because if there are risks to Ukraine's independence, if there are risks that we will lose the statehood, we want to be prepared for this. We want to understand whether in November we will have the powerful support of the US or we'll be all alone. Only our lives are at stake here, and nobody can just trade our lives.
Nobody covers the top global leaders like Bloomberg Television and Radio. The top names in business are on Bloomberg.
Middle market line draws are basically still about 5 percentage points below where it was pre-pandemic, which means as cost of borrowing went up, people aren't being quite as aggressive, and that's why the economy is slowing down. They're not hiring quite as many people. They're not buying that piece of equipment. They're not doing it because they're a little worried about final demand, and therefore they're being careful, which is unpleasant for your bank, but is okay because the companies are still making profitable and the credit quality is good.
Nobody covers business like Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Alex Steele. It was a week for the record books. Let's take a look at where markets closed out here. Running for cover. Honeymoon is over. Take your superlative and run with it. Jeremy Siegel like the honeymoon is over. So the S&P 500 ended today down just 1.8%. I say just because it was a lot worse earlier, down by about 2.8%. And that would have been the worst slide since 2022. So we did see a little bit of volume come in at the end of the close. We did see off the lows of the session. The VIX, though, having a big jump in a very short amount of time. You look at the VIX curve from just a week ago, a huge re-rating now has taken place within volatility, which you can be sure has then affected those systemic funds that track volatility and have to follow the trend, like CTAs or vol funds. That's going to exacerbate any kind of selling that we see. The money is very clear where it's going. The money is going into the bond market, particularly the front end, and into the yen. 146. Remember when it was 116? We were talking about that intervention. Nope, 146 for a dollar yen is the yen, as well as the bond market shine for some safety trade, Scar.
Yeah, so some big moves on the macro front, also some big moves on the micro front, particularly with Intel, losing 26% on the day, the biggest drop ever, at least in data that we track going back about 40 years. Clearly the worst performer in the S&P 500 as well. It gave soft guidance for this current quarter and also indicated it is going to cut 15,000 jobs and suspend its dividend. The CFO talked about liquidity in the press release, which definitely raised some eyebrows. Amazon.com coming out with results as well. Again, AI spending unnerving investors. This is a theme that we've seen across the Mag 7 names. It was the case for Amazon as well. That stock having its biggest drop since April of 2022. And I did want to end on a company that did better. Apple also came out with earnings up 0.7%. Tim Cook talking about the AI features, the Apple Intelligence features will spur phone upgrades when the iPhone 16 comes out and the iOS is ready for it. That'll be in the coming year. It's not going to start right away when the iPhone launches in September. But we got to go back to the broad market overall because our top story this hour is really about the losses that we've seen. At its low, the stock market was holding its best, or I should say its worst jobs day in 2 years, its biggest decline on a jobs day in 2 years. And that pushed the NASDAQ, seen here, into a correction, down 10% from its peak. While bonds, they rallied hard, pushing yields lower. Bad economic data is no longer good news for risky assets. Traders are now pricing in a full percentage point of rate cuts this year, and debate is really generating on whether we are on course for recession.
All right, well, let's bring in Jess Menden. She covers Bloomberg Equities for us. She also deputy team leader and been digging through this throughout the whole day. Jess, what is my narrative from this week?
Right, so a lot of people are pointing to economic data, growth concerns, but when I'm speaking with my sources, so whether it's portfolio managers, people who are working at hedge funds, maybe even just swing traders, a lot of this is more the rotational trade is still on. It's just the rotation's going to other pockets of the market. So Alex, you and I were co-hosting on radio earlier today. So you and I were talking about how a lot of times my sources, of course, the big run we saw, say, in the Russell 2000 in July, huge historical outperformance points if you're looking at it against when it comes to large caps. But the argument for that at the time towards, say, mid-June, late June, going into that rotational trade was that they're just so cheap. But now if you look at where after that run did, they weren't as cheap as they had been. And then the question was, well, what about its earnings outlook? And that still is a question mark and remains really elusive there. So you've continued to see, actually, since Powell spoke on Wednesday, where a lot of this rotational money is going more toward those dividend kind of low volatility type sectors. So especially if you're looking at the flows. So Ignatius Serafigis, I got him to pull some of the latest flows data from Bloomberg Intelligence for this week. So you saw some gangbuster numbers here for when it comes to real estate as well as utility flows there. So close to about $1 billion combined. If you look at technology, about $300 million. And then some of the ones you saw the biggest outflows were probably not surprisingly discretionary. Obviously the worst performing sector that we saw this week. Obviously Amazon was the big, because of its weighting today, pulling it down there. But you're seeing the rotation still going. It's just more toward those income driven type sectors that obviously their weighting is a much smaller in the major indexes, say the S&P 500, than obviously technology.
US bank deposits rose to $17.578 trillion from $17.562 trillion in the prior week.
Turn things around for the growthy tech stocks. It's worth noting that the NASDAQ Composite is still up 12% so far this year. I mean, it's gained a huge amount, and even with this pullback, it's still up by double-digit percentages.
And the S&P 500 from that October low still up roughly about 30%. And Michael Hartnett over at Bank of America today, he puts out, they do their modeling on EPFR data flows, but he had an interesting stat talking about if you went back to the 70s and looked at how usually the S&P 500 performs leading up to, like 9 months leading up to a rate cut in that anticipation. Usually you would see the S&P 500 gain on average about 2%, but this time the S&P 500 was up double digits, around 30%.